only concern is that
डिस्कशन में जब से लोन टैप से साइन हुआ था तब से हम बैंक ऑफ महाराष्ट्र को बोल रहे हैं। बैंक ऑफ महाराष्ट्र हमारा बहुत बड़ा पार्टनर है। हम बोलते हैं बस इतना टीए करते हैं, इतना कम करते हैं, तो कोई नहीं करते हैं। तो कहीं
नहीं, अभी क्या है, डिसीजन मेकिंग फास्ट है मेरे पास
सर,
हाँ या ना तुरंत बस
ये अब सर मैं आपको बोलूँ कि पड़ेगा पता ही नहीं होता है। अब यदि मैं किसी को बोलता हूँ कि मैं बैंक ऑफ महाराष्ट्र का मैंडेट ले रहा हूँ तो पीपल हैप्पीली गिव इट टू अस कि हाँ भाई वहाँ ट्राई करना है।
बाकी ऐसा कुछ नहीं है। Every sector where things are happening, I would like to participate. Why do this?
सर आप लोग को लैंडिंग क्या है?
Good morning, everyone. To all the dignitaries present here today, on behalf of the Association of Financial Advisors of India, a very warm welcome to the National Summit and Awards, Transformative Partnerships in Co-Lending and Loan Service Providers. Today, as we gather here in Mumbai, we are set to explore an incredible convergence of ideas and initiatives driving the co-lending ecosystem in India. I am Anupriya Dobal from the Association of Financial Advisors of India, and it is my honor to be your anchor for this summit. Today's event brings together a round of applause as they illuminate a lamp, setting the tone for a day filled with enlightening discussions and transformative ब्रह्माच्युत शंकर प्रभृतिभिः देवै सदा वन्दिता सा मां पातु सरस्वती भगवती निःशेषजाड्यापहा। शुक्लां ब्रह्म विचारसार परमां आद्यां जगद्व्यापिनीं वीणा पुस्तकधारिणीमभयदां जाड्यान्धकारापहा। हस्ते स्फाटिकमालिकां विदधतीं पद्मासने संस्थिता वन्दे तां परमेश्वरीं भगवतीं बुद्धिप्रदां शारदाम्। Thank you, everyone. Now I would like to request you to take your respective seats on the dais. Now I request Mr. Jyoti Prakash Gadia, MD Resurgent India, to felicitate Mr. Nidhu Saxena, MD and CEO, Bank of Maharashtra. Mr. Ashish Agarwal, to felicitate Mr. Shankar Tripathi ji. And Mr. K.K. Gupta sir, to felicitate Shachindra ji. The warmth of the lamp has set the stage for today's discussion. It is my pleasure to invite Mr. Ashish Agarwal, Summit Chairman and Founder Member, AFAI, for the welcome address. Mr. Ashish Agarwal is a director at Resurgent India and the founding member of AFAI. He brings over 25 years of expertise in investment banking, corporate finance, debt syndication, and capital markets. He actively contributes to multiple committees at PHDCCI and ASSOCHAM and frequently participates as a speaker and jury member at national financial forums.
Yeah, good morning, everybody. So, friends, welcome to the AFAI National Summit on Co-Lending and Awards, being held shortly after the Co-Lending Day, because the RBI circular was announced on the 5th of November. Today is 12th of November. So, this is a Co-Lending Day which we are celebrating, followed by awards. I am privileged to welcome esteemed dignitaries, including Shri Nidhu Saxena ji, who is the MD of Bank of Maharashtra. We have Mr. Tripathi ji, who is the Vice Chairman of Aadhar Housing. And we have Mr. Shachindra Nath, who is the MD of Ugro Capital, and Mr. Jyoti Prakash Gadia, who is the MD of Resurgent India Limited. I would like to welcome to all of you for joining with us in this program. And the guests who have come from the various stakeholders in the co-lending journey. So the banks, NBFCs, the fintech companies, co-lending technology players, and the LSPs, loan service providers, and the journalists and other distinguished guests, and ladies and gentlemen. Friend, this summit aspires to cultivate collaboration across a broad spectrum of stakeholders, including banks, NBFCs, fintech innovators, regulatory bodies, and technology players. The RBI issued guidelines on co-lending by banks and NBFCs on two priority sectors on November 5, 2020. The government aims to enhance credit flow to the underprivileged and underserved sectors to the economy, ensuring that the funds reach to the end beneficiary at the affordable cost. The approach leverages banks' lower cost of funds and the broader reach of non-banking finance companies in this segment. So this is the objective of RBI to start or to launch this co-lending partnerships between banks and NBFCs. Friends, the AFAI Co-Lending Award seeks to honor pioneers transforming the co-lending landscape. These awards aim to celebrate innovation, excellence, and collaboration, recognizing those advancing the financial inclusion, driving sustainable growth, and setting new industry benchmarks. AFAI is a leading industry body which is part of the entire ecosystem, which is helping or which is bringing all the financial advisors across the country at one place. This initiative has been taken by AFAI, and this is a non-profit organization, and AFAI members belongs from the banking and the other financial advisors from the different part of the country. If you see in many Western countries, regulatory frameworks create a cohesive ecosystem by regulating and aligning the interest of the borrowers, lenders, loan syndicators, and other stakeholders. India's financial landscape, however, presents unique challenges. So that's why this AFAI has been created, where we can bring all stakeholders at one place, and we have organized this program. So I invite all of you to become the member of AFAI, where you can do the networking, you can participate in the various advisory committees also, you can organize knowledge programs for the benefit of the entire ecosystem. Today's summit consists 4 sessions, which are all relevant sessions to the co-lending. The first session will start with the journey of banks and NBFC in the co-lending. Then the second session on the co-lending tech partners, whatever the technology challenges or technologies are available in the country. So all technology partners are here to discuss. And the third session, which is very, very important from the co-lending point of view, this is the balancing growth and the regulation and the compliances. This is another session. And the fourth session is on the LSPs, loan service providers. This will be followed by the awards also. So this is a full day program. I would like to invite all of you to make it more interactive and whatever the questions you have in your mind, because the objective of this program is to bring entire stakeholders at one place, and we have to discuss whatever the challenges are there, whatever the opportunities are there about the co-lending, and everybody can interact with everybody. As Resurgent India or as AFAI, when I was interacting with the banks and NBFCs, I could find a gap in the discussions that people are not talking to each other actually. So that way the objective, somebody doing very well, somebody could not do very well because of some reasons. So if they can meet together and discuss which are the good things, which are the good areas where we can improve ourselves, this will help. So this is the first of its kind conference on co-lending, full day conference. As AFAI, we commit that we will try to organize this kind of conference every year so that it can become a signature program for all of you. So I would like to thank you to all of you for joining with us, and our sponsors who have supported us in this program. I would like to thank you to them also, and thank you all. I hope that when you will go from here, you will be knowing more and more about the co-lending, and you will have a lot of friends also. Thank you very much. Thank you, friends. Thank you.
Thank you so much, sir, for a very warm welcome and quite intriguing insights. Now I would like to invite our next guest for the address, Mr. Shachindra Nath, Vice Chairman and MD, Ugro Capital. I am pleased to introduce Mr. Nath, Founder and Managing Director of Ugro Capital, where he had led the transformation of Chakhani Securities Limited into a prominent NBFCs with extensive experience across insurance, asset management, capital markets, and lending. Mr. Nath has established multiple successful ventures. He holds esteemed positions on the board of FIDC and as chair of key BFSI committees at PHDCCI and ASSOCHAM. A university rank holder and qualified lawyer from Banaras Hindu University, he is widely recognized for his strategic vision and impactful leadership. We welcome you, sir. Please put your hands together, everyone, and bring all your energy.
थैंक यू. गुड मॉर्निंग एवरीवन. ये जब भी मैं किसी भी फाइनेंशियल सर्विसेज और बैंकिंग समिट में आता हूँ ना, तो ऐसा लगता है कि लोग बहुत डल हैं, बोरिंग हैं. एक्चुअली नंबर्स के में प्ले करने वाले लोग ना कुछ लाइफ को जॉयफुल कम बनाते हैं. Co-lending for us at Ugro is a very close subject. Ugro, as some of you might know, is a young company. It was founded at mid of 2018. We suffered the crisis of IIFL, DHFL, the COVID. Still, we have built, in last 3 years, we have built a 10,000 crore of MSME financing business. 1,36,000 plus MSME customers we have serviced. We are able to do that purely because of the advent of co-lending which happened in India. I keep saying in India there are 2 types of businesses. One which are blessed with Goddess Lakshmi, other which are blessed with Goddess Saraswati. We have Saxena. Bankers generally as a class prefer Goddess Lakshmi than over Saraswati. So when it comes to giving money to NBFCs, predominantly it goes to, what I call the capitalist class. Because especially for the banks, they find Indian large promoter-owned, highly rated NBFCs are more credit worthy, and that's why the liabilities goes there. But if you look at the solving the problem of credit, whether it was, a second-hand vehicle finance, whether it was gold loan finance, it was agri, multiple other sector, it is younger, smaller, medium-sized NBFC which has done better job. Actually, some of you which might not know, the co-lending evolution in India is actually an outcome of a crisis. When in India the DHFL crisis happened, the regulator looked at the bank and NBFC interrelationship and felt that banks wholesale lending to NBFC at a scale can be really problematic, because sometimes when banks lend to NBFC and they literally have no control where the money is used for, while RBI also recognized that NBFCs are imperative for our credit market, especially for unserved, underserved markets, and that's why there has to be a solution around it, and that's why this marriage was created. Now, fortunately or unfortunately, whenever I think of co-lending, I think of either a Chettiar girl getting married to a Punjabi boy. Now, that example I've given many times. So today morning I was thinking of a new example. So the new example, all of you must have seen this movie called, DDLJ, Dilwale Dulhaniya Le Jayenge. Think of DDLJ, Raj and Simran. So Raj is the NBFC and Simran is the bank, right? And Amrish Puri, which is the father, is the regulator. Now, why I give this example, think of Raj, which is joyful, experiments, tries to do something, goes, do multiple things. And Simran is, embedded in tradition, follows, his father's footstep. And now, somehow both of them have come together to woo his father, which is Amrish Puri, which is the regulator. Because, the three institution, and fourth is the customer, symbolizes very different things. Raj symbolizes innovation, agility, which imbibe fintechs. Simran symbolizes trust, longevity, which is the bank. And the regulator will give its blessing only when it sees that there is transparency, and at the end of it, there is a benefit to the end customer. Co-lending is the DDLJ, and hopefully, at the end of it, it would be a happy marriage wherein we'll be able to, convince Simran's father that this is good for both of them. And I think so we are there, but there is multiple challenges. There is no doubt in my mind that future of lending in India, especially for priority sector, especially for sectors which are deserving credit sector, the power of the bank and innovation of NBFCs and fintech have to come together. I'm not saying banks don't have the skill set and power to innovate themselves, but sometimes banks' architecture, because there's very broad, wide, especially public sector banks have to also undertake many other mandates of the government, which sometimes may be not very productive and time consuming for chief executive and senior management of the banks. But in that, to reach to the last mile and the benefit of their capital structure and the innovation which NBFCs do can be only brought together and delivered to the customer when they come together. Now, it is very easy to say, that they have to come together, while regulators have provided a framework. But given that both these type of entities operate very differently, our first level of challenge, if you remember, RBI first circular on co-lending, which was called co-origination, came in 2019. UGRO was first part. I think we were the first NBFC in India, we were born in 2018. We signed 2 co-lending arrangement, one with ICICI and other with SBI. I think so within 2 months of the first circular itself. But it literally failed because the characteristic of that circular, it was co-origination, which means, we and bank were supposed to put our arms together and go to customer and do credit. It became quite challenging. It didn't happen. RBI brought another circular in 2020, and then we made conscious effort, and finally it started succeeding. There are 3 steps challenges. One, and all of that I must tell you is over a period of time. A lot of people actually say, we actually just recently, we presented to DFS. DFS set up a committee under the leadership, under chairmanship of State Bank of India. We have just submitted its report that how the co-lending can be taken to 10x level. DFS asked us that how co-lending in India can be taken 10x. Last CRISIL report says we are at 1 lakh crore. I think so we are at 1,50,000 crore right now. To take it to 10x is 15 lakh crore. So we have submitted our submission on that. But what we realized that the first step was understanding. Banks have a method. There is just this general belief. If you think of why NBFC exists, most of people say NBFC have better reach. It is untrue. No NBFC in India can match the reach of a bank. Banks are all pervasive. They are present almost everywhere. State Bank of India would have a branch more than what 20 NBFCs put together. So as Bank of Maharashtra, so as every other, so as look at ICICI. So first is the understanding. It is not about the reach. It is of NBFCs or fintech method of assessing the cash flow of a customer and defining and solving for a problem, versus banks do it very, very differently. So the first level of challenge was to bring these two together. Initially, I remember in 2020 when we went to SBI, SBI said these are our 10 credit policy, please take it and deliver credit on that basis. We said yes and we failed. Because if we were to do credit the way SBI does, then we will not exist. We exist only because we do it differently. It took us almost 2.5 years with respective banks for banks to accept, and banks have to be very calibrated because they are custodian of public trust. So they have to really step by step see that what we do is actually credible. But that was the first challenge. I would say we are at a 60% of that journey. Still different banks are at different level of maturity. Some banks, some of them are sitting over here, at higher degree of maturity wherein they adapt to NBFC's policy either in totality or at least 70-80%. Some banks are still like to do with NBFC the way they do it. Over a period of time, is my belief, banking industry per se would become far more innovative as the co-lending progress. We have seen actually in some of the large banks some of our innovative program, lending through GST, lending through cash flow, technology-led lending, banks adopting within their own system. That was the first level of challenge. It is not over, it is continuing, but it is improving. Second was the technology. Now that is continue to be a big trouble or a cumbersome process, but I would say we are at a halfway through journey. We are at 50%. Originally all banks, obviously banks can't expose their core banking system to an NBFC, and that's why banks said that we would, first they wanted to directly integrate, then there are multiple platforms which will emerge, and because the NBFC systems are more agile, they change very quickly. These intermediary platforms have to change very quickly, and when they integrate with the bank system, then it there is a lag effect. But we have been saying that there, in one of the recommendation for our co-lending committee was that there has to be an industry-led platform which is uniform. We are now talking of ULI. RBI governor has said there is a unified lending platform. We have been saying that there is an industry need to have a unified co-lending platform. So that's third challenge which were there. Now second challenge which was there, which we are way halfway through. So first one we are at a 70%, second one we are at a 50%. But third one, I was recently, consulting with RBI, and, a lot of people, especially journalist class, ask me this question time and again, is co-lending would, be there forever? And I keep saying that co-lending is a permanent feature. Now it would not go away from the industry. The simple reason for that there is a direct assignment market in India, which is roughly around 3,50,000 odd crore. Co-lending would eventually subsume the entire direct assignment market, because like this problem happened when some of the large NBFCs failed. When a bank buys asset from NBFC, it only look at 15-20% of the total pool, versus in co-lending, believe me, every loan file is assessed by the bank. So banks are far more safer in co-lending than direct assignment. So co-lending is permanent in India, but the last challenge, which regulator is also looking fairly seriously, which all industry should look at seriously, banks should look at, NBFC should look at, we have not been able to deliver the benefit of co-lending to the end customer. Co-lending actually became a tool of liquidity for NBFC rather than the end purpose of benefiting an undeserving customer. So if you look at multiple method of co-lending, whether it is gold loan, whether it is housing, whether it is MSME financing, some co-lending is also happening for non-priority sector. It is actually compared to a term loan given by a bank to an NBFC. All NBFCs would go to a bank, and this is contrary to our own interest, and say, I borrow from you at an X rate, please do co-lending on the same rate because I have the same OPEX, I have the same credit cost. But actually the purpose was a bank which has lower cost of capital, NBFC which has higher degree of innovation in credit underwriting. The end customer should benefit. That is not happening. In some cases it is happening little bit, but regulators are very concerned that this marriage which they created is a marriage without a child, you may say so. That the real fruit of the marriage is yet to fructify for the end customer. So if this to sustain and evolve, we have to all, and I hope that during this full day summit we will also deliberate that how the benefit of the banking infrastructure, innovation of NBFCs and fintech can eventually benefit the end customer. How an MSME customer can borrow at a lower rate, how he can borrow for all his but need, how NBFCs bring them closer to the banks. NBFC also are fairly fixated that we would do only the way we do it, but there is 2 step forward. There is multiple opportunities. You do secured loans, but we don't do OD, so banks can provide the OD. We don't open account, banks can provide the account. So the marriage for become really come together. It's about a boy and a girl now started living, but the family has to come together, and for families has to come together, we have to really think that how we will create a new family out of the co-lending. I sincerely hope and wish that during this day deliberation will come out with good result, and finally co-lending would not go to the 10x as the government of India wanted, and we will hit 15 lakh crore of total co-lending in next few years. But for every segment of the market, which is the underserved segment in India, co-lending would start benefiting the end customer. Thank you very much.
Thank you, sir, for your extremely insightful words. All of us couldn't have, get such a good summary about co-lending in just a few minutes. Now I would like to call a personality who needs no introduction, a very well-known professional in the finance sector. Currently, he is Executive Vice Chairman of Aadhar Housing Finance Limited. Mr. Shankar Tripathi ji, Executive Vice Chairman, Aadhar Housing Finance Limited. Sir, we welcome you.
Thank you so much. Dignitaries on the dais, Mr. Nidhu Saxena, MD&CEO, Bank of Maharashtra, Shachindra Nath ji, Ashish Agrawal, Jyoti Gadia, and very distinguished participants. Shachindra Nath has covered very comprehensively the why we should do co-lending, how we should do co-lending, and what we are going to get out of co-lending. After his talk, not much is left, but I will take 2 minutes to take you a different tangent. When in 1969, the banks were nationalized and second set was nationalized in 1981, the thought process at that point of time was that how to ensure that credit flow to the various productive sectors. That was the whole thought process, and at that point of time, government and Reserve Bank of India, I think my seniors must be knowing, but youngsters have to know about that. They have thought that there are priority sector and neglected sectors, and the credit has to flow to these sectors. Subsequently, both were merged. These were the agriculture, self-employed, SSI, small and scale industries, and small services. These were broadly the sector and retail trade. These were chosen by the then policy makers. With the passage of time, the agriculture remains the one sector, others were merged as the MSME sector. In 1975, the regional rural banks were also established. The whole thought was that the India adopted the multi-institutional approach to deliver the credit to the entire needy sectors of the country. That was the whole thought process. That's why they involved everybody. Many schemes were brought, and at that point of time, the point was only how to step up the food grain production, which India was taking in the PL 480 from the USA and all that, and we are now more than sufficient. How to have milk production, we are more than sufficient. And more important, how to provide the livelihood to the large number of crores of the people of the country. Subsequently, it continued till 1989 without the word known as financial inclusion. But actually it was financial inclusion. That's the whole thought process. In 1991-2, when the finance sector reforms were brought in, everything went to the back seat, and various new other priorities like NPA recognition, and so many things were brought by the Reserve Bank of India and the Government of India. And at that same point of time, the private sector came into being in 94, 95. And they showed the way. What is the consumption loan? What is the personal loan? What is the unsecured loan? Till that point of time, the PSU banks were having a taboo about even 5,000 rupees personal loan. They were not allowed because the credit squeeze was there, rationing of credit was there, money was not there. It was meant only for the productive sector. But we were unmindful that unless we provide consumption finance, how the industry will grow. The output of industry has to be financed. We were financing only industry. So these are well going on, and technology also started evolving a lot. 2001 to 2010, it was our technological era. And subsequently, the technology and the various other things have made a big stride in the country by digitalization, UPI, payment system, and so many things, India is tech, and all data are available during that period of time, and then moved from the traditional system to the modern system. Now, at that point of time, you have seen what was the financial landscape available. There were banks, private sector, public sector, foreign banks, there were there. There were close to around 9,400 NBFCs were there. There were small finance bank also came in 2016, payment bank also came. So huge sort of multi-institutional setup was available. And in between, in 2000, when for 9 years the reforms were going on, then government and RBI realized that financial inclusion has to evolve now, which has taken a back seat. And then Rangarajan Committee was established in 2005. A very structured method was given how the financial inclusion done. So my whole idea of telling right from 1969 till now we have been doing financial inclusion, but still we have not reached the level we should have reached. That is the whole thought of telling. So you have seen the financial landscape available. And along with the financial landscape, what was the strength? NBFCs, lot of tightening was made, lot of RBI brought regulation to control them. Shachindra mentioned about the failure of some big NBFCs and all that. At that point of time, the NBFCs were having the ability, agility, technological capabilities to assess the customer's credit and reach out to every segment of the country. They spread over across the country, and their learning to the local needs was much more pronounced than what banking system was there. Banking system was pervasive all across the country, but since bank has to deal with about 80-90 products, they were not able to focus on that. That's what the whole thought process was going on. And what we achieved by that point of time, we had 6 crore MSME. Out of 5.9 crore MSME are micro institutions, requiring hardly about 1 lakh, 2 lakh rupees, 10,000, 50,000 rupees alone. And today, even today, where we have reached, we have hardly about 3 crore MSMEs, they are able to get credit from the institutional segment. 3 crore MSMEs are still having no formal credit available for them. Though we have 25 lakhs and odd crore portfolio of MSME, still about the opportunity is massive because the large number of MSMEs are still struggling to get the formal credit. Coming to the retail segment, whether it was housing, affordable housing, and whatever it may be, the entire retail sector, though we have reached about 95 lakhs crore rupees today, 46% is 46% is something about that in housing. So then RBI envisioned that how we have to ensure that the credit flow to these sectors happen. NBFCs were short of fund. More than 9,000 NBFCs were less than 1,000 crore AUM. Banking sector was having huge resources available. So they thought that the transformative partnership between two will make a difference into that. And on dais, there are two dignitaries. Shachindra Nath is the pioneer in the MSME partnership, and Nidhu Saxena has done the first partnership in the country for the affordable housing. These are two dignitaries. That's why I think they have chosen very, very nicely. The co-lending partnership of 2018, which RBI brought in 2020, they modified it. A lot of modification came, a lot of problems also came. Any model you bring, it has some problems. It cannot be without problems. Today we have achieved 1 lakh crore plus the co-lending asset under management. But till now, nobody has assessed, neither the rating agencies, nor the Government of India, nor the Reserve Bank of India, the effectiveness of model, nor the industry. The banks sometimes feel shaky that if I have a partnership, whether the NBFC may go berserk in the loan and my account become NPA because 80% risk is with them only. RBI feels that the banking is more equipped with the risk-taking capacity and risk management. So the NBFC should have a asset-light model. So everybody is thinking from different directions. The time, what Shachindra mentioned, the Government of India has set up a committee. I think whole idea is to ensure that effectiveness of the model which is there and how we can take it much further, because I think the future is going, other than the corporate loan, future is going for all other loans as a partnership model where we can leverage the competency of one organization with other organization, and that will exactly make this model more effective. So I personally feel that whether in the 90% your working population in rural area is in informal segment, 65% urban population is in informal segment. So you have to cash flow based system till the formalization happens. Therefore, NBFCs are much more agile with the digital footprints and everything to assess cash flow and provide the credit to the banking system to keep in their books. But it requires a proper trust on both of them. They should have a policies which are acceptable to both of them and implementable. This is not happening. I am telling you, that's a problem. The models have not been able to deliver so much of things. And when I say trust has to be verifiable. Because in the lending space, you cannot have a blind trust. So I personally believe that the Reserve Bank of India is already looking into the matter. Government is looking into the matter. Industry should also deliberate. Today you have 4 panels, and you deliberate among yourself that how effectiveness can happen, how this marriage or this partnership can be really transformative to provide credit to the last mile of the customers. There is a huge unmet demand, 50% is still unmet demand in the smaller segment for the credit. And if that happens, probably that will be a big step in the real growth of Indian economy. So I wish to all the panelists today's conference for the full day to deliberate and give an effective recommendation and make this partnership and make this model more effective, which I think government is looking, RBI is looking, and we are going to be beneficiary of that. Thank you very much. Thank you, this Lending Association, for inviting me here. Thank you so much.
Thank you so much, sir, for sharing very intriguing information with us. Now it's time to release our souvenir and knowledge report, which is on unlocking growth, mapping the co-lending ecosystem. This report provides a comprehensive exploration of India's co-lending model, revealing how strategic partnerships between banks and NBFCs are reshaping the lending landscape. Beginning with the mapping of the co-lending ecosystem, it examines the complex operational dynamics and hurdles that can hinder seamless collaboration. Together, these insights offer a blueprint for sustainable and inclusive growth. Now we would request everyone to kindly reveal the knowledge report. Please bring your hands together. Thank you for being such a lovely audience today. The QR code of the report is also being circulated in the audiences. You can simply have a copy of, scan the code and have a copy of it. Thank you. Thank you each one of you for the revelation of this comprehensive and well-researched document. Now I would like to invite Mr. Jyoti Prakash Gadia, MD, Resurgent India Limited, for his address. As the founder and MD of Resurgent India Limited, Mr. Jyoti Prakash Gadia leads one of the country's top merchant banking and financial advisory firms, delivering impactful financial solutions to governments, financial institutions, SMEs, and Fortune 500 companies alike. A natural athlete with an unstoppable drive, he keeps his running shoes packed wherever he goes, ready to chase finish lines, dash to flights, or strides into those all-important meetings with the same energy and focus he brings to every challenge. We welcome you, sir.
Thank you, team. Good morning. Thank you. So nice to see that co-lending being a new event, being a new topic, and so much of investor interest and so much of interest coming into it. But why this co-lending? क्यों RBI के दिमाग में कीड़ा घुसा कि co-lending करना चाहिए, and why this co-lending happened that way? What was happening earlier was that, sir, suppose if the bank has given 100 rupees loan to a NBFC, and what the NBFC used to do, NBFC used to give suppose 1 rupee loan to 100 investors there, or 100 of the borrowers, and then he has to पूरा वो 100 लोगों का 1 रुपया का एक bundle बना के, he used to go and give that dump to the bank, and then bank used to keep that dump in between there. So nobody knows, sir, where the money is actually flown. The money cannot be traceable, and anything whatever was there can be many other issues that could have also happened. Just to see that there is a proper transparency into the system, there is a proper borrower interest that is being getting served, and right money is reaching to the right hands. So that was the purpose through which this co-lending model was developed, that we can have the goods of both the sides. Shachindra Nath ji told that DDLJ picture आई, and there was something which was there. I just wanted to tell Shachindra Nath ji, sir, उसके बाद में 2 states picture आई, where there was a boy from the south and the girl from the north, and the boy then spent some time with the girl family, and the girl started spending some time with the boy family together, sir. तो लड़के ने थोड़ा टाइम लड़की के परिवार के साथ में बिताया, और लड़की ने थोड़ा टाइम लड़के के परिवार के साथ में बिताया. So that was the merging of the culture. That was how the trust factor developed. That is how the Tripathi sir told. So can we develop some sort of a trust model by spending some time with each other? That I think so. Bank need to understand and inculcate some of the features of the NBFC there, thought process of the NBFC, and same way the NBFC also inculcate the thought process of the bank, how they think and behave that way. In case if that cultural alignment also has to happen before the co-lending actually has to come in between. I just wanted to, since 5th November was the day before 5 years that the Reserve Bank of India has come out with the co-lending guidelines. We wanted to celebrate a co-lending day on the 5th of November, but because of the festival, we couldn't celebrate that day. So today, We are just replicating that, that 5th November day which is there. So what has happened till now, as we all know that in this last 5 years till the time the co-lending has come in, 1 lakh crore of disbursement has happened through the co-lending model. It means lot of water has already flown behind the bridges, sir. Under the medium term, the growth momentum is projected to remain robust with an annual increase of 35 to 40% driven by growing interest from both NBFCs and banks. Commercial banks on an average has formed partnership with 7 NBFCs under the co-lending model. That's what we have done, is that there are so many commercial banks and how many partnership that they have formed. On an average, एक बैंक के साथ में 7 NBFCs के co-lending model अभी तक on an average हैं. In contrast, private banks has onboarded a comparatively into a smaller number of non-banking financial companies, including a significant potential for expansion in this area. Private banks, I think so, there is a lot of catching up that need to be do in terms of the co-lending initiative which is there. PSUs banks has on an average, they have been able to try because of technology thing which is little bit that is lagging them behind. What are the sectors through which this co-lending has actually happened? Personal loan 1 लाख करोड़ अभी तक जो डिसबर्स हुए हैं, उसमें को लेंडिंग कौन कौन से एसेट क्लासेस में कितना कितना हुआ है सर? पर्सनल लोन इज द टॉप ऑफ द चार्ट विच अकाउंट फॉर नियरली 35% ऑफ द को लेंडिंग एज ऑन डेट. Then home loan accounts for nearly about 20% of the co-lending percentage. Then unsecured MSME loans, gold loans, and LAP and the others. Unsecured MSME loans is constituting around 13% of the co-lending portfolio as on date. So I think so the personal loan where the Reserve Bank of India has come out very, very heavily in these last 6 months. So I think so the ratio is going to be changed in this next 2 months or so, where this co-lending percentage is going to be changed. Priority sector lending and the co-lending model which is there. Historically, private sector loans have shown higher NPA, especially on the PSB books. Bank level data also shows that factors like asset quality shape the share of the PSL in a bank's portfolio. Contrary to the belief in 2015, post-2015, lending to the priority sector by banks has actually improved their overall asset quality ratio, partly due to the enhanced NPA recognition as shown by the RBI data. So that is again a very, very good sign कि पहले जो PSL का जो data था, banks were forced to lend into the PSL. Now that PSL has become one of the top-notch asset classes for them, and that's what the business for them is. Now, navigating the complexities and hurdles for co-lending. What are the hurdles that we see? Because given that both sides सुनने में बहुत अच्छा लग रहा है, तो क्यों नहीं हो पा रहा? What is the problem? As Nath sir has already pointed out, that 3.5 lakh crores of portfolio sale is only happening. 3.5 lakh crore of portfolio sale only happening, so that can be easily shifted to co-lending model, because that's what the portfolio आप ले रहे हैं, उसके साथ में काम कर रहे हैं. 2 or 3 personal experiences, what I personally see, just wanted to bring to the MD sir's notice was that कि सर एक तो ब्रांच को या किसी को लगता है कि सर ये हमारा काम है, and co-lending model में the credit is not given to the branch manager, sir, because the co-lending agreement has been signed or whatever that way. So I don't think that because branch manager credit, branch manager KRA is definitely given on the loan that he has already originated himself. Into the co-lending model, what has happened, it is a centralized type part of that type of when people which is there. So lot of buy-in from the branches or lot of buy-in from the ground level people is actually not coming in from that perspective there. Secondly, what I feel is that कि banker need to think the co-lending model into a different perspective कि सर उनके यहाँ जैसे मैंने बोला कि 2 states के हिसाब से यदि हम काम करें कि सर कुछ लोगों को आप NBFC के हिसाब से सोचना स्टार्ट कराइए, or NBFC also has to think parallelly. So there has to be a separate team and the separate department that need to be created into the bank. We start thinking like an NBFC model there, because then only that merging of the minds that can happen that way. And the key reasons cite because of the what are the major reasons is that कि as Nath sir has pointed out, because यदि हमको banking के हिसाब से बैंक ने जो credit देने के जो नियम कानून बना रखे हैं, यदि if we start lending through that same नियम कानून or NBFC start lending through that same rules and regulations, then the purpose of the co-lending is defeated, because NBFC is trying to find out some sort of a newer methodology, newer asset class or terms of new customers. उसी customer को assess करने का एक नया तरीका उन्होंने इजाद किया. तो that innovation of that NBFC is getting curved by that, because banker want to say कि सर मैंने आपको बोला कि सर गाड़ी आपको इसी स्पीड से चलानी है और आपको यहाँ से नरीमन पॉइंट जाना है तो इसी रास्ते में जाना है सर. अब कोई नया यदि कोई अंडरपास बन गया है तो सर यू कैन नॉट ड्राइव बिकॉज मेरे बोर्ड ने अलाउ नहीं किया कि अंडरपास से जाना है, तो यू हैव टू ऑलवेज पास थ्रू दैट हाजी अली वाले जाम वाले रास्ते से ही आपको जाना पड़ेगा सर। तो अंडरपास से जाने के लिए सर आपकी बोर्ड पॉलिसी चेंज होनी होगी और बैंक हैज़ टू चेंज द थॉट प्रोसेस देयर। तो इन केस इफ द बिकॉज सो मच ऑफ डेटा हैज स्टार्टेड अवेलेबल, सो मच ऑफ अल्टरनेट डेटा, so much of other thing has started happening it, how can the bank start changing itself such a frequent methodology which is there? Borrower low credit score, sir, we need to understand, sir, low credit score, it has happened in the past, sir, in the mutual fund, and whenever we are displaying the past ki sir mera purana track record is not the indicator of my past my past performance is not the indicator of my future, sir, अच्छी चीज़ के लिए तो हम बोल रहे हैं, तो सर हम खराब भी तो अच्छे हो सकते हैं। When we are coming up कि सर मेरा अच्छा परफॉर्मेंस यदि पास्ट में रहा है तो यूज़र उसको ध्यान रखे, यूज़र ये नहीं समझे कि सर कि मैंने पास्ट में अच्छा परफॉर्मेंस दिया है तो सर मैं फ्यूचर में भी अच्छा परफॉर्मेंस दूंगा। दिस इज़ व्हाट दैट एस्ट्रिक डिनोट। तो सर एस्ट्रिक्स ऑल्सो डिनोट द सेम थिंग कि सर मैंने यदि पास्ट में ख़राब किया तो मेरे पास कोई नियम कानून नहीं है कि सर मैं अच्छा बन सकता हूँ सर। तो सर NBFC अंडरस्टैंड दिस फिलोसॉफी कि बिकॉज व्हाट वाज द ट्रैक रिकॉर्ड, व्हाट वाज द रीजन फॉर हिम दैट ही हैज़ डिफॉल्टेड इन द पास्ट, ही हैज़ सो मच ऑफ टाइम एंड पेशेंस टू अंडरस्टैंड दैट, एंड बैंकर मे नॉट हैव बिकॉज ऑफ सम अदर पॉसिबिलिटी ही मे नॉट हैव दैट अंडरस्टैंडिंग देयर। तो सिबिल स्कोर इज वन ऑफ द इंपॉर्टेंट डिसएग्रीमेंट पैरामीटर while devising the product between the bank and the NBFC there, because bank again because of the RBI guidelines and other things ki sir adi NP account ko if you are lending again, so it means it has to be treated like a NP into the bank's book, but NBFCs are going to fund that NP account. So how that RBI regulations and because how it can be treated like a new loan because 20% of that credit or 10% of that credit is coming from an NBFC, how can you treat him like a new borrower which is there sir? Lack of credit appraisal memo sir, हमारे पास सर जो क्रेडिट अप्रेजल मेमो है सर, हम लोग मेरे ख्याल से नेशनलाइज कब हुए थे सर 1970 के अंदर बैंक्स नेशनलाइज हुआ था सर, तब से मेरे को याद है सर हमने CA पास आउट किया, सबने किया सर, हमने एक CMA डेटा बनाया विकास बयान, we are all preparing that board note format which is there sir. I think so it is now a high time that we need to change how the working capital assessment, because co-lending is whatever the issue that the co-lending is coming up, the same problem what we see and we are going to face into the CCOD platform also, because 1 अप्रैल को आप 31 मार्च की बैलेंस शीट के ऊपर में आप उसको एक 100 करोड़ या 50 करोड़ की एक लिमिट दे देते हो, उसके बाद आप भगवान से प्रे करते हो कि सर एंटरप्रेन्योर बहुत ऑनेस्ट रहे पूरे साल भर और वो पैसे का सही यूटिलाइजेशन करें। So this is what the bankers pray to the God कि sir whatever the CCOD limit sir, CCOD limit is only being allowed only in my country sir. Into the other parts of the country sir, it is all invoice to invoice payment, it is all invoice to invoice thing, bill discounting, supplier bill discounting sir, each and every expenditure there is a separate set of banker which is there which identifies that separates a set of expenditure, profit and loss account and balance sheet, whatever the item by item मेरे को lender मिलता है। I don't get a common pool of money at one go and then it is up to the wisdom of the entrepreneur that how he goes and spend that money which is there. Over flexible underwriting process, NBFCs might have a little lenient process, they have a harder standing process, so how can we deal both the processes together sir? The evolving horizon, what next for the co-lending? I think so personal loan which is dominating the co-lending landscape, however with higher risk weightage, I think so that is going to come up, that is there. Government initiative to raise the MSME contribution which is presently around 18%, the government is thinking of increasing the MSME contribution to 25%. I think so that's where the NBFC like Ugro will have a very, very good time, where in terms of getting the MSME portfolio, that should be the priority of the bank, and as the liquidity tightens, NBFCs, I think they will be also forced to get into the co-lending model. Presently, this is what is the last I would like to point out, that only a third of NBFCs holding 90% of the sector AUM are directly involved in the CLM tie-ups. The model scalability in the near future will largely depend on maintaining the asset quality and also overseeing that out of the top 50 out of the top 100 NBFCs, we generally think कि सर हमको direct credit आसानी से मिल जाता है, तो how can we start, the bank can start forcing the AAA and also the AA rated NBFCs to come into the co-lending model. Till now sir, it is linked to those NBFCs which are generally not getting the credit. So those NBFCs जो कि BBB rated है या A rated NBFCs are, they are generally getting into the co-lending model because they are not getting the direct credit. how can we start thinking of the AAAs and AA's NBFCs getting into the co-lending model? How can we encourage them and how can we think over that? Thank you so much, sir. I think there will be enough for our panel discussion for this topic to deliberate, and I think so it is a evolving concept. Every year when we meet, we'll have something new to discuss and something new to cheer about. Thank you so much for this concept. Thank you, sir.
Now it's time to call our esteemed chief guest for the summit, Mr. Nidhu Saxena, MD and CEO, Bank of Maharashtra. Our chief guest for the summit is a personality that needs, again, no introduction. It's a privilege to introduce him as a distinguished banking leader with over 26 years of experience across diverse sectors, starting his journey at Bank of Baroda and later moving to UCO Bank. Shri Saxena rose through the ranks to become the Executive Director at Union Bank of India. Now, with Bank of Maharashtra, he has overseen critical areas such as treasury, domestic and international banking, human resources, stressed assets, MSME, wealth management and audit, demonstrating his versatility and depth in domain. In addition to his executive roles, Shri Saxena has served on the boards of Union Bank of India, UK Branch Limited, and Union Asset Management. His expertise has also guided the Academic Council of the National Institute of Bank Management and the governing body of Indian Institute of Bank Management. We would like you to give your address, sir. Thank you so much.
Well, thank you for the introduction. Thank you for giving me this opportunity to talk to this audience. Distinguished guests on the dais, my banker friends, their representation from few public sector banks. I am not able to figure out whether private counterparts are also in this conference. They're also there, and NBFC friends and the members from the media. Well, this is a little bit of challenging task for me to come in as the last speaker, and especially when the, so to say, stalwarts of the industry have taken the lead, and Mr. Nath, Mr. Tripathi, Mr. Gadia, they have actually covered the entire, I should say, issues that are around the co-lending. But yes, I'll still try to, maybe I will reflect on what they have already said, and try to come out with one or two issues and bring it before us to actually ponder upon and see that going forward how this co-lending business model will grow. Because I am personally convinced, absolutely no doubt on that, co-lending is the model which is here to stay. In times to come, yes, there have been teething troubles around it. And I think responses from the regulator, responses from the government have been phenomenal. I could correlate when Mr. Nath was telling that 2019 RBI came up with the co-origination business model. And he also elaborated on for what reasons this initiative came in from the regulator. Generally, banks would like to do some innovative thinking, find out some new lines of businesses and try to grow. Similarly, I am sure NBFCs would be doing the same. But I think here was the differentiator when the regulator is on their own suggesting a new business model for banks and the NBFCs to adopt. Need some water. I need some water. So this came in 2019 and introduced in 2019, and very quickly RBI did realize that this co-origination model is not working on the ground. Yes, the DHFL episode and the issues that were faced by the NBFCs at that point of time was a major concern for the regulator and the government, and that actually must have driven them to quickly come out with some quick fix solution, and they thought co-origination would be the model which will ease out the position in some way. They quickly realized that co-origination has some gaps and it is not working, and that's how we saw the birth of the model of co-lending. 5th November 2020, I could relate with when Mr. Nath was sharing the dates, because every year when wherever I mean the institution I was working with, and we used to try to pick up something new which is coming and can we lead in the industry, and we thought here is the circular and no other bank is there, can we try to do something? And very quickly we looked at the circular, and I remember 31st March 2021. So 5th November the RBI guidelines had been released, and we had to engage, first of all identify some NBFC, engage with them, understand the model, draft the master agreement, and then put some IT in place, because there was a strong realization that this doesn't work on a manual mode, it will not sustain, there will be issues around recon and other things, so we should quickly work out on some IT to support it, developed it in-house, and by 31st March 2021, we had 630 crores, I still remember the figure, onboarded. And it's okay, I mean, that is a history. We are far lagging behind. Many banks have gone ahead and they found value into this. Today, when we are seeing the numbers, this seems to be a minuscule number when the co-lending industry book is crossing 1 lakh crore plus. And definitely, as Mr. Nath, who's so to say an expert in this, has been tracking this, also is suggesting some figures that how it will in years to come we'll see the portfolio of co-lending growing leaps and bounds, and I'm sure it will. So a couple of issues, while I think before I raise those issues, whatever Mr. Nath said, I completely agree with him, because he is an authority, and I'm sure he's been driving this agenda with banks, various banks who are looking in a various their own perspectives, and he must have seen the challenges, and that's how he has formed the opinion. But while I completely agree with him, one issue I would like to disagree is the example of DDLJ and Simran, where he bucketed all the banks as Simrans. So there are some players who will be little different and think alike the way it ought to be. But his underlying point, I completely agree to it. I don't disagree to that. The underlying point he had raised is a very, very critical point, which is that here is the bank, here is the NBFC. Bank has some ways to go and lend in the market. NBFCs have some ways to go and lend in the market. Generally, they don't clash to each other. They are here to service a different segment in the market. NBFCs are there to service, they have their own niche, own geographies, own products, maybe a limited reach, but they have very robust systems of collections. Banks don't meet that. So the NBFCs have a different model, different customer segments, different way of assessing the loans, different ways of collections, and so on and so forth. So if co-lending means both of them have to come together, they have to forget, bank has to forget how do they do business. NBFCs also have to understand, because here the front ending has to be done by the NBFC. The critical task of sourcing new business is the NBFC. So if the co-lending has to actually come and deliver some results, banks have to actually understand that we can't have our own lending policies to work in the co-lending model. No, it will not happen. If you feel there is some element of risk the NBFCs take, which we are not used to, fine. So take what piece of business of the NBFC you are comfortable with. But if co-lending has to succeed, has to bring some results, has to deliver some outcomes, has to bring value for each of the partners, then you have to mend your ways. Maybe you and your branches keep doing the way you've been doing, but you have to understand how the NBFC sources, how the NBFC underwrites, what are the policies NBFC are having on ground to do businesses, and you have to adopt those if the co-lending has to succeed. Otherwise, you can tie up, you can do MOUs, you can do photo shoots, and you can have list of co-lending partnerships in your book, but I'm sure it will not add meaningfully to the balance sheet. So this is one point I would like to stress upon. Banks may have to think differently if the co-lending has to succeed. And number one. Number two, a large part of the NBFC and bank relationships, which is securitization, pool buyout transactions, on lending and all those, they are facing issues of reconciliations. When we do pool buyout transactions, in a pool of assets that are acquired, there are NPAs, there are bound to be NPAs. And the payment and collection, if the large part is manual mode or semi manual, it gives a lot of challenges, and reconciliation issues crop up, and ultimately banks also are not able to figure out, NBFCs are also not able to figure out, and it's a very unique way. I sometimes I'm surprised when banks, suppose they do 100 crore transaction, and there will be 5%, for example, NPA. I know it from the day one, 5 crores. So now the transactions have started, the payments have coming, and at some point of time it will be 10 crores outstanding and 5 crore NPA. But when the account comes for review, in the committees we look at 10 crores outstanding and 5 crore NPA. We don't know that, we don't realize that it is 100 crore and 5 crore. So and there are large part of unexplained issues where the audit issues come, where even the regulator says that you are not able to figure out and tell me for sure whether asset classification following of IRAC norms is happening or not happening. If the asset actually has been downgraded by the NBFC, whether simultaneously without lag of time in your books you have downgraded that account. So there have been a lot of advisories, banks have worked around this, and they've gone for individual account opening in their CBS, core banking solution, until unless they have that and they map and they are able to credit individually accounts in terms of debits for disbursements, credits for collections that are happening. Until unless that happens, the IRAC norms from the Reserve Bank don't get followed, and then the regulator concerns keep coming. So the point I want to make here is there is a little bit of complexity around this, and technology has to come in a big way to take care of this. If we want to scale up from 1 lakh crore to whatever numbers we are thinking and discussing, until unless we grow this book in a compliant manner, in a manner that it does not leave issues with the banks and the NBFCs and the regulator, we will not be able to sustain. So I think technology is a large role. There are challenges, concerns. Fintechs have been aggressively coming forward to offer that platform. And two for now, as much as I know, have actually progressed, brought in some solutions, but somehow PSBs have not been able to onboard because their platform is in a public cloud, and we are not comfortable to put critical transactions, customer data on a public cloud. We want on-prem kind of a private cloud solution and all that. So those are issues which still remain, and I'm sure we need to work around those and find quick solutions. Technology has to play a big role if co-lending has to succeed. And yes, no doubt the concerns from the regulator will continue to remain. Their concern is that the NBFCs are getting, there is a fund which is made available to them through these partnerships, and they are able to reach out to unserved, underserved, certain segments where we are not able to reach, certain geographies where they are more aggressive on, and the banks are not present. So that's how. But there is also a concern around the pricing part of it, which is going to be remaining from the regulator side, that ultimately the final beneficiary is getting the benefits out of this arrangement, where the banks have the low cost of funds, the NBFCs, at least in those segments and in those geographies they are working with, they have the reach. So put together the ultimate beneficiary, who is the borrower, small ticket size, is not only getting credit, but it is credit is available to him, her at a reasonable pricing. So we'll also have to be mindful of that part, because RBI is continuously going to try to ascertain that how it is benefiting the final beneficiary, yes or not. If not, then they will keep raising issues around that. So, but honestly, I think co-lending, I am personally convinced that this is the model here to stay. And if we find solutions around this, if bankers look at this with an open mind and realize that if they have to succeed in this model, they have to unlearn and forget certain things. Their branches can keep doing their normal activities, normal lending businesses as per their laid down policies. RBI has very, very clearly told that you can sit down, discuss with the NBFC and come with a common lending program, and go to your board, take the approval, and that common lending program, the discussions that are with the NBFCs in developing that common lending program must be with an open mind. If you are not comfortable, if the NBFC has 5-6 segments where they are actively lending, you can start off with 1 or 2, pick up 1 or 2, see how the experience going forward is, and then you can, as the portfolio grows, you can, partner with the other segments of the NBFC and ultimately take the complete, share in whatever businesses they are doing. I mean, that's all. I don't have anything much to add here, because whatever I will say will be, a repetition of what Mr. Nath, Mr. Tripathi has already expressed, Gadia ji has expressed, and I'll only end by co-lending piece. And I really compliment the AFAI and the Resurgent who have taken this initiative to have this first of its kind summit, and I congratulate them for this initiative. I am sure the deliberations during the day will add a lot of value, and times to come, this model is definitely going to stay, and we will be able to find solutions about a few of the concerns that are remaining, and going forward see that co-lending arrangement actually scales up in times to come. Thank you so much.
Thank you so much, sir, for your presence today. Now I would like to call Mr. Ashish Agarwal, Summit Chairman, for his vote of thanks.
Yeah, friends, I would like to, it's really indeed pleasure for me to propose a formal vote of thanks to all of you. I would like to thank you to Shachindra Nath ji for giving us the story of the Bollywood in a very simple manner. So I think all of us who are sitting here will not forget. Yeah, all of us who are sitting here will not forget what is co-lending. Actually, as a layman also will know that what is co-lending. So thank you, Shachindra Nath ji, for giving us information about the co-lending and how you have made it successful. And thank you for joining with us in this program. So I think he deserves big round of applause for his presence and dedication to the industry. We have, I would like to thank you to Tripathi sir. Tripathi sir, like my mentor and guide always, I take the advice from him. So Tripathi sir, first of all, thank you very much for giving your time. He has some board meeting or something, in spite of it, he could come here and he could commit because of his interest, the topic and the association with us. So thank you, sir. And the way he has given the insights about the co-lending from journey, not co-lending, even the banking journey from the starting and how it evolved actually. So the technology came in the picture, then the other regulation came in the, like the co-lending will also be successful, because initially when the technology came in, there were a lot of hesitation, but the same way this co-lending will also grow. So thank you very much, sir, for joining with us and giving us a lot of insights. Mr. Jyoti Gadia, who is the MD of Resurgent India, I think he is versatile actually. He can speak on any topic actually. So if you see the reports he has presented in such a manner, really it was insightful. Many things we could know that what are the challenges and opportunities also. And thank you very much for keeping time for this program and joining with us also. Then last but not the least, our chief guest, Nidhu sir. I think when I called him, he said, I'll come, keep my name in the list. And I'm really thankful to him that in spite of it, he has some meeting in RBI just now after that actually. And he's getting late also. He spent time with us, and he has given us the lot of ideas or lot of challenges which the banks are facing in the co-lending, like reconciliation, IRAC norms and all. Sir, we will discuss all these areas in this during the day, because this conference is only for co-lending. Actually, as I told, it's the first of its kind in the country, that co-lending, and this will become a signature event. After maybe 2-3 years, people will ask when this event is happening, we want to register actually. Not from India, from other part of the world. We will invite people also. So this is a vision of our in this. So this full day we are discussing only on co-lending and the concern areas which you have given to us. We have expert speakers, veteran from the industry who are practicing. They will discuss and we will find out the solution, and we will send you some white paper also what we have discussed and what is the outcome of it actually. So thank you very much again, sir, for coming and joining with us. And I would like to thank you to all the audience, all the people who have joined us in this program from the different part of the country, the NBFCs or the fintech players or the bankers and the other stakeholders also. And I can see the presence. Really thankful to all of you. And I will request to all of you be with us for the full day. We have a lot of things which we will discuss in co-lending. I can assure you, when you will be, we'll go from here, you will be having a lot of things in your kitty, that what is the co-lending and how you can make it successful. Thank you very much. Thank you all. Thanks a lot. And I would like to request to the organizer to give it the momentos to the speakers. So
it's time to felicitate our dignitaries on the stage. Thank you so much everyone for being with us today in our inaugural session. I would like to request Mr. Ashish Agarwal to felicitate Mr. Nidhu Saxena, MD and CEO, Bank of Maharashtra, with a token of utmost happiness from our side for your presence. Thank you, sir. Now I would like to request Mr. Jyoti Prakash Gadia, MD Resurgent India Limited, to felicitate Mr. Shachindra Nath, Vice Chairman and MD Ugro Capital. Thank you, sir. Now I would like to call Mr. Sanjeev Kumar Jha, Executive Director, Resurgent India Limited, to felicitate Mr. Shankar Tripathi, Executive Vice Chairman, Aadhar Housing Finance Limited. Thank you, sir. Thank you, everyone. Now it's time for a group photograph. Honestly, it's a sight to watch in front of the camera and at the back of the camera as well, because people from co-lending sector has joined us today for this one of its kind of co-lending summit. Thank you, everyone. With this, we have a meaningful ending to our inaugural session, and now we'll proceed toward the panel discussions. As we dive into the future of co-lending and explore new avenues for growth, we will be starting with a look at emerging trends and innovative solutions shaping the co-lending landscape. Today, you'll witness exclusive discussions on regulatory frameworks directly influencing the direction of the industry, and of course, this is a unique opportunity to connect and collaborate with leaders across banking, NBFCs, and fintechs, fostering meaningful alliances that will progress forward. I would like to inform each one of you that that towards the end of the day we have our co-lending awards, and after the co-lending awards we do have a surprise for all the delegates who are here with us today and who have taken their time from their busy schedules to take a decision to be with us. On our registration desk we have a fish bowl, and in that fish bowl each one of you is requested to kindly share your cards so that by the end of the day we can have a lucky draw, and the winners will be rewarded with extremely special gifts from our side. Our session 1 of today's summit represents the co-lending model, which was introduced by Reserve Bank of India in November 2020. It has enabled banks to collaborate with NBFCs in providing loans to priority sector borrowers. The Apex Bank designed the co-lending model to channel banks' low-cost funds to NBFCs working in underserved segments, including MSMEs, economically weaker sections, low-income and middle-income groups. This approach allows banks to extend their reach without any directly bearing the operational challenges of these markets. The need for such a model is clear according to the World Bank Global Findex report. While 78% of Indian adults have a financial account, only 13% have borrowed from formal institutions or used mobile money accounts. This gap highlights the untapped potential for credit access in India, and the CLM stands as a promising pathway to deepen financial inclusion and empower more individuals and business across the country. With keeping in mind all these aspects, it's time to begin with the sessions of the day. With keeping in mind all of these aspects, it is time to begin with the sessions of the day. Our first session is on expanding financial inclusion, the role of banks and NBFC partnerships. This session dives into how partnerships between banks and NBFCs can reshape the lending landscape to expand access to financial services across diverse regions. I would like to invite our speakers, beginning with our moderator, Mr. Ashish Agarwal, Director, Resurgent India and Summit Chairman, AFAI. Please bring your hands together, everyone. Our first speaker is Mr. Dinesh Kumar, DGM SIDBI. Our next speaker is Mr. Praveen Kini, GM, Central Bank of India. Our third speaker is CA Praveen T, CFO, Muthoot Microfin Limited. Our next speaker is Ms. Kirti, Timmanagoudar. Our next speaker is Mr. G. Ramesh Kumar, GM NABARD. Welcome, sir. Our next speaker is Mr. Chandar Mohan Kumra, General Manager, Bank of India. I would like to request all the delegates to kindly join the first panel discussion of the day.
Yeah, good morning, everybody. Thank you, Anupriya, for inviting all of us on this first session. After this inaugural session, this is expanding financial inclusion, the role of banks and NBFC partnerships. So since morning we are discussing on co-lending, and this is a very important session from the co-lending point of view, because the banks and NBFCs and they are partnering, how this can help in the financial inclusion and the priority sector lending. We will discuss, and we'll discuss the journey of the co-lending and what are the challenges and what are the areas which are to be improved, and whatever the experiences are there of the veteran from the industry. So friends, we have a very good panel where we have senior bankers with us from Bank of India and the Central Bank, and then we have DFI, SIDBI and NABARD, and then we have NBFCs, so microfinance company and the company which is into the multiple products in NBFC. So I think it's a very good combination of this topic where we can discuss in length and breadth about the topic, and we can understand more from the veteran of the industry, how they are practicing co-lending and how do they see the progress of this co-lending also. And I'm privileged to be the moderator of this session. I will try that whenever the session will finish, you will know many things about the co-lending journey of the banks and NBFCs. So friends, I'll now start the session, and I will now request to all the panel speakers to introduce themselves and their organization and their co-lending and whatever they are doing in the co-lending also. I think Naresh sir, you were there also in the session. Although it's a large panel, but we'll try to justify that discussion should be very relevant in the session. So Naresh Kumar sir is there. He is CEO of National Guarantee Company, which is taking care for the whatever the loans are there, unsecured loans are there, how they can be guaranteed from the guarantee scheme of the Government of India. So he'll speak about the various guarantee schemes also. So now I will request to all the panel speakers to introduce themselves and their organization, and what is the linkage or how you are practicing co-lending in your organization. So I think ladies first. So Kirti ji, I will request to you to take the lead, and then others will follow. Yeah, please.
Hi, good morning everyone. My name is Kirti. I'm representing IIFL Finance. We are firm believers in co-lending, and we have a book across home loan, MSME, gold loan and microfinance.
Hi, myself Pravin. I'm CFO for Muthoot Microfin Limited. So we are into microfinance. We are currently the second largest MFI in the country and operating around 20 states, around 3.4 million active clients. And we are coming from Muthoot Papachan Group. I represent the Muthoot Papachan Group. And as part of group, we have diversified portfolio into gold loan, affordable housing, microfinance, SME lending, plus two-wheeler finance, etc. So as a group, what we look at is the low income, lower middle income segment is what we are catering into, and that is where we believe in lending. And in terms of co-lending, we have multiple partnership at various products. So we have a couple of tie-ups in gold loan. We have 2 tie-ups in microfinance as well, and one interesting is that we have a tie-up in CLM 1 model also, where the ticket is very small. So there is challenges associated to it, but yeah, we'll cover that in the subsequent. Thank you.
Good morning to all. Myself Naresh Kumar, presently working with National Credit Guarantee Trustee Company under Ministry of Finance, Government of India as COO, Chief Operating Officer. NCGTC issues credit guarantees to various lenders and cover their partially risk. And till date, we have sanctioned credit guarantee to our lenders amounting rupees 8.3 lakh crore, and around 3.2 crore guarantees we have issued. Thank you.
Hi, good morning everybody. Myself Kumar, heading digital lending and retail banking in Bank of India. We have a good book under co-lending. Initially we were doing co-lending through different branches, but then we found there were issues, and ultimately now we have come up with an idea where we are doing this through centralized pool. So all these co-lending is happening at one place, and the digital platforms are there through which we are doing this co-lending, and we are hopeful that in the times to come, it will grow in a good way. Thank you.
Yeah, good morning everyone. I'm Dinesh Kumar, DGM, SIDBI. I'm handling co-lending division at SIDBI. SIDBI, as you all must be knowing, is a development financial institution engaged in the promotion, development and financing of MSME sector in the country. We are doing co-lending mainly in the MSME segment only because as we have mandate to do only MSMEs to serve the MSMEs, and we started co-lending 1.5 years ago, and we are getting the good traction under this business, and in all segments which the loan products catering to the MSME sector. So we are doing co-lending on all these segments. Thank you.
Good morning. After Dilwale Dulhaniya, 2 states, just now we found Bul Balaya also happened. jokes apart. Myself, Pravin Kini, I am General Manager, Central Bank of India. First of all, I would like to thank the organization AFAI and the Resurgent India to organize such a first kind of co-lending gathering over here. In fact, just like to also mention that in 2024, March 24, the co-lending portfolio which we were discussing, I would like to correct some facts for the panelists over here. That in the industry of the co-lending, it was 1 lakh crores. And out of that 1 lakh crore, for a kind information, 70% was actually between NBFC to NBFC. And only 30% was between NBFC to banks. And I'm proud to say that Central Bank was the leader and still is the leader in the industry, where we were contributing to more than 35% of the portfolio between the NBFC and Central Bank of India. Also, I would like to share that right now, most of the major NBFCs have already partnered. In fact, one of my eminent panelists was there right now, where he started with his journey, and he also narrated when the ICICI and State Bank failed. I would also like to add further to that, because Central Bank was the first one to adopt this model, and we were happy in shaping most of the NBFCs where this they could benefit from that. So naturally, we are our MD sir, that is MV Rao, he was instrumental in bringing this as a business model, and hence we are having very cordial relation with most of the NBFCs. Our partnership is now going more than 30, and definitely in the coming days also we will be looking for more good NBFCs to partner with us. Thank you.
Thank you, sir.
Sir, I am Ramesh Kumar, General Manager, NABARD, National Bank. As you are aware, NABARD is the apex bank for agri and rural development in the country. So we are also having a book, combined NBFC outstanding of more than 20,000 crores. We have our subsidiaries, 3 subsidiaries are engaged in financing NBFCs. Apart from that, we are also an important player in agri and agri MSME, rural MSME. So almost 40,000 to 50,000 crores is disbursed for various banks as refinance. So we are actively looking at this co-lending portfolio. And as per the DFS, we were asked to promote co-lending under AVCF, Agri Value Chain Financing, apart from the present what is happening here. So we have organized a workshop on that, co-lending under AVCF with all public sector banks and other banks also. So we'll be taking up this and doing in future. So I look forward to participate with all August gathering here and distinguished panel speakers, get engaged, understand and take this co-lending forward. Thank you.
Thank you, everybody. It's a good insights about yourself and your organization and what are you doing in the co-lending. So now we'll take up some questions from the panel. And you know that all panel speakers are experts. They are doing co-lending or they are aspiring for co-lending also. So, Kini sir, you are, you told that 30,000 crore is from banks and the rest is, and in the banks co-lending size, I think Central Bank is the leader that is known to the market also. So, I'll start from you this first question. So, everybody would like to understand how you made it successful actually. Because there is some secret formula which is, I think, helping you to grow fast in the co-lending space. So whenever we are talking to other banks also, they would like to understand, listen that how the central bank is doing actually. So if you can give some insights, whatever you can discuss here, that will be helpful to everybody.
See, as I just concluded in my speech, that Central Bank of India has adopted co-lending as a business model. So when we say that it is a business model, then you should understand that we have taken due care for all the things which are basically required to adapt to that model. So here, when all the other panelists were also discussing, naturally, as rightly said, the underwriting standards of both the banks and the NBFCs will definitely are different. But at the same time, you have to come to some common area where both the mutual interests are being taken care, and under that certain standards what the NBFCs are adopting will have to be accepted by the bank, and at the same time bank also advises them where it will be more mutually benefiting them to adopt those models where it can be easily be successful. Naturally, NBFC has many such products, but it is not necessary that all those products will be successful in the banks. But at least we can do some selective products, and naturally that gets clicked. And hence that has been working for us, and also NBFC has been adopting all those practices what the banks have been also advising.
Thank you very much that you have rightly told that it's not necessary to adopt all the product of NBFC. The products which are agreeable between banks and NBFC should be taken up first. Thank you, sir. Kirti ji, because in the NBFC space, while sitting here, you are the largest, I think, partnerships with the various banks. So we like to understand how you made it successful also. At India Infoline, you are into multi-products, housing, gold loan, MSME and other areas also. And I was seeing your investor presentation, I think you have, 20,000 crore of co-lending size in the overall co-lending space. I hope it will be the largest in the industry, a single NBFC group actually. So we'd like to understand from you how you made it successful. And the followed question is that many of the NBFCs are not participating still in the co-lending space. So what are the challenges and possible solutions which you think so that the others should also participate?
Sure, sir. First, I'll speak about my own company. So as you mentioned, IIFL Finance is a large listed retail-focused NBFC. In March, we had about 75,000 crores of AUM. Out of that, 15,000 crores was in co-lending. Mainly thanks to partners such as Central Bank. They're a large partner for us. And in the earlier session, some of the panelists also mentioned private sector banks are shying away from it. But fortunately, that's not the case for us, sir. We work with at least 6 private sector banks in co-lending, with full tech integration. Now, why we love co-lending is, I'll just give a brief history. IIFL Finance as an NBFC is actually just a big startup. It was started by Nirmal and Venkat 18 years ago, the lending platform I'm talking about. So we are not corporate backed. For us, the stated growth strategy is grow asset light, just like a startup, right? So you don't want too much on your balance sheet. So when in November 20, the guidelines came for the new avatar of co-lending, it was a huge thing for us. Just 2 months later, in Jan 2021, we set up a dedicated cell for co-lending. The only thing I've done in the last 4 years is co-lending, sir. So, so you can see how important it was for us. The other aspect is, the other thing you're asking is why some of them are not, some of the other NBFCs have not taken to it. I can only speculate. I can think of 3 reasons. One, some of the larger NBFCs are corporate backed. So their cost of capital is almost as low as that of a small bank. So perhaps they don't need it. The second one could be some of them are deposit taking, so they have alternative and cheaper sources of capital. On the other spectrum, if you look at some of the smaller NBFCs, probably they're too small. Just like how in a term loan, you're looking at certain credit rating, certain size of AUM. I remember when, every NBFC has to go through the same proposal process for co-lending, right? So most of the banks have some sort of optimal size, maybe 1,000 crores AUM, 5,000 crore AUM, or a BB rating. So maybe some of these NBFCs are still young and they are probably not qualifying yet, and hence they would rather work with a larger NBFC than go straight away to a central bank. That could be the second reason. The third one, I'm just speculating, because every time we have done a tie-up, banks do take a lot of time in both physical and in data checks in terms of due diligence. So the NBFC has to be ready to open their books. They should be ready for these several due diligence that happens. Maybe they're not comfortable or they're not ready yet. So I could think these could be the reasons. So once they are fixed, I think there'll be more players.
Thank you so much. I think one great reason which you have told that it's an asset light for NBFC. So in every business, if you see, people are talking asset light actually. So this for NBFC, this is the model where you can be asset light actually. Thank you so much. Dinesh ji, because you have already told that SIDBI has started and it's a successful model now for you. But whatever the study has come, that as per some SBI report also, some economist of the SBI has published some report. According to the study, on an average, 24% of the CLM proposal, co-lending model proposals, sourced by NBFCs and HFCs and MFI are rejected by the partner banks. So what needs to be done to reduce the rejection rate of NBFC? This might be one of the reasons that many of the NBFCs are not willing to go for co-lending partnerships. But we can find out some solution that what are their solutions for that, so the rejection should be less. If you can highlight on that, that will be helpful.
So, Ashish ji, I feel that rejection part or acceptance part start at the time of partnership itself. It's not that you have pushed the cases today and in this month you have pushed 100 cases or 200 cases and bank has rejected 25% or 30% cases. Maybe that study may be slightly older, because in initial times the rejection was on the higher side because of the so many confusion, the policy alignment, tech part and all these things. But gradually things have evolved. The banks and NBFCs have understood the issues. They have aligned. There is lot many upgradation on enhancement on the part of the tech platforms and all these things. So I feel presently the rejection letter will rejection percentage will not be so much of higher. But reason may be, I'll just give an example why cases are being rejected. Suppose NBFC is pushing the cases. The LAP case, you take the typical example of loan against property. So what you will do now, at the time of sanctioning the limit itself, you will have to understand their product, their processes, their policies, and you will have to document all these things. So that there is no confusion, there is no dispute at the time of accepting and disbursing those cases. At SIDBI, what we have done, we have taken your policy, we have studied not only your policies, all your processes. How you will be originating the cases, what will the KYC process, how will you doing the underwriting, what are the risk management process you are following, what are other checks and balances, how the title investigation, valuation part you are taking care of, what will be the format of title report, what will the format of valuation report, what inputs you are taking from those reports, and what is your KM format. So at the time of making the partnership itself, we are studying all these things, all the formats, even the KM report we are studying, what kind of KM you are preparing, and we are reaching at a conclusion at the time of partnership while pushing the cases will accept this parameter from these your policies. Everything we have documented. You must be having the 100, 20, 25 BREs in your product. We have picked up 5 to 10 BREs. We'll see only this BRE and we'll trust you. All these things have been taken care by you. So when you are pushing the cases to SIDBI, I'm just seeing that my proposal is meeting those parameters, and for rest of the things, I'm trusting my partner. The partner has taken care of. Other things, the rejection letter may be because you have done your proper thing, everything you have taken care, all the documents you are having, but while pushing the cases, all the data have not reached to the bank. There may be some technological issue or some understanding issues that all the papers or documents are not reaching to the bank. So that may be the another reason. But I feel the first reason is if you have not aligned your processes, then the rejection letter will be higher.
The bank will study your valuation report, your title report, and will see your report, your advocate written so and so things, your value writing so many things, it is not as per our policy, so this case not fitting in my parameter, then this case will be rejected. One thing banks have to understand that there is a different segment the NBFC is dealing with. The cases which are not fitting in the credit policies of the bank, that's why those cases are going to the NBFC. I am sourcing independently the cases at the rate of 10%, 9%, or 11%, when the customer is going to NBFC, they're either charging 16, 18 or 20% rate of interest. So why customer is paying 18% rate to the NBFC? Because there may be some things which are not fitting in the bank's parameter. Their CIBIL is not good, there may be some issues in the property. So that risk is being taken by the NBFC, and there are different risk mitigants for those risks. So we have to trust the NBFC, and banks have to align with the processes of that NBFC partner, then only this model will be successful. Otherwise, it will be very difficult. The rejection will be very, very high on the higher side, and you will not be able to build up the good portfolio under this model. So my request and my suggestion is that at the time of partnership itself, all these things you will have to foresee and document everything. You prepare the SOP. In our sanction letter, we have the 10 pages SOP. Each and every step we have written, what will be your role and what will be my role. So then the dispute will not arise, and it will be a successful partnership. Thank you.
Dinesh, I think you are very well covered. Why the rejection can be less. When the partnership is starting itself, then we can jot down the all SOPs and the policies of the NBFCs and lender banks. Then definitely there can be less rejection. So thank you so much. Kumar sir, you told that Bank of India is also now leading in the co-lending space. So if you see, there are different risk perceptions in the mind of the people between partners. These are the related to the pricing risk and the NPH. So when we are talking to the banks, and we have got the feedback also from the some NBFC, they are having this discussion with the banks, that always the banks are more concerned about the NPH and all basically. So what do you think, the NPH in co-lending are more or less, or what is the study which you have, maybe of your experience or whatever practicing you are doing?
Hello. We know since last 5 years, this is a small period where this co-lending has started, and during this last 5 years, lot of experience have gained by the co-lenders also, by the NBFCs also, and by the banks also. As far as this NPAs are concerned or the other things are concerned, the only thing what I want to say that, as Mr. Dinesh was also telling, that initially when we start the process, at that point we have to understand that how that means, what are the areas where, because each and every NBFC, they have their own areas of operations, they have their own strengths and weaknesses. So we have to understand their strengths, their areas of operations. Maybe they are good in MSMEs, or they may be good in retail, they may be the other thing. Then we also have to see how they own the business or they underwrite the business. It can be, means they are doing there by their own team, or it can be outsourced. It can be outsourced. So we have to understand their all areas, that how they do their business. Once you understand, and naturally, ultimately, as far as NPAs are concerned, right now, if we see the NPAs, because they have developed their teams, they know how to recover the things, the downline at the ground level, they have their teams. So ultimately, if we see at our level, the NPAs, whatever we have seen during last 5 years, it is a very, very good experience. The NPAs are too less as the NPAs what we see in our books in MSMEs or retail or other sectors. Naturally, that part is better, what we see in our book, despite what we say that the underwriting, because they are going towards the downtrodden sector or the underprivileged sectors, but then also that part is happening properly. So the only thing as far as that rate of interest is concerned, that is one of the area that means we have to further look into it, because ultimately the scope or by which the RBI came into this picture was to see that the underprivileged or under the sectors, they should get a proper rate of interest, means it should be passed on to them. Once the NBFCs are getting the rate, what means the banks are providing, it should be passed on to the other sectors. And for this, RBI is regularly nudging us also, and that part has to be seen, I think, in the times to come. Thank you.
Great. Very well said, I think, sir. You have given the message to the industry that NPAs are less in comparison to the normal lending and the NBFC lending under co-lending partnerships. So this is a great boost up to all the key players in the industry to partner with the banks have to partner with NBFC and NBFC has to partner with the banks. I think you have raised one good question or good, I think, interaction point, the rate of interest, which is again because RBI circular clearly says that there should be some benefit to the borrower when they are, the banks and NBFC are doing co-lending partnerships. So is there any rate cap whenever the partnership is there? Or this is a individual cap by the bank or there is any cap by the governor or the regulator? So I think Pravin sir, because you are practicing this co-lending in a big number, and I think anybody can contribute in that on the rate cap for the ultimate borrower. Is any ultimate borrower is getting any advantage under co-lending model? Or any bank or banks are putting some kind of restriction to the NBFCs, because very recently also we have seen this RBI has banned 4 NBFCs because of the higher rate they were charging in other regions also. So this is a very important point to discuss under co-lending, whether it's a win-win model for the all stakeholder, all players, or somebody is sacrificing because of that. So Kini sir, you can highlight and then the others can. Yeah.
Thank you, sir. I think it's a very sensitive question. And especially coming from the MFI, I think you all have been reading the news. There is a lot of news coming in the sector and the expectation of the RBI to bring down the rate and pass on the lower cost of fund benefit to the customers, etc. So I'll be honest. As of now, we have been engaging with the RBI at multiple levels, the SRO level as well as at the company level, but there has not been a specific ceiling that has been assigned by RBI as of now. But always there is an expectation that ultimately when we talk about the CLM model, there should be a benefit of lower cost of fund or a pricing benefit should be there for the customer. But the problem here comes is that how does it different being as a CFO is that for me it's a borrowing, it's a financing arrangement. I'm doing term loan borrowing, I'm doing structured deals like DAPTC, I'm doing co-lending. So for me the real question comes is that how does it differentiate between a normal financing arrangement in the CLM? So that is the whole point, but at the same time when we envisage this, the expectation is to bring down the cost of funds. So it's a double-edged issue that we are facing as a sector. But the solution lies within the two entities that is getting partnered. One is that the bank also need to understand this is not a normal lending to the balance sheet, where you take a certain risk on the balance sheet, but you are taking a risk on individual customers. But that may be construed as a higher risk proportionate. But the point here is that we are trying to address a section of the society which is not underserved or lack of, or for the financial inclusion matter. So I think when the banks also consider this as a partnership, they need to consider the rate sensitive matter and accordingly give that benefit to the NBFCs. And secondly, from the NBFC also, like even though I mentioned it is purely a financing arrangement, you need to look at it slightly differently. You need to look at it as a partnership model. You need to look at it as a long-term strategy model, where you always have 2-3 partners with you who is willing to lend you at any point of time. And then when you arrive at that two objective, I think then you have a solution. Of course, we can definitely pass on the benefit. And secondly, also, I think now when we talk about as an industry, we talk about more than 1 lakh crore in co-lending model, and a lot of that co-lending model goes in CLM2 model, which doesn't have any rate benefit which is getting passed on. It is actually akin to a DA transaction which is already happening. And when we are talking about the
the industry, the co-lending industry will move from, replace the DA, which I believe it will do eventually over a period of time. But if you are doing CLM2 model, that's not really passing on any benefit to the customer. So ultimately, I think as a sector, as an industry practitioner on the NBFC side and the bank side, we need to promote more in the co-lending one model, and we need to work together, identify areas where we can bring down the cost down, bring down the financing cost, and pass on that benefit to the customer. So even now, I think when we discuss with the banks also, we see that the banks are talking about a maximum ceiling within, not from the RBI, within the bank side there is a maximum ceiling to the end-use borrowers, etc. But I think unless you hear that properly, and from the NBFC side also, because actually we are running in the field, incurring a lot of OPEX in terms of managing the business and things like that. So I think it has to be fixed considering both the parties. But ultimately there is no doubt that the model, if it has to grow, what we discussed earlier in the section, from like 1 lakh to maybe 15 lakh crore, the pass on benefit has to happen. But as of now, to my understanding, there is no ceiling, but we need to showcase the RBI to bring that confidence in the product.
So I feel that interest passing on the interest rate benefit now, it lies on your efficiency on the accepting the cases. Why I'm saying this, NBFC is sourcing the business as per their policy. Not necessary all the cases will be covered under the co-lending. Suppose you have the LAP product, or you have unsecured business loan product where you are sourcing the, you have the highest rate up to 24%, I can say 28%, 26%, whatsoever it is. In our policy, if I talk about SIDBI's perspective, we have kept the interest rate. In the unsecured business loan, we have kept that we will not allow beyond 21% rate of interest under the unsecured loan. In the secured loan, we have kept the rate at 18%. And if the loan amount is more than 2 crore, again it is kept at 15%. So one part that we have kept here. Another thing, the expectation is once you have entered the co-lending partnership, cases originated after the partnership only should be covered under the co-lending. Suppose if I am entering the co-lending arrangement today, the co-lending circular, it is mentioned that is akin to direct assignment. So it is not that you are entering into partnership arrangement today and 6 months old or 1 year old cases you are covering under the co-lending arrangement, then the benefit is not will be passed on to the customer. So expectation is you have entered into an arrangement. Now you source the business according to that arrangement, keeping in the mind that these cases will be covered under the co-lending arrangement at so and so rate of interest. Then only actual benefit will pass on to the customer. Now issue comes at the rejection part. What will happen if suppose your rate, standalone basis, you are charging rate at the 18%. In the co-lending, if you cover those cases under co-lending, then you may accept rate at 16% or 15% because I am giving you the concessional 80% I am taking in my books and my rate will be supposed to 9% or 10% whatsoever. So if I reject that case, then there is issue with you. You have the apprehension in the mind, suppose if this case is not taken by the bank, then what will happen to those cases? So on this part you will have to work on. Rejection should be minimized. There should not be rejection, I feel. Because if you have agreed the parameter, if you have aligned everything, these cases will be accepted by me. Though it is a discretionary model, it is mentioned in the RBI circular, it is a discretionary model, bank can reject those cases. But sitting together, you have to reach at the conclusion, if your cases are meeting this parameter, definitely I will take in my books. So you have the assurance, if I am sourcing these cases on so and so rate, then these cases will be taken by the bank. Then I feel the benefit to the interest rate will be passed on to the end customer. Thank you.
Ramesh sir, in award, known for agri lending or supporting the agri refinancing also. And you are, as you told also that you are the new entrant in the co-lending space. So what excites the award to come into that? Because if you see most of the NBFCs are into MSME lending or housing and other areas, agri lending is still less. So what is the thought process behind that? And you see there are guarantee schemes also. So under your NABARD co-lending program, are you considering these guarantee schemes which are there? Because agree, I think most of the lending is under unsecured lending actually. So if you can highlight on that, and Naresh sir, you can cover up on that on the guarantee schemes, how they can help in co-lending also. Yeah, please. Yeah.
Thank you, sir. First of all, I just like to take a half a minute that there was a working group constituted by DFS on agri value chain financing, and the working group gave a number of recommendations. One of them is the co-lending under AVCF, agri value chain financing. So accordingly, last before year, we have organized a workshop on co-lending with banks. That is aimed at only public sector banks initially, all the 12 public sector banks. And if you see, almost 600 crores under AVCF, agri value chain, is there under co-lending space already. For few banks, they have done already, public sector banks under almost 600, but it needs to be grown. The important issues, what we understand and when we interacted with all the, is that one is the underwriting norms, they should be different for agri value chain financing. The documentation part also, there should be agreed documentation, but in tune with the, and also the officers who are dealing with also to be in such a way, both sides, that they also should be aware of the agri financing space. And particularly, as you know, we have promoted almost all, along with Government of India, 10,000 FPOs, farmer producer organizations or farmer producer companies, and we are actively working in the cooperative space also. So these 10,000 FPOs, almost 3,000 FPOs we have directly funded to the tune of about 1,000 crores or so. So this space, again, FPOs, as you said, guarantee part is not directly available to the co-lending partners, but if you are co-lending to a FPO or smaller FPOs, the FPO is eligible to get the credit guarantee. That is available with our subsidiary NAP Samrakshan, promoted by NABARD. So that FPO can avail some part, irrespective of the source where it is getting. Even co-lending also can be tried. So we are discussing and finalizing various policies on co-lending also. These are the important things that are hindering, as you said, underwriting norm. These we will be addressing in future, and we are in discussion with banks, and we will be starting some of the pilots in the AVCF, agri value chain financing space, and promote that, and rural agri lending, and also particularly the rural MSME part, agri MSME part, we are focusing along with the microfinance space, where NABARD is actually the precursor for microfinance space. Thank you.
Thank you, sir. Thank you very much. So Naresh sir, can you highlight on the guarantee schemes which your organization is running? And something has announced 2 days before in the media also and the budget also, that up to 100 crore of plant and machinery for MSME, there will be guarantee scheme also. So if you can give some insights of that also.
So scheme guideline we have not received, sir. So it may take some time. But with regard to NCGTC, we work very closely with various departments of Government of India, Ministry of Finance, and various ministries. And presently we are having mandate of 11 credit guarantee schemes, trust. And cumulatively we have sanctioned credit guarantee of approximately 8.3 lakh crore, and beneficiaries are around 3.3 crores. Some of the schemes, that guarantee scheme for the Stand Up India, Startup India, education loans, factories, corporate debts, micro units. So these are the schemes we are working very closely with our member lenders, and member lenders are various banks, PSU bank, private banks, NBFCs, MFIs, so cooperative bank, RRBs, so like that.
Sir, for giving the insights about your organization and how it can help in the co-lending also. So, friends, we have many other questions also, but keeping in mind the time, I think constraint, because we have another session also, I'll not take much of the time, and we'll take some questions also from the audience. So please keep your questions ready. There is a last question with the panel, which I would like that if everybody can contribute, which is also important, because unless until any partnership, if it is not a win-win for all the stakeholders, then it is not a true partnership. So this customer experience and the customer satisfaction, how does the customer experience in the co-lending compare with that of direct lending? And what can be done to enhance it? Are customer grievances increasing under co-lending? So these are 2-3 areas which need to be discussed here, because ultimately the customer is happy, then everything is okay. So anybody can contribute on that, Kini sir, or maybe Kirti madam also, because both of you are leading in the co-lending space in the country.
Hello. See, basically, if you observe, when you say customer satisfaction, naturally, when he will go to NBFC, he will only be going if he feels that his loan is not going to be going through the normal banking, because the underwriting method of the banks are, very stringent, or naturally, or if those products are not falling and he is not able to get that loan. So naturally, when he goes to NBFC, so there a lot of their variations are there, and most of those, they fit into those NBFCs. So naturally, if you feel that way, the customer satisfaction will always be there when he goes to NBFC. Whereas in the CLM model, what happens is that already he is tied up with those NBFC, so naturally he will not understand at that point of time that the 80% of his loan may be also be taken by some nationalized bank or some private bank. So here that you can say, unless and until if there are any closure issues, pre-closure issues, during that point of time the customers are having issues, and if you see, the complaints also usually go up when these cases do come up. Otherwise, the customer will be always happy once his loan is being sanctioned by any either the bank or the NBFC. But here, most of these cases what we are discussing in the co-lending model, of course, those are not been fitting into the normal banking, but naturally it will be fitting into the NBFC, so they will be on the satisfaction level will be on the higher side.
Thank you, sir. So two things. One on the customer. If you look at our customers, if any of us on the stage or any of us in the room want to take a housing loan, you will not come to you'll not come to me, right? We will go to a central bank or an SBI or an HDFC. However, Sharda, who's my maid sitting at home, she wants to buy a house. She wants 15 lakhs. Most likely, it's too small a size for most banks to give. So she will come to me. And let's say we have a tie-up already and we want to bring her under co-lending. So honestly, when I download an app, the conditions that you need to accept run into pages. I'm educated, masters and all that, but I don't read it. So while we declare everything just to be legally safe, I really doubt if Sharda is reading whether it is under a co-lending partnership with Central Bank or 100% with IIFL. For her, I'm the face. Right? If she has a problem, if there is a delay in repayment, I'm one stop point for her. So for a customer, the originator remains as the Spock, right? Any grievances. Of course, within 30 days we don't resolve, they can always go to the co-lending partner or eventually to RBI. So that's one point. So we don't see any difference in the customer behavior or their satisfaction per se. But yes, it's a win-win partnership. If I look at my co-lending portfolio, the yields on that compared to the portfolio that's 100% on my book, my co-lending portfolio is definitely at a lower yield. So we are passing it on. But it may not be significant, it is lower. And the other one you're asking was about the whole bank and the NBFC partnership itself. I think today there's a lot of movie reference that is being spoken about, and me being a woman, I'll speak about something else. So this is, you know, a co-lending partnership is not like a senior-junior kind of a thing. Earlier in marriages, a lot of people say that wife happy is life happy. So that's not really true. I think I'm also married. If the husband is not happy, the marriage is not going to be happy. So the both wife and husband both have to be happy in a partnership. That's when this will actually take off.
So co-lending, I think all three partners would be happy actually. So anybody would like to contribute in that? Kumar sir, you want to contribute in this customer experience as per Bank of India? Any experience which you have? Any kind of grievance which are coming to you? And
no, I totally agree with the participants what they have told. Ultimately, that customer experience, it should, because ultimately NBFCs, they are the front face for the customers. So they should live the front face, and we should be, because ultimately from the operational, from the onboarding till the last stage, the NBFCs are the front face to them. So why we should enter into that area? So particularly in this part, I am convinced the NBFC should, and customer experiences means they should take care of means whatever the part is there, because sometimes what we see, particularly that the complaints come in that CIC also, because maybe that delayed payments or somewhere, or maybe that recon issues. Due to that, what happens in the NBFC's book, it may be showing means standard asset. In our books, it may be SMA or sometimes. And then what happens? The reporting. Sometimes if the reporting is happening through NBFCs, it's okay. But sometimes we also enter into that picture. And due to that, what happens? That discomfort starts, and then complaints and all. So naturally, we'll have to take care of these all things. And that customer satisfaction, ultimately, it is the utmost and the important thing that we have to take care of it.
okay, thank you, sir. Thank you so much. So now the floor is open for questions. I'll request, please ask question which is relevant to the topic actually, and keep it crisp also. So, sir.
Hello. Good afternoon. This is Suresh from Central Bank of India. I've got a question to GM NABARD. When is the NAB Samrakshan Guarantee Scheme for co-lending likely to be implemented? And similar is a question to Mr. COO from NCGTC, whether any scheme for coverage of the credit guarantee is going to be made available to co-lending portfolio.
Sir, as I clarified you, the co-lending credit guarantee is required at two stages, at customer level, and also credit guarantee are for the bank who is financing. So credit guarantee in case of FPOs is rightly now available. The FPO, the credit guarantee scheme through NAM Samrakshan doesn't see where from the FPO is getting financed. So it is not, so if it is a farmer producer organization or FPC, so in turn FPC is funding the farmers, or the farmers of the FPOs are get benefited out of that. A normal farmers, and that no credit guarantee at present is not available. As I told you, there is a workshop happened, and we have posed this to Government of India and also to DFS Government of India, that there can be a credit guarantee scheme across for co-lending that will help the co-lending to grow a greater heights. Particularly, you can start with the agri and some space, agri space or rural space. Then it can be expanded to other areas. That is what we made a recommend. But FPOs, the credit guarantee from NAB Samrakshan is available. Okay.
Not available at present for the to the bank, which engages in a co-lending with an NBFC engaged in FPO financing. Okay. The credit guarantee scheme called the NAB Samrakshan package is not available.
No, the FPO, have you applied for the NAB Samrakshan? I'll discuss.
Yeah, you can discuss. I think that's a great. Naresh sir, would you like to say something?
So with regard to NCGTC, presently we are not having any mandate from Government of India. जैसे ही आएगा, I will look into that, sir. Thank you.
Thank you.
My name is Sandesh Nath. SBI is a duplicate branch of UP state. We don't know about that. And second question is, this year is a problem happened, we just note down. Last year this problem happened, we just note down, but we can't implement on that.
Understand, sir. Can you repeat your question, sir? What you want to say?
SBI, State Bank of India, is a duplicate branch is open in UP state, but we don't know about that duplicate branch is open. Okay.
Duplicate branch of SBI.
fake branch open किया है.
Oh, SBI में there was some, I think, fraud basically, but I think this is not the relevant question for us actually, because this SBI can give the answer. Nobody is from here and from SBI. Any questions, sir? Sir, please.
Whereas the process delay happens because of the various partners involved. Like for example, you have a direct lending and you have along with the partnership. So my money, this one is there. What is the value addition with the co-partner or the NBFCs is adding in such a way that the repeated or the kind of the assessment cannot happen at the bank level. That is one. And how do we ensure that the benchmark kind of a timeline for disbursement is being improved or better through this particular association? That is not being measured. Anything not measured just is only a question of hype kind of a creation. What is the value addition which is being done? Can we measure that and put it on record? Thank you.
Co-lending. Okay.
Gentlemen, please, can you give a reference? I didn't get it.
So especially when we approach the NBFCs, for example, one of my clients which is there, we approach it through the direct as well as through the, what they call the multiple banking, right? So direct approach most of the time results into a kind of, a faster kind of, result oriented. Because you go through the channels, right? If you approach through the different channels, or I'm not trying to degrade, but it is my own experience, but it might be different for somebody else's experience. What is predominantly important is that do you benchmark? What is the, as per the banking norm, do you benchmark the timeline to disburse? What is more critical is when I have a kind of a hungry, I need the money. When bank want to disperse, my client may not be interested in this, right? So the timeliness of the borrower when he needs the money, how far the co-lending kind of helps the borrower. That is not being measured, not being reported.
First of all, basically this is more related to the NBFC question, but still I will take it. See, what I could observe from your observation was that, see, the basic concept of co-lending you first understand. The bank, I'm specifically talking about CLM2 model, which is predominantly working now, is that bank comes into the picture much later. And the hypothetical thing is that the loan which is extended by the NBFC to the borrower may land into the co-lending bank, or it may not also. It may be there in the books of the NBFC only. So the question about co-lending doesn't arise it here. If you say that the borrower is not getting the finance at the first stage itself. See, if we see NBFCs have certain stipulations, and if he fulfills all those things, I think so they are the most eager ones to dole out the finance to them. I don't understand if at all, if it doesn't fit into those categories, then that may be the question. It may be some isolated cases. Otherwise, what we observe was that NBFCs are really very fast in taking the decisions. So here, the co-lending question doesn't arise at all.
Sir, if I may add, see, when an NBFC, at least I can speak from our company's perspective, we cater to the customer irrespective of whether I have a co-lending partnership or not. It doesn't really matter. And for me, turnaround time or customer satisfaction is the most important thing. Especially I can say, let's say in a smaller gold loan. If you look at any gold loan companies, the turnaround time is less than 30 minutes. So customer doesn't really have a time beyond that to wait, because he knows, he's used to that quick turnaround time. So the way we work is, we in fact do CLM1 in some of our gold loan with API integration. we wait exactly 30 seconds for the bank to respond whether they want to take this customer under co-lending or not. If we do not get a response, maybe because of technical failure, because it's an API after all, right? Or maybe, you know, that customer is an NPA in their book, or any other reason banks don't take it. I'm very happy with this customer. That's why I'm even come to this stage, right? I've valued the jewelry, I've taken the KYC, I've done everything. I'm happy with the customer's credit, so I will underwrite and take 100% onto my book. Because for me, customer is the most important thing. Whether it comes under co-lending is secondary.
Thank you. Thank you so much. Last question, I think somebody has taken the mic. So this can be the last question, I think.
Yeah. So when the agreement is been done through the NBFC and the bank, so how is the rewards and the risk been split between these two parties when the agreement is been done? When the NPA has been created or the interest has been split, how it has been arrived?
Very good question.
See, first of all, as we partnering with any NBFCs, first you should understand that if it is a win-win situation for both of them, then only the partnership will happen. So while assessing the rewards and risks, see, rewards in the sense what happens is that for NBFC, if we starting with 100 crores of this and 80-20 partnership, he can easily go up to 500 crores because 80% of his books are being taken over by the banks. So naturally, and second, for banks also, if those are falling under priority sector, naturally for banks also to get that size of the books in priority sector, also it's like, meeting out their targets. So that is always there. As far as the risks are concerned, of course, risk will be there when you are in finance, when you are in lending. But at the same time, we always take care how to mitigate those. So whatever the BRs which we spell it out, and once we do that, even the partners also, they understand that if this our loans has to now go into central bank or any other bank, and whatever the products that has BRE has been specified, naturally those loans should be fitting into that. If at all, if it is not fitting into that, naturally the rejection rate goes up. So that is one of the cases when we always tell, and I think so this is my suggestions to all the NBSOs sitting over here. See, to reduce the TAT, it is very much essential. You can just understand when we go say 25%, that means out of 4, 1 resources is going waste. Because ultimately we are putting our efforts into all that, and when it has been pushed back, naturally from your side also, the persons who are handling the co-lending cell over there in your NBFCs also, they are also wasting their time. And naturally the persons who are in the field, they should be also educated at the same point of time that if we want to do the co-lending under this product, so this has to be trained well to all those persons so that they will definitely take care of that, and then only those loans will be sanctioned which will be fitting into the co-lending partners.
And reward actually. So risk is sharing between both the partner in equally, whatever the ratio of the funds which they are giving actually. So in case of NPA, definitely if 80-20 arrangement, then 80% will be the major partner, 20% will be the junior partner actually. And rewards also, the rate of interest between both the partner depend on their arrangement based on the costing and the other aspects actually. So it is very well defined in the system actually. So friends, now I think we have already crossed the time limit. So I would like to close the session here, and I would like to thank you to all the panel speakers for giving the insights of the co-lending from their practicing area. And I hope that all of you must have got some kind of insights also which are relevant or which will be helpful to your co-lending journey. And if you have any other question also, all the dignitaries will be available after the session in the hall. So you can have one-to-one questions also from them. And I would like to thank you once again to all of you for your deliberation. Thank you so much. Thank you.
in Strategic Alliances, IIFL Finance Limited. Mr. Chandar Mohan Kumra, GM Bank of India. Mr. Naresh Kumar, Chief Operating Officer, NCGTC. Ladies and gentlemen, this was our first session of our very first co-lending summit by the Association of Financial Advisors of India. And now it's time for the group photograph. I would request you to please bring your hands together. Thank you. Such a moment, it's very rare that such a panel sits and there's an interaction happens. Well, this was our panelists for the first session, and now we'll begin with our second session. Our next session is on co-lending and the role of tech platforms. This session explores the crucial role technology plays in co-lending, from enhancing credit access to managing risk. We invite our speakers to share how innovations like AI, machine learning, and blockchain are shaping this field. For this session, I would like to invite our panel of speakers, beginning with the moderator, Mr. Shashank Sharma, Director, ScoreMe Solutions Private Limited. Please bring your hands together, everyone. In 2017, alongside Mr. Jyoti Prakash Gadia, he co-founded ScoreMe Solutions Private Limited, aiming to develop paperless credit delivery and monitoring solutions. His leadership has been pivotal in establishing ScoreMe Solutions Private Limited as a trusted partner for over 200 institutions, including banks, NBFCs, and fintechs. Please join me in welcoming him to the stage. Our very first speaker is Mr. Rajat Gulati, CEO and co-founder, Plutus One Technology Private Limited. Plutus One, headed by Mr. Gulati, is a leading payments infrastructure firm providing digital bill payment solutions to banks. An IIM Ahmedabad alumnus and computer science engineer, Mr. Gulati is a third-time entrepreneur with previous ventures in F&B and IoT. He has also led product development in EdTech and served as Group CEO of a consulting firm, advising startups in robotics, EdTechs, and PropTechs. We welcome you, sir. Our next speaker is Mr. Sharad Agarwal, CEO and TO, Ugro Capital. Mr. Sharad Agarwal, a veteran with over 26 years in BFSI, renowned for establishing fintech startups and leading digital transformation, he is a recipient of the NBFC Leadership Award and brings deep industry insights as a former Gartner Research Forum member and Capstone Certified Professional. Please bring your hands together for him. Thank you. Next up is Ms. Bhavna Sharma, Principal Consultant, Lentra. Ms. Sharma is a distinguished thought leader with over 12 years of experience in the BFSI sector, spanning consulting, banking, and leading product firms, both in India and internationally. With credentials in computer science engineering, an MBA in finance, and an LLB, she expertly drives transformative digital lending solutions that align technology with business objectives. We welcome you, ma'am. Next, Next is Mr. Sudeep Kirk, VP Nuclear Software Exports Limited. He is a seasoned IT executive and lending expert with over 31 years of global experience in software product development and consulting for top banks and NBFCs. Over his 3-decade tenure with Nucleus, he pioneered one of the first indigenous global products in the lending domain, leading implementations across Asia, Europe, and the Middle East. Next, Mr. Rahul Jain, ED and co-founder, All Cloud Enterprises Solutions Private Limited. With over 12 years of expertise in scaling enterprise businesses and alumnus of the Australian Graduate School of Entrepreneurship, he leads business, finance, and marketing, driving All Cloud's mission to transform lending with secure, scalable technology. We welcome you, sir. Coming up next, Mr. Arun Sood, co-head UB's Financial Services Group. Mr. Sood oversees revenue growth and manages the P&L for UB's primary platforms, including UB CoLend and UB Invest. In addition to leading cross-platform initiatives, with over a decade of expertise in financial services, he brings a strong background in structured finance and high-impact lending partnerships, having previously held pivotal roles at Vivruti Capital and Northern Arc Capital. We welcome you, sir. Our last speaker for this panel is Mr. Uttam R., CEO, Saisam Omni India Private Limited. Mr. Uttam holds an experience of more than 18 years in technology and financial services across the UK and India. A specialist in product management and strategy, he has led the development of innovative products such as loan applications and data analytics platform. Mr. Uttam holds a master's from the London School of Economics and Political Science. We welcome you, sir. I would now like to hand over the mic to our moderator to proceed with the session, Mr. Shashank.
Hello. Thank you, Anupriya. Please. Thanks. Very good afternoon to everyone, and thank you for being patient during the transition. I would, on behalf of AFAI, I would like to congratulate the entire team for setting up this August presence here. And I think what better panel could we have to talk about the role of platforms when we have, veterans from the industry in terms of who have conceptualized platforms around different use cases. And since morning, we've been hearing a lot about, data getting exchanged, partnerships becoming the way forward, and co-lending taking the deepest shape in the country, which we have so far. But what I truly believe is that, such, I would say, ecosystem cannot function without an efficient technology platform in between. And with India getting more digitized, and we hearing about digital lending solutions on a daily basis, I think co-lending is one subject which definitely needs the, I would say, serious attention of both the stakeholders from NBFC as well as the bank side, to look at a scenario that how this technology role play can take a better shape. And I think to discuss on the current objective is where we have the panel. Since we have a mix of NBFC and the platforms, I would like to start from the NBFC side. So Sharad, just a quick one to you, that, how do you think that the role of the platforms in the NBFCs is evolving, and overall on the co-lending aspect, sharing your experience being one of the leading NBFCs working in the co-lending side, how is your experience so far, and how do you think that, the industry is going to evolve around this? Thanks.
Hi, my name is Sharad. Okay, I would say, without technology, co-lending cannot work. Okay, and you grow the story. Okay, we have a 50% of our book is co-lending book. Okay, and I would say a few good things which we did ourselves. Okay, and what can be done further, right? The one of thing is that, we have our in-house capability of our, rule engines, right? So so any loan comes to our system, it automatically tells us which partner it will get qualified. Okay, it's the beauty of system. On day one, whatever we do business, we know that where we can send this case. Okay, which I would say our platform providers can improve upon. Okay. Second piece is that we have a dedicated business solutions group. Okay. sitting on day in, day out in bank premises, NBFC premises, and ensures that all clarifications are sorted out, and bank officials, yeah, they have a lot of business also to do, and they have a lot of queries because we come from NBFC background, right? So a lot of questions comes on, different kind of products, their policies, all that. The team is dedicated and sitting in the premises and ensure that it's sorted out, okay? And of course, we have a lot of, bouquet of products. So we have all kind of MSME product, whether you call it EV, solar, machinery, secured, unsecured, right? Okay, and there's a dedicated strategy which we have developed ourselves, okay, and accordingly our partners, so which bank does which product, right? Which NBFC does which product, right? It's our dedicated strategy, distribution strategy around that, and ensure that is month on month delivered. Okay, this is a target-oriented approach, okay, and of course that our platform helps, right? It's a fully API integrated, platforms, okay, and our internal processes are fully digital process, okay, complete onboarding process, and we understand even banks' platform through our fintech partners. So we know from our experience that what kind of KYC loan will get qualified, what kind of legal report for secure loan will get qualified, okay. So there's a learning which we impart to our ground team and ensure that those cases are only flow into our system which will get qualified, and whatever business we have to do in our books, we keep it. Okay, so these are the learnings which we are implementing, and of course, a lot of things I do see that industry is evolving till disbursal process, right? But a lot of things need to improve upon post-disbursal process through these fintech partners, right? Okay, the repayments, reconciliation, right? Compliances, RBI is coming very heavily on compliances, KYC norms, okay, etc., etc. So I think, and of course, there's a unified digital interface, I would say, required. Okay. But why I'm saying there are partners, right? There are in between partners available, and if there is any rejection happening, partners should be able to tell us this case will get qualify where, right? They know from our experience, right? We have tied up with multiple banks and partners, but that case stops there. So that's something which we developed ourselves. Okay. So there's a partner's opportunity, they can do that. Okay. And of course, in our experience, direct integration really helps. We have done a lot of direct integration with banks, which speed up the process.
So I think that's a very minute way of handling the entire core challenges which today lie between the NBFCs and the bank on that front. And congratulations to you on the successful implementation of the platforms there. And we'll come back in the second round to discuss more upon how adoption we can deeply inculcate. Moving on to you, Uttam, I think so probably now we'll move towards how platforms are taking the shape, and how do you think that there is a more deeper role which these platforms can play in between, because we've heard from Sharad that he has pinpointedly taken up each and every use case and very minutely implemented it internally at Ugro to come to this stage of an end-to-end automation. So how do you think that at an overall industry level we can have a more deeper role of platforms getting played there?
Sure, thanks for the question. A bit of a storyteller, so try and
go
cut
ahead.
me
No
off.
issues.
Yeah. So actually way back in 2015 was when I actually built the first co-lending platform when I was at Capital Float. We used to work with a bunch of different NBFCs for co-lending. This obviously has evolved way ahead now. What we did at Credit Saison, the NBFC arm, was we did about 20-25 different partnerships. In those partnerships, every month we kept facing a reconciliation issue. And the governance in a Japanese entity is tremendously high, right? And keeping that in mind, we built this tool to ensure that accuracy to the rupee, we are reconciling with every single entity that we work with. And this is all NBFC to NBFC or a fintech to NBFC co-lending, right? Tried and tested, this model worked beautifully on a 6,000 crore book. What we did was then it came to birth the tech entity of the Saison Group. We sold the platform off to the tech entity. Now we offer this entire platform to different NBFCs and banks. So today in the morning, somebody was talking about reconciliations being an issue, right? I don't know if this is still an issue today, maybe to clients it is an issue, but as a platform we've solved it. And our clients today on our platform are quite happy with it. Now that's one technology advancement of the platform that needs to happen, right? Because each one has their own logics in terms of IPC logic, or how they treat different scenarios, or how they treat different payments and structures, etc. So it's all configurable, and that's how we sort of manage this. Being conservative, I erred on the conservative side. None of our deployments today sit on public cloud. Everything is RE to RE. Everything is on an RE's instance. And that's important in terms of how this co-lending platform also should evolve, because customer information, which is public, PII information, right, shouldn't be public. And especially with a very strong regulator like RBI, you have to err on the side of conservation, right? And today all our deployments that way are between, private clouds or, in-house service that, entities put together. Being disciplined in terms of compliance, being disciplined in terms of accuracy of data, being disciplined in terms of process, in terms of efficiencies that we need to achieve, insights in terms of the data that needs to come through for an NBFC and bank is super essential. So to ensure that, right, you need to have a customer success team. For me, and for any platform out there, you have to become a partner with both the bank and an NBFC. It's just not a bank-NBFC partnership. As a technology, you have to become a partner. The day you think you've implemented a solution and that's it, I don't think it works efficiently, right? Because this model, the products are evolving, customers are evolving, the process is evolving. You cannot just be a solution provider, deploy and move away. You have to ensure the success of both entities. So that's how I see technology evolving in this space. Waiting to see how more guidelines come on this, but interesting times. I love the challenges.
Thank you. I think so very minutely when you mentioned that on-premise is something which you have taken very seriously internally, and your key facts on giving compliances the utmost importance, that has really helped you there. So we'll definitely catch up that how these can become a better adoption sources. Well, you do mention about the regulator and the data privacy as well. So I'll move to the other side of the panel. So Bhavna, over to you. And I think I'll just like to hear your thoughts upon what do you think that the regulatory changes which are there in the ecosystem today can elevate the role of these tech platforms and can enable these NBFCs and banks to come closer to each other and integrate at a faster pace.
Thanks for the question. So I would like to start by stating that though there are detailed guidelines on co-lending by RBI, but I do see there's still a lot of room for the interpretation, right? Because apart from the guidelines, there are references to the PSL guidelines, DLG guidelines, or TLE guidelines, and then there are co-lending guidelines. So one system has to be mature enough to be compliant to all of these, right? Not just the co-lending guidelines. And when and coming to the co-lending guidelines, RBI says there should be a synchronization of the data between both the co-lenders. So there is a need of real-time data exchange in order to be compliant with the obviously as my counterpart spoke about the data privacy, that the data at rest and data at transit should be encrypted. So all of those things should be taken care of, and there are a lot of opportunities that I see for the platform providers that what they already are doing for the sole lending and bring up to the platforms of the co-lending as well. Now, if I talk about the reporting, there is no such guideline that, the reporting should be done by both. Again, it's on the discretion of the partnership agreements between both the co-lenders, whether, the NBFC wants to do the reporting or both want to do the reporting. So now here, there are some refinements that I can foresee, in the guidelines by the RBI, because if both are doing the reporting, then this will end up the borrowing getting reported twice, or the borrowing will having two loans, right? So these sort of refinement would be there along with reporting. Then I'm coming to the next side of the things is the accounting, right? Now, which is the most painful area for most of the NBFCs, not the banks, because again for CLM1 and CLM2 model, it will be different, right? So CLM1, if I talk about 20-80%, okay, I have to do accounting of my 20%, they will do for 80%. What about CLM2, where I'm funding 100% now, and I'm not sure when my 80% portfolio is going to be sell down. So I have to be ready for my off-balance sheet accounting as well. So all the platforms, there is a lot of room to scale up, right? These are the challenges that we see that a lot of the NBFCs and the banks are facing in terms of reconciliation. Obviously, the platforms are intelligent enough to configure the IPC or IRAC norms, but again, it will different from the partner to partner. The bank would say that I do IPC. The NBFC would say that I do ICP. Now, once in previous sessions, one of the the speakers said that at one side the books are clear, at the other side the borrower is reported as NPA or SMA. So these challenges will be there unless you have a real-time data, exchange happening. So for that, there should be a middleware where both NBFC and the partners are talking. The transactions, not just the the origination part or the sending of the document or sharing the onboarding for things or the data pointers. There should be real-time exchange of data on the servicing side as well. That's what I see, and that is only possible when the platforms are taking or catering to the end-to-end, the entire ecosystem, and not just the onboarding part or the servicing part. So yeah, I do see a lot of refinement coming forward from RBI, be it data privacy, be it reporting, be it how the accounting should happen, be how you should clean up the books. And yes, obviously I'm not blaming that people do NBFC side, people do go for unfair practices just to show that the balance sheets are clean. It's maybe because they have to do some arrangements, right? Because now I have provision for 20%, but I'm not finding buyer for my entire portfolio. How would I I have to do some adjustments, and then there is scrutiny. So obviously all these things taking in account the RBI policies, the guidelines and everything should be there in your technology systems that are supporting the co-lending. And we do support one of the largest PSU. I would not name, but I would leave it up to you to figure out from the logos behind. So we are already, doing co-lending, supporting co-lending portfolio of one of the largest PSU. And I think, eventually the policies are maturing, the practices are maturing, and I'm sure the regulations are also, they will be mature.
Thanks for your views. I think you did mention about how different partner approvals are to be handled on the platform, and how accounting is to be taken care of that. I think we'll come back to Sharad on that part in the later part of the session. And I think just to break the scrutiny here, so Rajat, I'll move to you. Since Sharad mentioned that a key role which today implementation has helped them to take is the implementation of the business rule engines module, and how different partners evaluate the end customers onto different credit policies. Well, any thoughts on how can transaction-based small credit ratings can be utilized in terms of assessing customers for the onboarding in co-lending, and if you can just share your views on that. Yeah.
Thanks, Shashank. That's actually an interesting question, and our approach to it. So again, I'll borrow a page out of Uttam's book maybe and tell you a little bit of story. We didn't come at it from a lending point of view. When we set up Plutus One, the founder team has about 14 years experience working with the banks here. So we've always been looking at it from a what's the bank's pain point, and whether it sits under lending, whether it sits under some other domain, Plutus One was designed to try and solve it. So what we are is we're a payments infrastructure solutions provider to the bank. So currently we work as a Bharat Connect TSP for a couple of banks. We run the switches that operate their bill payments for them. But we also provide the solutions then to their corporate accounts, so MFIs, etc. We are essentially the interface between the MFI and the customer. So a couple of interesting things happen here, right? That gives you access to a lot of granular data. So a lot of loan repayments, for example, are happening through the Bharat Connect platform. right? So when we talk about when we move from the origination, the issuance to the actual collections piece, you realize that the most seamless, painless way of doing that is to make a consumer-friendly platform that they can use on a daily basis to be able to make those payments as well. And the more integrated it is into the final beneficiary's life, their flow through the day, the easier it is and the higher the rate of redemption, the lower the NPS. But what it also did was it gave us the idea, and this is and almost everything that we do is built atop the rails that NPCI builds. So there are regulator, there are partners. What we realized was that if you're going to, the main thesis behind co-lending was to be able to take credit to where credit was not being delivered previously, right? That's the basic thesis. But with that comes the realization that if you're going to go after a new TG, you're going to issue new credit, you have to have different new data points to be able to incorporate new rules, right? And new sources of that data. And look, let's be honest, when we go apply for a home loan, right, for a large ticket loan, we dress up our financials a little bit. Everybody does it, right? It needs to be presented the right way. And that's a once in a lifetime sort of transaction where you're taking an effort to make the presentation the right way. And I would say that it's not necessarily the most accurate picture of the applicant's financial state. The most sort of accurate, okay, let's put it this way. The more accurate you want to go after the more frequent transactions, right? The more compulsory transactions. And those transactions, to us, the most frequent, compulsory, and low-ticket transactions that actually give us granular data were bill payments, right? We're all making bill payments. You could be anybody, you're still making bill payments. You're paying rent for the house, you're paying for your phone, you're paying for your landlines, whatever it is that you're paying for. So because we are operating the bill payment switch and the bill payments interfaces for consumers, on behalf of the banks, that gives us access to a lot more data. And using that data as inputs into a lending decision just makes that decision way more robust, right? We're still building out some of the rules there, right? But having access to data is a definite plus, and I would think everybody would agree that the more data you have, the better decision that you can arrive at. But obviously, that's an incremental effort. You get to the data, you make the rules, you actually test it out to see if there is a correlation there, and then you build out the lending on top of it. And we're currently at that stage with some of our partners.
Well, interesting to see that, the small data points, even at the transaction-based bill payment systems, getting utilized as a form of underwriting assessment models. I think that can certainly might be used at the low ticket size lending sizes there. Thanks, Rajat, for that. I'll move on to you, Arjun. And I think, so we've talked about middleware implementations, we've talked about BREs, we've talked about bill payment based data getting utilized here. Now, one interesting fact is that ultimately this platform has to go and, get integrated with the loan management system. So how do you envisage that, any operational level challenges which you have already dealt for and which can be beneficial for the audience here to understand that, how that can be taken up at a more seamless manner? Your thoughts on that? Thanks.
Thanks for the question. Hi, good afternoon, everyone. Now, I'll go back a bit into 2018 when the co-origination guidelines were released by the Reserve
take the
Bank.
mic a little up.
Yeah, when the co-origination guidelines were released by the Reserve Bank of India, and the objective was to take credit to the segments where credit is not there and to take it at a cost where the cost of borrowing reduces and they move away from the traditional money lenders. That model did not pick up because of inherent issues that a blended rate of loan had to be given to a customer and two systems were not talking to each other and reconciliation was a nightmare. Then in November 2020, the guidelines on co-lending came out, which was more pragmatic and more practical on how two institutions can partner with each other in co-lending model 1 and in co-lending model 2. At UB, we had an advantage, we had early mover advantage because our platform was ready because we were already doing it between two REs. Now, the problem of this is twofold, right? And I would like you to visualize this in two ecosystems. That one is a bank ecosystem. So the bank ecosystem is a 50-year-old ecosystem, lakhs of employees, thousands of branches, well laid out hierarchies and well laid out processes and very little scope of deviations in the processes. While on the other hand, you have an NBFC ecosystem, right? So imagine an NBFC which is 10 years old. They have cracked a particular customer segment which is not being served by a bank, and they have cracked the underwriting methodology using assessed income, right? Or by talking to the customer when the field staff talks to them. NBFCs are more agile, and they are also operating at a certain NIM. Now, getting both of these institutions to co-lend is an operational nightmare, if I may use that word. Now, breaking it down further, first, how do these two institutions define or agree that this is going to be the partner in my journey? And co-lending partnership is something which is not a transaction-based, like what happens in, let's say, a direct assignment or a pass-through certificate transaction. It's a partnership which is going to continue till the institutions continue, right? The second question is, and the challenge is that how do you align these two institutions in the data that you're collecting from the customers, the assessment methodologies, and the underwriting standards that are being used. Right? Very, very different. We have integrated with private banks, foreign banks, and PSUs. For a LAP product, in one bank we have 1800 data fields, and in some other bank we have only 700 data fields. Right? The third thing is, how do you adhere to a TAT of disbursement? In co-lending model 1, if the disbursement TAT increases, your customer goes away. Right? And the customer experience is destroyed. In co-lending model 2, if the disbursement TAT goes beyond a certain weeks, your liquidity might get impacted. Or you might give that case somewhere else. The third challenge is regarding how do you move data, how do you move documents, and a couple of panel members have already touched on that. The fourth is, which is again the core issue of co-lending, how do you marry two repayment schedules? Right? How do you marry the day count convention? How do you marry the IPC or the PIC convention between two systems? And then once the loan has been disbursed, when collections are coming up, there could be audits at a bank ecosystem or NBFC ecosystem, then how is the post-disbursement compliance taken care of? Right? So these are some of the challenges from our experience. And it's great to see a lot of platforms come in the country and this ecosystem develop in a way that people are thinking that this can be, this tech platform model can be something which will, generate the ROE for the investors who have invested. Now the thought here is that all this complexity has to be handled by one middle layer. Right? Now if you think of a bank thinking of integrating with 50 NBFCs and going through this journey 50 times, or an NBFC trying to partner with 10 banks and going through this journey 10 times, it's not going to happen. Right? Or it's going to take so long that the management and the shareholders are going to lose the patience. And then they will say that, move on. Let's do something else, raise money through DA or raise money through some other product, go to the retail markets and raise money. Right? So the thing is that how the TAT can be controlled. And the second thing is also about how this can be done in a seamless manner so that the cost of transition from one partner to the other is extremely low. Right? So this complexity can be done by the middlewares. And with our experience of implementing across multiple investors in the country and having more than 100 partnerships live on our platform, our experience is that the protocol has to be defined. And in a lot of cases, these protocols are defined by the banks. Right? So what is going to be the create loan protocol? What is going to be the collections protocol? What is going to be the documented data sharing protocol? What is going to be the information security protocol? So the bank has to take call on one platform or two platforms and give them access to their ecosystems by publishing the APIs, and then stitch multiple partnerships one after the other. And similarly for an NBFC also, because it's a source of liability and diversification is the most important thing in financial services. If you are live with one partner, using that protocol, you can then go live with the second, third, fourth, fifth partner in a matter of days. Right? Today, because our APIs are quite advanced, NBFCs can come on our platform, they can configure their LOS and LMS logics and generate an API contract within 15 minutes. So these are some of the experiences that we have had in implementing this.
Thanks, Arjun. I think you did mention about a very important point, which is, I think the need of the hour is that there has to be a common integration, parlance, and it should not be that multiple institutions, multiple integrations to be taken up. That will definitely, set the theme for the second question when we'll talk about the adoption piece of it. Quickly moving to you, Rahul. How do you think that, at All Cloud, you are helping banks scaling up the co-lending programs? And any thoughts on the integrations front which you would like to share here?
Sure, I think a lot of talk has happened on the either sides with the lenders and with the tech platform saying that the co-lending cannot happen without having an efficient integration of systems together. But to scale this platform, I would also go a step back and say when the business partnership happens, the tech partnership also should happen. The tech platform should get involved early on in the business, otherwise a photo op would happen but the first loan to get disbursed with about 6 to 8 months down the line. And then the whole purpose of co-lending fails. So get the tech systems involved early on, because the tech platforms, like ours, understand how these integrations will flow. And it's not only happy integration that happens, right? There are rejections of cases, there are resubmission of cases, there are some documents missing which they want. All of these have to be factored in. The rejection rates in co-lending is about 25%. So 1 out of the 4 loans are rejected by the senior lender in these cases. How do we get that down? This will scale co-lending. So getting this efficient system and also getting tech platform involved early on is one thing that is very, very important. Second is standardization of data. Obviously, the banks and the NBFCs to understand that there has to be a standard set of data that flows between the two platforms, the two systems together. And this has to be scalable. One integration after another. It should be just a replication or mere replication of the earlier integration. Otherwise, you keep spending time on integration, but the business doesn't flow. And obviously, the team gets into lethargy of project, right? The project lethargy kicks in, and then you start feeling that, yaar, Excel pe kar lete hain, badhiya hai, platform, integration chhod do. That will defeat the purpose altogether. And I know for a matter of fact that a lot of smaller NBFCs, we are working with about 100 NBFCs, they want to do co-lending. But the problem on the other side is that getting these integrated, not just from the system perspective, but also from an intent perspective, is very difficult. And we've seen our customers, one of the customers who've done it successfully, he's been able to do it with multiple lenders on the other side. Because the leadership takes interest and puts a mandate, puts a foot down and says that if I have to do co-lending and I have to do my business, it has to happen automated. I am not going to be putting teams to recon, to submit data, to prepare camps, send it to the co-lender, add a more 2-3 day of fat in terms of my TAT. That's not going to happen, right? So people who are doing it on a scale will have to follow the, kind of a platformish approach where they say that I would integrate, I would work on these integration, and I will ensure that it happens this way. But people who leave it up and then, as I said, business does the partnership, but technology does not get involved, yeah, it will not scale.
Again, I think very important point, that intent to go live and, to adopt the platform at the right time. That's very important. Very well, taken up, Rahul, on that front. Sudeep, moving on to you. I think so. You spent, I would say, a good amount of time in the industry designing different platforms now. We talk about NBFCs, banks, platforms, middlewares, so much of our data getting, integrated. One key aspect is, which still remains one of the major aspects for the banks, at least, is the core banking system. How do you ensure efficient integration from that middleware platform to that of the bank's core banking and back to the NBFC's LMS? Your thoughts on that? And I think then we can move on towards how do you think that adoption can be the key driver for this particular path here? Thanks.
Sure. Thanks, Shashank. Yeah, you touched upon a very important aspect of integration. Rahul has talked about tech partnership. Actually, before the business partnership can work, it's a tech partnership that has to be in place in today's world. Businesses cannot run without technology support, without seamless integration of technology platforms. That's essential in today's world. So now, CBS, as Arjun has talked about, banks' ecosystems are old. The technology platforms are old in quite a few cases. But what is required here? For seamless integration, you need API-driven architecture, service-oriented architecture. You need event-driven architecture, so that whenever an event takes place on a co-lended loan at NBFC's system, immediately it can be passed on to the CBS. And as everybody has talked about, it's not a one-to-one relationship. It's a many-to-many relationship that will eventually be there. It's already there, but that's what will be there. Right from origination, you have multiple touch points between CFSS at the NBFC side and CBS at the bank side, starting with KYC norms, AML, compliances, unified credit scoring, credit policy execution, disbursement. Arjun has talked about the point on repayment schedule. That's a very, very interesting subject in itself, because if you have in a co-lending partnership, if you try to draw a bank's repayment schedule and NBFC's repayment schedule and add the two, it doesn't add up to the customer's repayment schedule.
Correct.
Calculating it other way around is also difficult. You calculate customer's repayment schedule and then try to do it. Either NBFCs or banks actual yield goes down what you declare. So there are issues, and the biggest thing is in isolation these schedules cannot be drawn. You have to start with one and then derive other two, and that's the reason this integration, online integration through microservices. We cannot pass on the information with 1700 data points or 800 data points. You need microservices based architecture. And that's one of the reasons, because systems are not ready on either side. The adoption of co-lending model 1 is relatively lower, because that's where the compliance right from the beginning till the end is much higher. That's why a lot of lenders on either side are waiting, especially on bank side, for NBFCs to originate the loan, and they take the loan at a later date in co-lending 2 model. Another aspect, because of lack of integration, a lot of manual work happens, which increases the cost of operations. OPEX increases, which today may not be hurting the banks, because the co-lending book is very, very small compared to their own books. But what you cannot afford is that NBFC is spending X percentage of the book size as OPEX, and on the 80% which is held by bank, they also spend X by 2 or 0.8x as operations expense. It has to be almost zero, otherwise the whole benefit of interested benefit to customer will not happen. And that's where the role of technology platform, organizations who are providing these solutions is extremely important. We talked about data standardization, reconciliation, everything needs to be part of this tech solution, because multiple vendors, multiple softwares, multiple solutions are in picture. How do we define? And that's where we need an industry body, like we have Indian Banking Association, some other body where we have players from both sides, from business side as well as technology side, to come and define these standards for data exchange between partners. That is the need of the hour. Otherwise, the cost of integration is going up and up for every partner. And it is putting a lot of pressure on the technology partner, because the timelines are really, really quick. Everybody expects the integration to take place within weeks, 10 days, but in absence of any standard methods of communication in terms of the signature of those services, if I need to, from NBFC side, if I need to go to the bank and pass on some information, the signatures are not common. This differs even within the same software. If it is a core banking solution from one partner, the signature differs from bank to bank, from implementation to implementation. Same way on the other side. And that puts a lot of pressure on either side in terms of cost, in terms of timelines. We talked about regulatory. As Bhavna said, things are open to interpretation. Every day new guidelines are coming, which is very good. RBI is very proactive in bringing up various aspects, taking care of customers, fairness in lending. Now, the last one, or may not be the last one, but KFS. We don't have answer how KFS needs to be handled in CLM1 model. Will this KFS needs to be shared by both the partners, and they need the consent from customer. Both partners need separately, or only one set of KFS will work. There's no real straight answer available to that. So probably because of most of these, in my view, and with the experience that we have, most of our customers and partners are preferring to go for CLM2 model rather than CLM1.
Thanks, Sudeep. I think you've pinpointed a lot of key issues which are holding back CLM1 from getting adopted, and we definitely, I think, on the NBFC front. So Sharath, we have the platform team, and I was waiting for this moment to come that we all know we have to move towards microservices. We have to see the right time of onboarding a tech platform. We have to look at a configurable workflow in the co-lending platform. Now, having said all of this, and the vendors being aware about these scenarios, why you still think that CLM2 is the preferred approach? Or I would say, how can we better up on the adoption on the CLM1 model, and I think take the right benefit of what exactly co-lending was originated for?
Yeah, of course, CLM1 takes a lot of time, right? And especially in our case, customer needs money urgently, right? It's MSME, right? And they need working capital, right, for that. And ideally, they look at 7 to 8 days for funding to happen. Okay, that's why CLM1 takes precedent. Takes a lot of time. You have to convince banks or NBFC partners, right? In some cases, we are doing good job. Okay, we can do within a few days, but within our system, right? Okay, if it talks about product to product, case, right? Sometimes it takes 7 to 8 days, and a lot of documentation work happens, right? On a CLM1, okay, where customer doesn't want to wait. Okay, so that's the only limited point I would say is the customer urgency. Okay, and of course, and some of our business happen through partners, DSA model, right? Okay, and DSA will definitely push for urgent money, right? Because they is putting case to 5 different lenders, right? So these things, take priority and it create toll on CLM1. So this is the main reason I would say.
Sure.
Okay.
Thanks. I think Arjun, I'll shuffle the sequence here and come back to you where Sharath mentioned that TAT is something which is to be addressed there. And Sudeep also pointed out on the cost of integrations. How do you think that these can be better off? You have already shared that a middleware approach, something which is to be taken up at a common point there. How can that be, I would say, expanded or I would say go to the last mile of the end user? Because what we still talk about is a central level integration within the bank and NBFC. But ultimately, to reduce the TAT, I think bank as a whole has to be onboarded onto that platform, and the entire workforce has to be made ready to take decisions and act upon the cases coming in on a real-time basis. How do you think that scenario can be achieved here?
Extremely important point, especially on the turnaround time. And when we talk about CLM1, in addition to TAT, the key determining factor also is that how many back and forths can happen with the customer. Right? So in an unsecured personal loan or an unsecured business loan, you cannot have a lot of back and forth with the customer, right? Because the customer needs money now. So the time sensitivity is high while the price sensitivity is low. While when you go to a secured asset class like housing or a loan against property, the time sensitivity is not as much, but the price sensitivity is very high. Right? So in order to reduce that, I think our thought is that co-lending complexity should be managed between 2 institutions. The field level staff should not be exposed to that complexity. Systems have to be built and processes have to be built in a way that job is very easy for the front end person to share or capture that information and get the documents in the right way, publish it on the LOS LMS, pass it through a middleware to the bank's ecosystem. One of the way to reduce that, and it has been covered by a bunch of players, is that the more standardization that you build in the workflows, and the more early you bring in tech in these discussions, it's going to be more scalable and easy. From a cost of implementation perspective, I think it's a 4-year-old product, to be honest. So we are in November. I think our guidelines are exactly very close to 4 years old now. It's an early product that is getting developed. So the cost is going to come down over time. When direct assignment market was booming and when it started booming after 2013-14, the cost of doing those transactions initially was very high, right? There used to be a 100% mandatory audit, but now that has come down. Now people do sample audits, right? So it's a journey that our ecosystem is going through, and one good thing to be observed, and because we have implemented our direct assignment and securitization platform also in a couple of banks, the journeys of co-lending and securitization are essentially very similar, because fundamentally what's happening is an asset is moving from an NBFC balance sheet to a bank balance sheet. And the DA guidelines also today are very clear that each loan account has to be opened and the collections entries have to be passed in each loan account. An individual customer KIF has also to be opened. So the more standardization that comes up, and there is another theme to be observed. Today banks are choosing their tech platforms. Right? So if an NBFC doesn't like a particular platform, but if the bank has chosen it, there is no option for that NBFC. Right? Because you will have to come through that platform. So what will happen because of this is the platforms that are well funded, the platforms that have seen scale, the platforms that are investing in talent, the platforms that are investing in making their product and data security more robust, will be able to bring the cost of implementation and integrations down, benefiting the ecosystem. Thanks.
Thanks, Arjun. Well, Uttam, quickly taking it, on the wrapping remarks from your side, how do you see that, a more cohesive environment can be created around exchange of data for better adoption? That is one. And I think Arjun did mention about the common platforms getting a better shape. Now, when you say that, your platform is on premise, how do you think that, that can act as a common platform, or do you think that still it is to be taken up on a private cloud deployment where it can, I would say, handle multiple arrangements from different banks and partners here?
Sure. See, we are the youngest in the platform middleware business, right? So what we've done in the ecosystem is to work with existing middlewares, where with our NBFC network, we do integrate with other middlewares because they do have the presence with the banks. And it's a joint model. It's coexistence. It is all of us trying to create an impact together. It's network effects. It is also about how do we collaborate to ensure that the ecosystem survives, ecosystem thrives, ecosystem grows. But at the same time, there is value creation at both ends, right? With those principles in mind, when I think about how do you ensure you find ways to work with different platforms, different data sets, different processes, is a lot of work that needs to be put in place. But like, people have also said, there's a lot of people still sitting on the sidelines. They're still observing how co-lending is actually functioning. It is about how probably ULI is going to come out. Can we then start to think about in the future a unified digital platform itself, right? Maybe it's an idea. Maybe it's about standardizations that all of us have to get to. It is about the protocols that we can establish with different entities. It's a long game. It is not going to be easy because there is, I would say, a lot of different systems put into banks and multiple systems with different entities and different divisions within the bank, right? So data sets itself is so diverse, disparate, unstructured. Now to put all this together and then find unified ways of working is actually a very, very complex problem, right? And technology is a mindset. Technology is an investment. If it is seen as a cost center, this will not be looked at in terms of how we can create an impact for a longer term strategy. So when it comes top down, then changes come. But there are some entities which are proactive, which do changes proactively. Those NBFCs and banks will be the leaders.
Sure, thanks. Well, Rajat, Arjun mentioned about a point that I think we have to go towards a phase where parameterization has to be looked upon. And there has to be a lot of predefined rules in place which would ultimately help the process to achieve a better TAT. Any thoughts on, how can this be achieved?
Sure, but I think Uttam answered part of it saying it's going to be a long way to actually doing that, because lending in itself and co-lending is a subset of that. We've already covered multiple use cases for that, right? So there's unsecured, the MSME, personal, LAP, all of those kind of loans exist. So doing parameterization across all of those products is today I believe that's an intractable problem. You're probably going to need different sets of parameters for each one of those products. Let's take the case of, say, MSME lending. There are a lot of products and services that are already in play that should probably be used. There were some players who tried to look at MSME lending as a standalone problem, and that's impossible. That it doesn't work like that. A platform like Treads exists today, right? Jyoti spoke about it earlier in his talk, right? We should be using invoice discounting to be able to issue credit with much better data, with much lower NPAs, if we're able to do that. And a central hub for that exists. The question is, how do you use that hub, right? Today, what we're seeing minimal participation from, at least we think it's minimal participation from banks and NBFCs on the Treads platform to be able to do this. But the reason we're seeing low participation there is because their access to data, their applications coming to them rather than going to private partners, rather than going to NBFCs, is actually very, very low. So how do you increase exposure for NBFCs and banks to credit requests via the Treads platform? There is actually a product for that as well, but it's not yet in play. So so we work with that product, for example. It's called the B2B category on Bharat Connect, right? That's built to be a connector to an interface and enabler for the Treads platform. But there aren't a lot of lending partners who work with us on that today, because again, they have a very, and this is not to criticize anybody, they have a very focused approach on lending, and the creative sort of solutions that might exist right outside of their area of focus have not been a priority thus far. But we think there's a lot of value there, and if that's one for, say, just for MSME and against their invoicing, there'll be 4 creative solutions, out-of-the-box solutions for all of the other products that we're talking about. So if you tell me that we're in 2024, at the end of 2024 today, and by 2025, we're going to have parameterization for co-lending across these products, I don't think that's going to happen.
But I just want to add one
Sure,
point here,
please.
right? Like we just have seen that, somebody said that the unified platform is a long journey, but I do believe these exist, and there are capabilities available where right from the origination, co-origination, the middleware, co-lending middleware, which is again AI ML enabled, where the propensity of acceptance of the portfolio can be identified, and the loans can be pushed to the desired lenders. All these things exist, and again the servicing part of the thing, then the accounting part of the thing. So the entire ecosystem covers, and such capabilities are there, and I would just request all the people right here to basically adopt those systems, give them a chance, leverage the capabilities that they have, because everything is new, right? Everybody is evolving, and it's again a story of evolution to revolution, right? So everyone will mature with the time. So yeah, that would be my closing statement.
Thanks. Rahul and Sudeep, a quick one, common one to both of you. Sudeep, what are your thoughts on adoption getting more penetrated in the market? Because bankers do understand they need to adopt a platform. We are talking about, actually the panel has given a food for thought to AFAI that there has to be a need for a common body which can at least have some transformative layers of how standardization can be achieved on that. Any additional thoughts on this front, on the final ones, in terms of adoption to be penetrated more on the ground level? And then Rahul, we can move on to you.
See, adoption will increase. There's no doubt about it, with more clarity and integrations happening. Both businesses as well as technology solution provider will find the areas and understand where all integration needs to be done. Some standard integration, once they happen, tweaking those to other solutions, other platforms will require lesser time. And finally, we'll have to move to CLM1 only, because that model only passes the benefit of interest rate to customer. CLM2 doesn't pass, and things will take shape and will happen. And I don't see any reason for not low adoption over a period of time.
Thanks. Rahul, summarize.
I think, carrying on from what I earlier said as well, I think there is definitely the tech integration will help and CLM 1, as Sudeep said, has to come in. It is not just for the borrower, but also from the NBFC's perspective, because that's where the liquidity also kicks in, that you have access to funds that can be deployed when it is actually needed by the borrower. But I think as an industry, there have to be efforts to remove the ambiguity in the entire process of co-lending. More research papers, more guidelines, more interpretations, standardized interpretations of what processes from a taxation perspective, from income recognition perspective, from NPA, reporting perspective have to come in. Because even today, if people are doing it, it is again open to interpretation, which can be challenged later on. So that's an inherent risk in this entire transaction. So if that is weeded out today by experts in the industry, and as you rightly said, AFI can do it, I think that will be something that people can confidently adopt co-lending.
Thank you, thank you. Well, I think just to summarize it on the closing remarks front, we've heard it from the lenders front who have already implemented these models, and from the platform players, we do know that we are already pinpointing our focus upon two key issues to be implemented, be it implementation of a middleware approach, or to take it on a microservices level with the CBS, or parameterization of the BREs, and I would say a common onboarding platform for the borrowers as well, where we can look at some data points on the unharnessed data which is available across the domain. Well, on this note, thank you panel for sharing your views here, and I'll just open the floor for one or two questions if there are any. I would just request you to please summarize your question and be very pinpointed, and if you can address it to a specific speaker, that would be very helpful. Just two questions, please. Thank you. Can we get the mics, please? Yeah. So if you can switch on the mic and point the speaker you have a question for, or if you can just throw a journal question, speakers can take it.
Yeah. Now, if there is a loan ticket size is a very big one, and one bank is maybe hasty or is not willing to to enter in it. So if there is a requirement of more than one banks or the NBFC, and the platform is to be needed in the tech size, so we have almost forgotten the blockchain. Now if the blockchain I wanted to know from anybody if anyone has tried the blockchain for this co-lending purpose, because there is a real size risk assessment, and people, even if in the middle of the period, if wanted to enter more lenders, or some old lenders wanted to exit, is this experiment has been done?
Sure. So you want to understand about implementation of blockchain in the platforms. Any speakers would like to take this? Sudeep?
Not to my knowledge. While blockchain and smart contracts have been talked about in various technology forums, real implementation is pretty low. A real use case, and there are doubts around its authenticity, its security. So adoption of blockchain smart contract is really low.
Sure. Thanks. We just have time for one more question. If you can pass on the mic to the gentleman on the right.
Hi. So this is a general question for the panel. I wanted to ask if in the industry have we considered using ONDC and their protocols because they have common data schemas, and there's an ONDC financial services piece which is being sort of laid out because there is so much issue in terms of accounting, in terms of data integration. Has that been considered? And that would be the first part of the question. The second part of the question is in terms of the alternative credit data. I mean, a lot of platforms are focusing on that. Do you see in foreseeable future alternative credit data reducing the cost of overall the financial services product to the end customer, or do you just see the size, it helping increase the size of the pie, which means, increase, taking it to new customers in the market? Thank you.
Sure. Any speaker would like to take that? So I think ONDC standardization on the...
At a UGRO, we just acquired one platform, the MyShub Life few months back. It is an embedded platform, embedded finance. There we are trying to use ONDC, okay, and we have started talking to ONDC protocols, all that, and putting those products under ONDC platform. Okay. And with regards to alternative data, of course, right? It helps. It really helps the fasting the process. You can go to underserved demographics using alternative data, utility payments data, transaction data, and it reduces your cost of operations, expedite the funding, and then you can create a good book, I think, and really helps, okay. And in our digital lending platform or embedded, we use very heavily on that. And even our growth score engine, we have a UGRO 3.0, which we use GSTN and Bureau Banking. So we use alternate data also, and it really giving good results.
Yeah, just to add to what Sir has just said. So yeah, alternate, data and the scoring models will definitely, increase the efficiency. However, when in a co-lending middleware, you have the model that we have is like you have the scoring parameters, including your, alternate data or the original financial data, and then you have the scoring, parameters basis on the policies of both the lenders, co-lenders, right? So that they can just see, and the model can also, mature, when we come to AI and ML, they can also mature that, okay, with these alternate data, the probability of alluring the buyers are high. So all these can be a consumption to the BRE and the AI ML model scoring models as well. So yeah, definitely it is going to add up to the efficiency.
Just wanted to add my 2 cents. So yes, we're actually integrating the the ONDC stack into the consumer platforms to be able to present financial services from the banks to them. As far as the interest rate question goes, the way we think of it is to say that the interest rate isn't, so the weighted sort of, the average interest rate is not about whether it's coming down or going up. It's about finding the right rate for that individual case, right? A customization to N of 1. So what will happen is, like everybody else said, what you're going to see is more efficient pricing for the credit itself. In some cases, it's going to be lower than what it would have been without that alternate data. But in some cases, definitely going to be higher just to reflect the risk of the applicant.
I would also like to add something on the alternative data points. It's definitely going to decrease the cost for the financial institution. See, because it will increase the approval rate. What you incur as the cost remains the same whether you are approving 60% loan or 80% loan, because you have processed the loan application before taking a rejection decision. If your approval rate goes from 60% to 80%, definitely you will start earning on those 20% cases. Your interest earning would be there, but cost of origination, which is already paid, some part of it would be saved. And that's where you will save on the overall cost, and efficiency will increase, OPEX will reduce. Not only that, financial inclusion is a very important aspect. With alternate data points, credit on that will help us in increasing that financial inclusion for underserved and not served people.
Thanks, Sudeep. Thank you. So with this, I'd like to thank the audience, and thank you so much, panel, for spending up the time on a working day. Really thank the audience for the patient hearing. I know we were between your lunch, so yeah, I think so. You'll be happy to know that we're wrapping up now. Thanks. Anupriya, over to you.
Yeah. Thank you so much, everyone. Such an esteemed panel today. It is time to honor our speakers of this session, and I would like to request Mr. Shashank Sharma to felicitate our esteemed panelists. Beginning with Mr. Rajat Gulati, CEO and co-founder, Plutus One Technology Private Limited. Please bring your hands together, everyone. Then Mr. Sharad Agarwal. Okay. Mr. Uttam R, CEO, Sison Omni India Private Limited. Thank you for being with us, sir. Then Mr. Sharad Agarwal, CEO and TO Ugro Capital. Then Mr. Rahul Jain, ED and co-founder All Cloud Enterprises Solutions Private Limited. Next is Mr. Sudeep Garg, Mr. Sudeep Garg, VP Nuclear Software Exports Limited. Next is Ms. Bhavna Sharma, Principal Consultant Lentra. And none other than Mr. Arun Sood, Co-Head UB. Please bring your hands together, everyone. We're gonna have a wonderful lunch. Before we get off the stage, I would like to request Mr. Vineet Sharma to felicitate Shashank sir. And now it's time for a group picture, please. I know we all are hungry, but we need a group picture to remember. All smiles and tech solutions together. Our third session is one of the special sessions for us because it's all ladies session. As we begin with our third session, we extend our heartfelt thanks to our sponsors who made this event possible, beginning with a shout out to our silver sponsor, Central Bank of India, Ugro Capital, Associate Sponsor, Punjab National Bank, SIDBI, FinTech Partners, Plutus One and ScoreMe Solutions Private Limited, Knowledge Partner, Resurgent India, Corporate Contributor, Manappuram Finance Limited, SAIS and Omni, FlexPlay, Association Partner, PSLAI and FIDC, and our exhibit partner, Canara Bank. Our third session is on balancing growth and compliance for NBFCs. This session will address the tightrope walk that NBFCs navigate to balance growth with regulatory compliances. Please join me by giving a big round of applause and welcoming our panel of esteemed speakers for the session. I would like to begin with the moderator of the session, Mr. Vinod Kothari, Director, Vinod Kothari Consultants. Big round of applause, everyone. It is an honor, sir, for me to introduce you, and who is an internationally renowned author, trainer, and consultant on financial subjects such as housing finance, securitization, credit derivatives, structured finance, and banking regulations. Known for his expertise, Mr. Kothari has lectured globally from New York to London to Singapore, Sydney, Johannesburg, engaging diverse audiences, including rating agencies, investors, tax officers, legal professionals, and executives of major financial institutions. A fellow of ICSI, Mr. Kothari has led Vinod Kothari and Company in corporate law practice for over 30 years. We welcome you, sir. Our first speaker of this panel is Ms. Bunani Roy Chaudhary, MD, NAB Samruddhi Finance Limited. Ms. Roy Chaudhary, with an MBA in Finance, an MA in Economics, and certifications from IIBF, has dedicated over 3 decades to NABARD. Her expertise spans institutional finance, focusing on green finance, WASH, infrastructure, microfinance, and financial inclusion. She has significantly contributed to advancing rural financial institutions in India. We welcome you, ma'am. Our next speaker is Ms. Geeta Chenani, Associate Director, Care Ratings Limited. Ms. Chenani possesses over 12 years of expertise in credit analysis within the BFSI sector, where she oversees ratings for diverse financial entities, including housing finance companies and NBFCs. She is actively involved in industry outreach, contributing insights through webinars, publications, and engagements with investors to provide informed rating perspectives. A big round of applause, everyone. We all are energetic now. It's session 3, post-lunch. Now, our next speaker is Ms. Shilpa Mankar Aluwalia, Partner Shardul Amarchand Mangaldas. Ms. Aluwalia brings over 12 years of expertise in banking, finance, and corporate law. She advises major fintech companies and investors, including Facebook, WhatsApp, PayPal, and Amazon, on regulatory and product strategies. Welcoming our next speaker, Ms. Smita Jha, Partner Khaitan & Co. Ms. Smita is an advisor on banking, finance, insolvency, and digital lending laws. Recognized as a recommended lawyer by the Legal 500, she actively contributes to industry consultations on fintechs and restructuring issues. Now, I would like to hand over the mic to our moderator, Mr. Kothari.
Thanks, ma'am. Thank you very much. The caption of the session is balancing between growth and compliances. As this is the afternoon session, the biggest challenge is balancing between networking and the discussions. And quite often, it's the first part which takes over, therefore people are still to usher in. But if the volunteers can help, I think best is to close the doors so people who would like to be inside can come inside. This session, as the MC already indicated, is unique in the sense there are 4 ladies that I need to be moderating. At home, just one keeps me subdued and moderated all the time. Here I have 4, and I think in interest of my safety, they kept me a little away from the 4. Light away in apart. Let's maybe straight get started with a very serious discussion today. And I'm going to make a next serious statement. Tell me if you find it serious enough. That the compliance environment for non-banking finance companies is all cool and comfortable. Did you find this serious? Is it seriously amusing? So things have obviously taken a sharp change. This change might have been slow for people who have been like insiders. Probably the change is slow and let's say predictable. But for a lot of others, the change was very sharp, very fast, almost unpredictable. Some people even say unprecedented. But there have been actions by the supervisor against specific practices. I wouldn't even talk about against specific entities. After all, when regulatory action is taken, it's taken in light of certain practices. But then it does hurt certain entities. It hurts some specific entities more than others. But in general, the view around is that actions of the supervisor have hurt almost every player in the industry. Non-banking finance companies in general today, the feel is one of introspection. The feel is one of regulatory risk assessment. I think the key word today for most of the NBFCs, large or small, is that the biggest risk that the sector faces today is regulatory risk. And this regulatory risk has come to the fore over a period of time because NBFCs have been doing quite well. I think post ILFS, post COVID, once the impact of COVID was over, NBFCs in general were doing quite well. I mean, the growth rate was fantastic. It was regularly, consistently exceeding the rate of growth of banking. And of course, the NPA levels were also by and large manageable. The rates of interest were quite good. Thanks to digital lending, they were able to maintain fantastic growth in asset size as well. And in order to maintain a bridge between the banks and the non-banking finance companies, Long time back, they had a window called securitization, which was found to be tough. Then people moved to so-called direct assignment, which also became tough in 2021 as the RBI came with fresh regulations on direct assignments. And then co-lending came on the scene. So co-lending came as a sort of what one would look as an easy alternative to effectively do what co-lending was achieving, at the same time with less of regulations. And then 5 years back, because Ashish ji would just be celebrating 5 years anniversary of the co-lending circular of November 5, 2019 or 2020, 4 years, 4th anniversary. And that made a sea change because the newfound way of so-called CLM2, which is basically the so-called discretionary co-lending, that you pick and choose, you can cherry pick assets and still call it co-lending. And in certain respects, this might still be exempt from the minimum holding period requirement. So you can actually do an on-tap direct assignment, constantly keep originating assets, keep pushing assets to your co-lenders. You could probably expect a lower cost of funding from the co-lenders. And therefore, on your share, 20 or whatever else it is, the rate of return could be significantly higher. This party was going so very decently, so very well. When I'm saying this party was going, I'm not saying that's the end of the party still, but yes, there is a sort of an introspection now needed, because from the press reports and at least the anecdotal hearings, it seems that the Ministry of Finance also wants the growth in personal lending, particularly unsecured personal lending, or even microfinance. There are some bit of reforms of regulatory practices that the regulators are expecting now. So probably bankers will now be in a mood of, well, let's check what we're doing. Let's check our co-lending partners. Let's check the regulatory health of co-lending partners. Because if you are a partner with another entity which undergoes a severe regulatory review, I must say, in a sense, there is a reflection back on you as well, because you are partnering with the NBFCs. So that's the topic for discussion today. I have a wonderful panel consisting of and people who are into lending, people who are legal experts, and a person who is a rating analyst as well. So I've got basically a mix of participants from the lending space, from legal space, as also from rating analyst point of view. So we would be able to examine the compliance environment from different angles. Let me straight get started, and let me first ask Bonani to give a very short 1-minute perspective, just to break the ice with the audience, and give your very short reflection on how do you see the compliance scene now in the non-banking space after the recent regulatory actions, Bonani.
Okay, thanks Vinod, and thanks AIFAI as well as Resurgent India for having me here. Absolutely an honor. And a very relevant question, because we have seen a spate of regulations happening over the last 6 months, I would say, in different segments. And it has affected us as well. Very honestly, we are wholesale lenders. For those unacquainted, we are a subsidiary of NABARD into B2B lending. So, and we had a ESG focus as well. So we were very cautious about who we work with, who are the partners. And most of our clients had onboarded into co-lending, either as an upstream or a downstream role. And we have seen that last year the story was different. Last year by this time, and even I would say first quarter, second quarter, the business was huge. So if we look at the volumes, we can see that there is a contraction in volumes. Whether it's defined by underlying business or underlying end borrowers, whether is the demand at that level, that is the question. And what we actually garnered from our clients is that they don't have issues with their liability as much as they have issues with their asset side today. So they are unable to deploy. Is it only because of regulatory action, or is it also because something's changing at the end borrower level, whether it's the rural or semi-urban, whether actually there is a contraction in demand for credit, and that would that can translate to whether there is a contraction overall demand. So again, I leave it to the discussions.
The same question moved, just short 1-minute reflection on what's happening in terms of compliance environment in the NBFC sector.
Sure. So
co-lending had been growing very well. FY24, in fact, the discussions that we were having with various financial entities, in terms of tie-up and volumes, they were seeing 3 to 4 times increase in co-lending volumes. But what has changed in the last few months? So is it just the volumes or is it the business also? So also looking at the fact that there have been various regulatory actions. Now, what will be the fallout of these actions? So basically, it will prompt the senior lender, which is the bankers, to do more due diligence of their co-lending partner, whether that partner is in line or not. And also, if we all go through the regulations, it is mentioned that the credit sanction process as well as the due diligence, the responsibility of that falls on both the junior as well as the senior partner. So that is something that bankers will have to take care of. And last but not the least, due diligence will get its, a lot of precedence. Because if we step back and we look at where are these, which are the areas in which these regulations are coming in. So basically this is with regards to, stopping of onboarding of customers, be it credit cards, be it lending products, or the regulator having certain concerns from a supervisory standpoint, compliance standpoint. And these are important areas because co-lending right now is at a nascent stage, right? Just a back of the envelope calculation, if I were to do, because there is no credible number for this, it would be slightly over 1 lakh crore of AUM. But right now this market is growing, right? So it seems, probably it seems a right time for the regulator to intervene so that the risk doesn't spread.
Yeah, right. I think that's a very important point. I mean, Geeta has made extremely important points. And number one, she said that when a banker signs a co-lending agreement with a non-banking finance company, given the fact that the due diligence and the responsibility for practices is on the senior lender as well. And therefore, you cannot be comforting yourself saying that I am not doing anything, it's the NBFC which is handling and therefore it's their business. No, that's not acceptable. That's one very important point she made. And she also made another very important point that we are currently at 1 lakh crore, but the scale at which we are growing, this may be the right time for the regulators to interfere and maybe set the ground rules before things become out of proportion. And let's maybe park it for a minute. We come back to you, Geeta, on that. But let me move to Shilpa, your initial thoughts on how do you see the current scenario?
So I think very relevant questions given what's happening in the market. But I think, very quickly, my short take on co-lending is, yes, I think definitely regulatory risk has increased. It's become a focus area for the regulator, but I don't think the business model is really going to go away. It's worked so well. I mean, for two key reasons, all of us in the room, know the strengths of the co-lending model. One is each party brings its strengths to the table. The banks bring their lower cost of capital, and the MBFCs bring their ability to leverage tech to access consumers, their wider credit reach. And it's worked particularly well also in opening up certain credit access channels for lenders, for borrowers who may not otherwise have access to finance. The SMEs, the MSMEs is something we were talking about earlier, the small businesses. I think the co-lending model has really worked for these segments where NBFCs are using different tools to do credit underwriting, using data, using big data, using alternative models to assess the credit risk of consumers. And that has opened up credit access. So from, at least from that perspective, the demand side, that will continue to grow. But I think the regulatory risk the RBI has, regulators have pointed out, are broadly in 2 or 3 dimensions. Systemic risk concerns around growth of unsecured lending, growth of consumer loans, personal loans. And I think this is a time where both the regulator and I think platforms and banks will really focus on compliance, regulation. I think the amount of time and resources that platforms spend on compliance will increase. This will be a demand from investors as well. And in terms of, I think, banks focusing more on the business models, the kind of KYC, I think what Geeta had mentioned, the kind of credit underwriting models. I think the approach where it's not my problem, it's the NBFC's problem, I think that approach is definitely going to change, because there'll be an expectation that the regulator is clearly set out, even in areas where you may not have a defined set of rules, for example, pricing, right? I think there again, banks will start thinking about what the pricing of the end product looks like for the consumer, because ultimately, these are areas that the RBI has indicated are concern areas for the market.
Vidushi, moving over to you.
Thank you for the question, and I think panel members have already touched upon most of the points, but I will tell you, being a corporate lawyer, looking at what regulatory actions the regulator has been taking, right now there's so much skepticism and cautious behavior from everyone, and specifically for co-lending, because if you look at it, it's just one key circular. Now, whether one key circular can, tell us all the points, how to ensure compliance, it is practically impossible. So at this point of time, it becomes very important for all of us to analyze how regulator has been behaving, how we can ensure that we are on the right side of law, and what calls we take reading the circular. I think that becomes very important, especially at this point of time.
Absolutely well said, Vidushi. When you talk about the supervisory action against some of the lenders in the recent past, the RBI talked about certain practices. Press releases are never so very detailed in terms of what were the practices, but primarily the feel one gets is in respect of the following practices. A, the rates of interest. That's something that the RBI has time and again been talking about, that we liberated the rates of lending. Earlier there was a cap on the net interest margin in case of microfinance, which was done away with. There was no absolute ceiling on rates of interest ever for non-banking finance companies. So we've been extremely liberal in permitting you to charge what you feel like charging. But that doesn't mean people can take liberty with borrowers and start charging what the RBI says is exorbitant or excessive rates of interest. So rate of interest was one point. Nowhere does the regulator ever say what is the rate of interest beyond which I will have a problem. But nevertheless, we are told rate of interest is one of the issues. Second issue, of course, was transparency in disclosures. This has been, once again, one of the so-called fair lending practices point of view regulatory issue. But I think of late, slowly, the RBI has made a so-called KFS disclosure mandatory for most forms of lending. And KFS now mandatorily says you need to compute a certain annualized percentage rate which has to capture several elements. So that transparency in lending disclosure is mostly taken care of by practices which are implemented over time. The third thing which regulator quite often talks about is evergreening. And this is a consistent problem with the industry, that quite often people give loans. They may be called top-up loans. They might be given the name of a personal loan to the same borrower who has a running loan with the lender already. And the proceeds of the second loan are used to take care of the delinquencies in the first one. Therefore, the second loan is basically a device to evergreen the first one. And therefore, so it goes. So there's a third loan which is taking care of the second loan and so on. So evergreening, note that banks have been doing it over the years. Governor Rajan talked about it as zombie banking. And different other commentators in the past have been talking about use of ARCs or use of AIFs for evergreening loans with banks, but that's been going on with the banking sector. When it comes to NBFC, that's been one of the regulatory objections. And the next objection which RBI has actually flagged in terms of their observation particularly for gold lending, which quite often takes the shape of an agri loan also, that you are calling it agri loan, but you're not monitoring the end use of the money. Because what is gold loan? What is agri loan basically is the usage of the money for farming purposes, not the fact that you are a farmer. Everyone could be a farmer in some sense. I might be having a papaya tree in my house. I might be growing a couple of tomatoes in my kitchen. So I might be a farmer everyone might be a farmer in that sense. But the meaning of agri loan is not whether you have a tomato growing at the back of your house, but whether the proceeds of the loan are used for farming purposes. And that is quite often evident looking at the magnitude of the loan itself. So that these were primarily the objections of the regulator. And I'm coming to the first one, which is the rate of interest. And Bonani, I'll direct this question to you. Rates of interest, the RBI has been talking about. The RBI has never spelled as to what is an excessive or exorbitant rate of interest. What feel do you have in this? When do you say we are crossing the Lakshman Rekha from, is there a Lakshman Rekha at all? Or Lakshman's Rekha was invisible, so there's some kind of invisible Lakshman Rekha?
Yeah. Yes. So again, very relevant question, something that we get asked a lot. As far as RBI is concerned, for MFI sector, there was a Lakshman Rekha earlier, right? Then RBI went into deregulation, and that was, mind you, only for the NBFC MFIs. It was not for others, so there was no level playing ground there. So when they removed it, it was expected that the NBFCs or the MFIs would be charging rates which are in sync with their cost of funds, let's say, because that's what it was tagged to. It was tagged to a benchmark earlier. But again, we know that there was different entities in the MFI space. I'm mentioning MFI because this is where it's hit the most. And we have seen that MFIs who have ROA of even 6 and 7%. That's where the regulator is concerned, that I don't care if you charge 30% if your cost of funds is, let's say, 16 or 17, because in these segments where it's microfinance or unsecured business loans, where you are really working in the remote rural areas, OPEX is going to be very, very high. So taking into account the OPEX, your risk cost, because this is a very high risk sector again, very high risk segment. So taking into account after all that, if you have a ROA of 6 and 7, when others have 2.34, even maybe 4.5, that's, we see around 3 is the general one for the clients we work with. So then that kind of a ROA doesn't justify, and that's where this is what we come to know from the inspection RBI conducts of the MFIs, where they ask questions on why is the ROA so high. Is your rate really justified? And there's no reason for different MFIs to have the same rates. We almost find similar rates. There's no reason. For any banker, the COF is very low. Then we come to NBFCs at different levels. So we look at a MFI working in a remote area which takes funds from us, let's say at 14%. So obviously their ROI is going to be very high. So ultimately, it is the rate at which, it's your earnings. You have to look at the returns. So a very high return is not justified because ultimately it will not sustain. The rural areas or the semi-urban areas, they are not earning this kind of return. So they can't ultimately sustain, so evergreening is bound to happen. Otherwise, you won't get your loan back and they won't survive. So that's why it was a kind of a reminder, it was a wake-up call, and I think most of the MFIs are waking up. SROs have woken up and have even given kind of guidelines to the MFIs that please look into your ROA and stop evergreening. Things are going to fall in place. I hope that answers the question.
Absolutely fantastic answer, Bonani, and I'm hoping that the audience is getting all included because she's making extremely pertinent observations. She talked about ROA. Remember, she didn't talk about ROI. She was talking about ROA of 5 to 6% return on assets. And the way the competition goes, if the cost of borrowing of MFI is, let's say, about 11%, cost of overheads, I would assess, would be between 5 to 7%. If it's efficiently managed, probably 5. Smaller entities would probably be 7, so that 11 plus 7 makes it 18. Cost of risk, which is also computed these days. Most of the NBFCs, MFIs will be following Ind AS, and therefore they are computing cost of risk in form of what is called expected credit losses. So that would add up to another 3%. So 11 plus 7 plus 3, that makes it 21. If I'm lending at 24%, my ROA should actually be 3. If the P&L is reflecting an ROA of 6 or 7, that would mean there are sources of earnings other than ROI, rate of interest. And that's very important. These days, most of the lenders have found other ways of earnings besides earning out of interest. They'll probably be selling some alliances with some OEMs. They might have probably alliances with some insurance companies. Unfortunately, insurance companies also become a part of the game. There's substantial pass back of commission from the insurance companies that gives a decent earnings to all forms of lenders. MFI is just in one example, but all forms of lenders make a significant earning from insurance companies. So all in all, if you're talking about 6% ROA, that's actually significant. She's right in saying that at an income level of 25,000 a month for the family. Remember, the definition of MFI is 25,000 per month at household level, which means husband and wife both are working, their aggregate income should not be exceeding 25,000. So 25,000 income the person who makes will still be spending 12,000 rupees on meeting his, bare basic domestic needs. Khana khayega, kapda pehnega, medicine lega, that will take 12,000 rupees for barest minimum necessity. You are left with just about 12,000 rupees. With the 12,000 rupees to service a loan carrying 24% rate of interest, there is obviously a question of affordability. I am not sure how this is explained as affordable, but that's a very key question that Bonani has raised. Let me now, Bonani, and I think probably even, let me ask this question to Geeta as well. Cost of lending is a very important issue she raised. When it comes to co-lending, I have a co-lending partner who has indicated his cost of funds. I have a bank which is saying, I will charge you 12% rate of interest. So cost of lending is fixed when it comes to the bank. My own cost of capital maybe, for example, let's say it's 30%. Therefore, the blended cost of lending, given the fact the banker is charging only 12, my own cost is 30, could still be the weighted average because the banker is providing 80% of the money. If we compute a weighted average, the cost of lending ought to be still cheaper than lending entirely on the balance sheet, which means the whole purpose of the RBI permitting co-lending, which you can see very clearly in the 5th November circular, is that we are doing this to allow lower cost of funding to the borrowers. In co-lending, do we actually see the lower cost of funding? Bonani, this question briefly to you, and then we move to Geeta.
Yeah. In so many cases, we have seen that this is being passed on in the sense that there is a blended finance and it goes to the cream de la cream of the clients, obviously, because somebody has repaid 2 cycles of loan on time, they deserve, and it also becomes a kind of example to the others that I need to be a good borrower, I need to follow credit discipline. So we have seen this with especially the public sector banks where they have had a deal with the originator. So where the originator's rate was 26%, we have seen a 19% blended rate, that is 9 plus 27 for the entire loan. I know that there is a huge differential on the 20%, it's true. But again, the OPEX and everything is high. So when you look at the weighted average, it's not a huge benefit. What really serves as a benefit here is that the best of the borrowers are getting a lower rate. But this has not happened in all the deals. Definitely, even where it was bankers coming in, it should have happened. It has not happened in all the deals, and that's surprising. Whereas when it comes to NBFC to NBFC co-lending, which is not covered by the circular, and I'm surprised that nobody thought of it earlier. It only happened after RBI came out with the circular on co-lending. Earlier we were co-financing projects and all. But retail level, the idea came only after the circular happened and everyone is misusing the CLM2. CLM2 is only for banks and NBFCs for co-lending, for priority sector lending. It was meant for that segment. But lot of deals we are seeing where it is NBFC to NBFC, no change in the rate of interest. It's just the win-win situation for both. Huge margin on that 20%, and they are also taking the MHP advantage, which they should not be. Just wanted to point it out.
Once again, she made an extremely important observation. I hope the audience heard. Afternoon time, I'm hoping you're still able to maintain yourself agile. Na? NBFC का रात का नींद उड़ गया, afternoon में सोने का कहाँ गुंजाइश है? She made a point that the so-called CLM2 was only for PSL lending, that too between banks and NBFCs. That use of CLM2 or the MHP carve-out for non-PSL lending and still calling it CLM2 is not actually not envisaged by the regulator. Geeta, same point coming to you with cost of lending. Is it actually being passed on to the borrowers because the co-lending weighted average cost is anyway cheaper?
So, if you look at both the structures, CLM1 and CLM2, I think CLM1 is more favorable in terms of passing on the cost structures. But unfortunately, most of the deals that happen, they happen on CLM2 because of various operational issues, and tech has to be integrated right from the start in CLM1. So with maximum deals happening on CLM2, I would say this is hardly getting passed on. So let's say for the NBFC, probably they would be able to get some kind of a lower cost of funds. So for example, if a BBB NBFC would be raising capital, let's say 12 or 13, and with bank is, the hurdle rate is 10%. So probably they are able to get the lower cost of funds if they enter into co-lending for that proportion of the portfolio, but not necessarily getting passed on to the end user.
I just have a follow-up question to you, Geeta. The question is about you as a rating analyst. Looks at the business model of an NBFC which is focusing on co-lending versus another NBFC which is on balance sheet lending. In the former case, do you see any differential risk factors given the fact that the assets which show on the balance sheet are only my share of the loan, just about 20%? Whereas the exposure and the returns both could be on much larger portion, which is 5x, because I've got 80% share, which is not on the balance sheet at all. So my balance sheet is already leveraged 5 times because of the off-balance sheet 80% assets. On top of that, I have leverage on my own balance sheet as well. My balance sheet itself is leveraged. If my balance sheet is a 5x leverage, and I have a 5x leverage off the balance sheet, I'm talking about a 25x leverage. As opposed to that, think of an entity which is lending on the balance sheet itself. As a rating analyst, how do you differentiate those two scenarios?
So firstly, we will look at the business model, the usual things, assessment in terms of how is the loan getting originated, underwriting is being done, and the loan is being collected. That is obviously something that is being looked at. You made a pertinent point on the leverage. So because obviously the NBFC, so here what we look at is that what is the proportion of co-lending that NBFC is doing. Because that is the headway they are getting in terms of leverage. So the more co-lending I do, the lower would be the leverage, and obviously my earnings also wouldn't be really an apple-to-apple comparison with the other NBFCs. So since you touched upon the leverage, it is not just leverage, it is in fact the entire business and the earnings and the return matrix. So when we look at leverage, we look at AUM to net worth. So that is how I am factoring for both off-book and on-book growth that is happening, and I'm looking at it from a net worth perspective. Interestingly, another important point here is that for some NBFCs, co-lending is a natural business choice that they are doing. It is that some portion of their business would be co-lending. For some NBFCs, we have seen that there might be issues with regards to raising of funds, due to which the natural choice of business would be co-lending. So here we also look at whether that particular NBFC is able to raise money from the market or no. So suppose if I give you an example of a MSME or a housing finance company, typically my loan should be 4 or 5 years if you are an MSME, 7 to 8 years behavioral maturity if you would be a housing finance company. Now, I should be having more term loans on my liability profile, but I might be having more working capital loans, because if 50-60% of my incremental business is getting co-lent, and that is happening within next 1 month, I'm transferring the loan through CLM2, then I don't need term loan, I need working capital. So here the liabilities entire profile would be different for that particular NBFC. So we look at that also, whether that NBFC is able to, are they able to raise funds from the market or no. Plus there are other things when we talk about earnings. So one is that I would be getting fee income. I would be having net gain from sale of financial assets, which kind of would be showing that my ROTA return matrix is higher than the peers. That may not be so. So we kind of look at all these return matrix from a AUM perspective so that we are doing an apple-to-apple comparison.
Very pertinent point once again, because you're also saying that in case of co-lending, it helps to mitigate the risk of asset liability mismatches, because the profile of assets and the profile of the co-lending, co-funding that are raised exactly matches. Except for the 1 month period during which I'm warehousing assets to be passed on to the co-lender in terms of CLM2. Very, very pertinent once again. Shilpa, I'll move to you and I'll ask you, when it comes to co-lending, other than the November 2020 circular, which as Bonani mentions was drawn for PSL transactions between banks and NBFCs, there is absolutely no ground rule raised or laid by the RBI for co-lending. And absence of rules may give us two possible scenarios. A, that there is no rule, therefore we write our own rule. Whatever I write is the rule, that's one. Or may mean that the size of the cake is becoming large enough and therefore there might be a situation when things become completely unmanageable and therefore we ought to have a discipline, bare basic discipline from the regulator. So is this, do you think this is the time for having a book of rules for co-lending? Or do you think we have sufficient regulations anyways? What would be your take?
Okay. So Vinod, actually I'm going to draw from two very important points that you just made earlier, which feeds into this discussion. Is one, you spoke of interest rate caps. There are no interest rate caps for co-lending models, right? But still we see it as a concern that the regulator has expressed and has taken action where they feel these interest rates are exceeding what should be, what should be the norm. Second is there is no regulatory framework for non-PSL co-lending, and a lot of the co-lending models we're seeing today are actually non-PSL. So, platforms come to us and say, how do we develop a business model when there is this regulatory void, but clearly there is a regulatory expectation. So how do we know where to draw that Lakshman Rekha which you spoke of, right? Because there is no clarity on what the regulatory framework is. I think the way to think about this is twofold. One, a lot of financial product growth has actually happened in a regulatory black hole. Because if you look at, even if you look back, a lot of the fintech regulation, for example, what happens is you have product innovation, which takes place without laws in a regulatory black hole. Once you achieve a certain critical size or mass, then regulators feel this product has generated a sufficient scale and risk that we need to step in. And then the regulations come in. But I think even in a regulatory black hole, there are enough cues you can take from existing laws for similar frameworks. And also you can take cues from the way the regulator has been reacting to various products, business models, processes. I think if we look at, if we look back, I think there are 3 or 4 focus areas that I think everyone in this room will agree has been a concern for the regulator. One, systemic risk. What does your business model mean for systemic risk? What are the KYC processes? What are the end-use requirements like you mentioned? Are you really complying with the spirit of the law, not just the letter of the law? In the digital lending sector, we saw how the RBI came up with a set of rules on FLDGs, default guarantees, because they clearly felt that that was an area where there are no rules, but it created a lot of systemic risk by moving credit from a licensed balance sheet to a non-licensed balance sheet. So you have a sense of what are the things the regulator really cares about, and I think you can always test your product against these 3 or 4 things. So one is systemic risk. The second is the consumer. What does this mean for the consumer? Is the borrower being compromised in any way at all? And then again, we come to what you spoke of, transparency, disclosure of costs. Are there any hidden costs in the product? Are we disclosing the APR? And a lot of the regulation, again, has been triggered by making sure the consumer, one, is fully aware of the terms and conditions of the product, of the pricing, and the recovery processes are in line with what they should be for banks and NBFCs. So second is the consumer is really the focus or a lot of the regulation. Recently, again, the RBI came up with loan aggregator rules, which said that even if you are a loan aggregator platform and you believe there is a certain product that is best suited to the consumer, you still need to make full disclosure to the borrower at the back end, what is happening at the back end.
So that's number two, I think. The third really is data. I think as we transact more and more digitally, we all generate much more digital data, which has a lot of uses. I mean, I think lenders can use a lot of this data to customize loan products, credit products, and understand the consumer. But I think there's also a lot of scope for unauthorized use. And this has really been a big focus area of the RBI. And I like to call it the 3 W's of data protection, right? Does the consumer, does the borrower know what data is being collected? Does the borrower know why is that data being collected? What is the purpose? And third, where is it being stored and who is storing it? So I think as a lender, if you are collecting data and accessing data, you need to make sure that you have a consent architecture in place, that your product actually, you do enough to protect consumer data, and you partner with NBFCs. For banks, they need to partner with NBFCs that have sufficient data security tools in place. And for NBFCs, they need to make sure if they are partnering with other tech platforms, data is a real big focus area. So I think while you're absolutely right, there is no regulation, but I think there are enough cues in the system that we can draw from, or that platforms can draw from, to come up with business models that are not pushing the boundary and are compliant.
Normally when lawyers speak in public platforms, they keep things vague. It helps them. This time I've seen a lawyer speaking with absolute clarity that while there are no ground rules, but there are enough cues and clues you can draw from parallel regulations and set for yourself a set of rules that you would like to abide by. Before I come to Vidushi on a very sensitive question, I'll open up what the question would be, but let me ask audience, are you all wanting to interact with the panelists here? Are there people who are going to ask questions? One hand, that's one, just one. Any other question? Because I'm trying to time that. Since we need some kind of a hard break here, so I'm just trying to... No, please don't pass on mic just now. I'm just trying to assess how many audience questions would there be. I've got one. Anyone else? No. Okay. So I'm now asking the question to Vidushi about a little sensitive question on applicability of GST. Now, the context of the question would be that there is a rate of interest that lenders expect, the funding lenders. They expect 12, 13, 14%, whatever. And the NBFC is charging good 26%, therefore that leaves a spread of 12%. Is this 12% in nature of service fees? If the answer is yes, then the service fees are chargeable to service tax. Is this 12% in the nature of interest on your 20% share? In case of interest, there is no question of service tax, but then the GST authorities would like to take a view that after all, the originating lending partner is providing services to the entire partnership and it's getting compensated for those services, and therefore there is a service tax element inherent. Vidushi, what's your take on this? Is an unresolved question though, but what's your take?
Like you said, very, very sensitive topic. Tax में जैसे means it's not a question, but एक भी पैसा ज़्यादा देना पड़े तो बहुत चुभता है. Individual बोलो या corporate बोलो. And when we are talking about co-lending, see, co-lending, the phrase itself means we are lending together. We are partners. Bank, NBFC, both are partners. We enter into an arrangement where if I am an NBFC, I am taking the responsibility to say, recover the loan, okay? Or some other roles I am playing. It's not a service. And the extra interest which I am charging is charging because I am taking a lower priority. So where is the service coming from? It is actually interest. Vinod, you were saying that there are various other avenues of generating income, but this is not one of the avenues. This is pure interest. So there's no point of charging, calling it a service. It's one of the roles or responsibilities that NBFC is taking as a partner in co-lending. But whatever said and done, I know lots of NBFCs have made representations, associations like FIDC have made representations, but until now there is no positive response that the industry has got from the tax authorities. I can share, and we were also discussing before this session that what is a workaround. Workaround is that, NBFCs are trying to just call out particular amount, reasonable amount, say 1 lakh is actually a service fee, because tax authorities are not cooperating, if I may say that, you know. So we'll just say that, okay, 1 lakh is the service fee, you charge GST on this. Because it is not GST, but how to work around when the authorities are not cooperating, they are not looking at it the right way. So it is absolutely a sensitive topic.
When taxpayer and tax collector, there is a question of cooperation. घोड़ा और घास के बीच में दोस्ती कहाँ से हो सकती है? Right. You are right, unresolved question, but quite significant, because one would probably call it interest if the share of the originating co-lender was subordinated. But like most arrangements have, the share is, at least theoretically, the share is pari passu. And therefore, on a pari passu share, I still get 40, whereas the other co-lender is getting only but 12 or 13. I think this is a question of how do you document, how do you establish the entirety of transaction. So before I open up to the audience, I have one quick observation. Once again, I think the point we all need to understand, and I think all the panelists have said this very clearly, that while there is no set of rules for non-PSL co-lending, most of the co-lending which is happening is either non-PSL or is happening between banks and NBFC, and therefore there may not be clear set of rules. But absence of rule doesn't mean there is absolutely no ground rule at all. Like the lawyers on the panel did mention, that you need to understand from the spirit of the regulation. And these days, RBI is not going simply by letters of law. Time and again, you would have heard them saying, comply with the regulation in letter and spirit. Quite often, the letter may not exist. But comply it in spirit. Understand the spirit from wherever you can get it, but comply it in spirit. I'm not looking at those spirits which probably might, invigorate your evenings, but they would like the spirit to be followed of the regulation. So that's the essence of all regulations. I think co-lending has had a tremendously good time. I'm hoping co-lending will continue to have a very good time, because it's something which is partnering of differential strengths. There are entities which are good at funding. There are entities which are good in disbursement. There are entities which are good in servicing or managing. There are entities which are good in digital lending. So if people have differential abilities, they ought to come together. That's the beauty of the system. People should capitalize their own differential strengths. Economically, there's absolutely no argument against co-lending. I completely say that there cannot be an economic argument against co-lending. The only question is, where there is a risk, there must be capital. And therefore, if the risk is being taken by one of the partners should accordingly have allocated capital against the risk as well. Let's open up for audience questions for at the most maybe 5 minutes if we have questions. There was somebody, sir, you wanted to ask him? Anyone else who is wanting to ask question, please keep your question ready, because we'll probably have a hard stop in next about 5 minutes. Yeah. So is the mic working? Right. So maybe can I give a brief answer? With the permission of all, can I just give a brief answer to that? Because typically when you do a loan agreement or sanction letter, you say that we intend CLM to the co-lender comes subsequent to origination. So always that's why it's called discretionary co-lending. So we do say in the sanction letter that we will try to bring ABC co-lenders, and once we bring the co-lender on board, we will intimate to you the name of the co-lender. So that's consent to bring an unnamed co-lender is taken from the borrower. Subsequently, the name is indicated to the borrower. The borrower's consent is therefore deemed implicit in the terms of sanction itself. That's the only way in CLM2 you can actually take borrower's consent. Any other question from the? It's money. That's right. Yes. Subsequent, once you find a co-lender, then you give an intimation to the borrower that as per clause number whatever of loan agreement, we have brought, let's say, Navasamriddhi as our co-lending partner.
Yeah, and if I may just add, like he was saying, it's a prior consent. You are already taking that consent that I may transfer it, or CLM2 model I may imply, and I'm taking your consent straight away. Sure. So it's a prior consent, and consent has to be really very stringently looked at, especially with the data protection new laws also coming in, regulators looking at it very stringently. So we should all make sure that consent framework is well put in the documents.
You are right.
That's right. So sir, in case of I'm saying subsequent communication is very important, right? But prior sanction in CLM2 is impossible. CLM2 is always discretionary, which means the co-lender decides to take a loan only subsequent to origination. At the time of origination, the co-lender is not even there on scene. So because it's discretionary, therefore the name is communicated, but anonymous sanction without the name of the co-lender is taken at inception, as Vidushi points out. Any other question from the audience at all? At the back, there's a hand going up. Yes, please.
Hello all. I have actually a couple of questions. One is with respect to CLM2. People say CLM2 is akin to DA. So is there a requirement of getting a legal opinion every time we can do a DA with the CLM2
I'm sure
partner?
there are interested parties here. They'll say yes.
So,
do you want a disinterested answer or interested answer?
I want a disinterested answer. Also, can we do a master DOA where we are doing?
That's the answer, ना? आपके पास आंसर था, कंफर्मेशन जा रहे थे क्या यहाँ पे?
नहीं, मेरा एक दूसरा क्वेश्चन है कि अगर मैं मास्टर DOA कर लेता हूँ and on an ongoing basis, I am doing, on a weekly basis or a fortnightly basis, continuous basis पे CLM2 करता हूँ. So that is possible. So I make a master DOA of say 100 crores, and every week I am doing a 20 crores CLM2 transaction. Is that possible?
Well, the lawyers would probably want to answer. And conflict of interest. And मैं कर दूँ मैं disinterested party वाला answer. You rightly mentioned. I think it's perfectly okay. Have a master deed, which is a kind of envelope agreement that within a particular range will keep on assigning. As and when you assign, just do an intimation. So you don't need to do a so-called assignment agreement every time. In lots of so-called replenishing transactions also similar structure. Bankers have long been using the same structure for loans against shares. Shares are replaced. They don't do a pledge every time. They have a master pledge agreement under which shares are replaced every time. So this is similar to that. There'll be, the envelope agreement should provide for subsequent transfers within the particular boundary, within the particular range that you fix. That should serve the purpose.
Thank you so much. And one last question, sorry. So there is much clarity available on the CGTMSE guidelines. You can do CLM.
I think RBI has come up with one clarification now.
So I am saying lot much clarity is available with respect to CGTMSE, assignment of pool, or CLM2. But there is not much clarity available with respect to CGFMU. So is it possible to assign pools sourced under CGFMU under CLM2 or DA transactions?
Would any of you would like to take this or? Okay, so my take would be that any loan, whatever be the underlying security or guarantee, once you bring a co-lender, the benefit of the entire security or guarantee goes to the assignee. That's the basic law of assignment, that whatever was the security, guarantee, collateral, benefit, whatever was available to the assigner will pass on to the assignee as well.
So same holds for CGFMU
that
as well.
Holds true for any guarantee, be it a loan level guarantee or even a pool level. For example, if let's say the pool is guaranteed by let's say an FLDG, will the benefit go to the co-lender? Answer is yes. The benefit goes to the pool and therefore inures to the co-lender as well.
Thank you so much. That was very helpful.
Thanks. It's been wonderful. Last 1 minute to each one of you. Last 1 minute, because we need to be stopping at next 5 minutes. But Bonani, last 1 minute.
Just a closing remarks, right? Yeah. So I think I agree with Shilpa that ultimately none of us need a regulator if we know what's the right thing to do, and we all know what's the right thing to do when we are doing business, that is taking care of the customer or responsible lending. If we do that, the regulator will be out of his job actually. We do it the right way. Sometimes we do need advice, do need a parent, right? But mostly we know what to do. And to sustain ourselves and to sustain this entire sector, it has to be customer first, compliance first, it has to be responsible lending, it has to be ESG at the core. That's all. Thank you so much.
So my closing remarks would be that keep it simple. Do all the compliance, due diligence, KYC, onboarding of customer norms, And just keep in mind that this is a book that you haven't acquired, treat it like a book that you have created.
I think, you know, one way where the industry can really come together and solve this problem is self-regulation, like you were talking about, and the SRO. And I think the SRO is a very good platform that can actually be leveraged, which will act as a bridge between the regulator and the ecosystem where there is no regulation. And then that kind of gives the industry the ability to drive regulation and the direction of regulation in some sense. So I think it's a very powerful tool that can be leveraged. It has a lot of potential.
Excellent. Ashish ji and Jyoti ji, I hope you're listening. Very important task for you all. Go ahead, Vidushi.
I would say there is nothing to be scared of. I feel that the industry is very scared of generally because of the actions taken by the regulators. But we have to be mindful, like we discussed, if we all want to follow the law by its spirit, we will do the right thing, and there's nothing to be scared of. Co-lending is here and it will strive.
Excellent. So my closing remark would be that in the end, everything is fine. If it's not fine, it's not the end. Thank you very much.
Thank you, sir. So we would like you to stay on the stage for a bit. I would now like to request our moderator to felicitate our panelists, beginning with Miss Bonani Roy Chaudhary, MD, Nab Samruddhi Finance Limited. And now a moment to capture. Sir, the goodie as well. Our next speaker, Miss Geeta Chainani, Associate Director, Care Ratings Limited. Oh. Okay. Apologies for the confusion. Miss Shilpa Mankar Aluwalia, Partner, Shardul Amarchand Mangaldas. Miss Vidushi will take it. Thanks, Rupa. And now, Miss Geeta Chainani, Associate Director, Care Ratings Limited. And now, none other than for Kothari sir, I would like to call Mr. Ashish Agarwal sir to felicitate him. Please bring your hands together, everyone. Freezing the moment for session 3, sir. To remember. Thank you so much everyone for being a part of this summit. It is time for us to move on to our final session of the day. Our fourth session is how LSP models can enhance PSL lending. This session will explore the potential of loan service provider models to facilitate priority sector lending and drive inclusion. Our speakers will offer insights on how to maximize these partnerships for impactful results. To shed more light on this, I would like to invite our panel on the stage. Again, beginning with the moderator, I would like to invite Mr. Bhavik Vasa, founder, GetVantage. A huge round of applause, everyone. Mr. Bhavik is a seasoned entrepreneur and two-time founder, honored as a Business World 40 Under 40 Achiever and FinTech Asia 200 Fellow. With over 18 years of international experience across fintech, digital finance, and startup ecosystems, he established GetVantage and Get Growth Capital, India's first capital getaway and embedded finance and growth capital platform dedicated to supporting emerging small businesses. We welcome you, sir. Now, our panel of speakers, beginning with Mr. Anil Pinapala, founder and CEO, Microfin. He is a visionary fintech entrepreneur with over 20 years of experience, focused on innovative solutions for non-prime borrowers. He pioneered the first cloud-based lending platform in the US and now, as the founder of VVFi, is dedicated to creating accessible credit options for underserved markets. We welcome you, sir. Our next panelist is Ms. Riddhi, co-founder LXME. Ms. Riddhi is the co-founder of LXME and University of Warwick alumna. Has over 15 years of experience as a 2x founder in fintech and e-commerce. Through LXME, India's leading financial platform for women, she promotes financial independence and has earned notable global accolades. We welcome you, ma'am. Our next speaker is Ms. Tanya Chadha, Chief Business Officer, Ugro Capital Limited. Ms. Chadha is a distinguished leader in digital business and strategic alliances, currently serving as Chief Business Officer at Ugro Capital, where she leads digital business strategies and key partnerships. With over 19 years of expertise in financial services and technology, Ms. Chadha has previously held senior positions at IDFC First, Kotak Mahindra Bank, Ratan India Finance, and MS Swipe. Known for her strategic focus on revenue growth and operational efficiencies, she holds an MBA in Finance and Strategy from the Indian Institute of Planning and Management. We welcome you, ma'am. Our final speaker for this session is Mr. Deepak Jain, co-founder Flexi Loans. He holds an MBA from the Indian School of Business and is a chartered accountant with over 11 years of experience in investment banking and management consulting. Previously working with Access Capital and JSW Limited, in 2016, he co-founded Flexi Loans, a digital lending platform focused on providing financial solutions for MSMEs across India. Under his leadership, the company has disbursed over 7,000 crore, empowering more than 50,000 MSMEs across 2,100 towns through a fully digital bench-free model. Recognized in Fortune India's 40 Under 40 list, in 2022, Mr. Jain continues to drive financial inclusion, making accessible financing a reality for underserved MSME nationwide. We welcome you, sir. Now I would like to hand over the mic to the moderator of the session.
Thank you so much. Thank you. Okay, so I think we are the last session for the day. And the only request I'm going to have my co-panelists is, let's make this interesting. Let's talk a little bit of tech. We had a session before this, which was a lot to do with co-lending and regulations and a lot of legal jargon. But we are not going to make this session any easier. I think thanks to the regulator, we have so many more acronyms coming out every day, right? Thanks, you know, the name or the title of this session is also LSP, PSL. So, you know, on that note, I have to thank the RBI for DLG, which gave birth to LSP, for the PSL. You know, having started on that humorous note, let me also start with some optimism. I'm very privileged to have co-panelists here who are leaders and founders who've been building fintech and tech-driven businesses. We all are also regulated, have NBFCs, are working with NBFCs, and there's this nice confluence of technology first, financial services and lending. And that brings me with great optimism. As you heard, yes, I love to be introduced as Bhavik Vasa, founder of GetVantage. But even more, I love to talk about the fact that I am a part of the Indian fintech industry, because we're supposed to talk about what is going to be the use of AI, ML, and other acronyms, and the use of technology in increasing or being able to exponentially grow lending in this country. But when we talk about AI, which is the buzzword, yes, the Western markets and the US has given AI to the world. But as a fintech founder, what makes me the most proud is that after the India stack, we gave UPI to the world. And having already digitized payments, I'm also even more proud to talk about what we're going to do next in digital financing with giving Open to the world, Open Credit Enablement Network. And I think it's really these interoperable networks that brings the ecosystem together and really creates inflection points. And we're going to talk about these inflection points because for a lot of years and decades, we've heard that MSMEs, agri is considered priority sector. But fir bhi, why is there still such a large credit gap? Right? Let me ask all of you guys one small trivia. Let's see if all of you all are still awake and active. 110 million. Can anybody tell me what does that word mean? What does that number mean? 110 million. MSMEs in the country? Itna bada time nahi hai, Deepak apna. Hai? Sorry. Anybody else? 11 crores. That's a good translation. Yes. We need to Indianize our numbers also. Absolutely. The employment that the priority sector, 110 million is the employment generated by this sector, and hence the importance of this sector to the Indian economy. We have big aspirations, sir. From being a 3 trillion to a 5 trillion to a 7 trillion economy, right? And we've always had these small businesses as the backbone of our country. And so here today on stage, I'm even more proud. I have my colleagues, Rahul and Priya in the audience, to really announce that priority sector is taking front and center. This segment is getting all the attention, right from the government to the ministry to the regulator to all of us as the ecosystem players. And a great initiative that is just been launched called the Priority Sector Lending Association of India, PSLAI, a much needed body to really get 5x growth to this Indian economy and generate that much of jobs, wealth, and overall creation. So on that note, I'm really going to get started by really bringing Deepak to share a little bit about his journey, a quick background, Deepak, on Flexi loans, but more importantly, also touch upon from being a very early player, as an early fintech, NBFC, how have you seen things evolve over the last few years?
Hello. Thank you, Bhavik, for laying the whole how things have evolved and why priority sector is super critical. To some extent, what the gap we saw in the priority sector is the reason why I left my investment banking job and started Flexi Loans in the first place. I'm born to a jeweler and a money lender. As I grew up, I saw a lot of entrepreneurs coming to our shop and give us gold and take money. And they would not mind paying 3%, 3.5% interest rate. They give one currency, they're taking another currency. And yet they are, and the LTV, the other currency which was given was also lower than the LTV of that gold which was given. So, saw that. Then as I was doing a lot of IPOs and QIPs for banks, saw the level of underpenetration in terms of current accounts being opened by many of these MSMEs, the number of loans being given to these MSMEs was super low. And everybody, including Mr. Vaidyanathan, I did the QIP for Capital First, they so wanted to go after this segment because it was super underpenetrated. So we said that, okay, why is this underpenetrated? So this is a small trader, wholesaler, which is the backbone of Indian economy. They on an average generate 5 to 7 employment, like, each of these retailer or trader will generate employment opportunities for 5 to 7 people, and yet they are borrowing from money lenders. So why? So the reason was the documentation required back then for getting an MSME loan was super, super complex. For getting a 5 lakh rupee loan, one, it was not called business loan. Majority of the banks called it a PL. Anything below 7 lakhs was called PL. It was not called a BL. And I'm not talking about, I was with Access, spoke to Rajiv, back then. It's called PL. It's not BL. The documentation was exactly similar. If you are an entrepreneur, you need 3 years ITR, etc., for a 5 lakh rupee loan. Not this guy, he'll have to run to his CA for a 5 lakh rupee loan. He's like, I don't want to waste so much amount of time. So let me go to a local money lender and borrow. That was the answer. So we saw this opportunity. I did a Reiki. I traveled all over the country along with my co-founders, met a lot of small traders, associations, and saw there was a massive, massive opportunity. So what we came out back then was flow-based lending. We said, okay, you just give us your bank statements. That's how we'll figure out your ability to pay. We'll look at your bureau and figure out your willingness to pay and give you the loans. We'll keep it absolutely simple. 2 documents, your KYC, and we are sorted. We created those journeys. Now, the googly our way was, none of these entrepreneurs had PDF bank statements, or they couldn't download PDF bank statement. So the industry has evolved significantly in the last 8 years, thanks to amazing work done by many of the PSU banks here as well, including SBI, etc., where they made the apps, the bank statement apps, so easy now to download and give it to us, to an extent that almost 65% of the bank statements we get today, and we are disbursing roughly 350 crores a month, 60% of the bank statements we are getting are through account aggregators. So the industry has evolved a lot, but I remember calling these customers and telling them that, okay, why don't you go to the nearest branch and I'll speak to your branch manager to help you get the bank statement to us. So those are the kind of days what we have evolved from. To NASH, getting those NASH printouts and getting those NASH forms filled. And the NASH registration is to take anywhere between 15 days to 60 days. Some of the PSU banks it took 90 days, and by then you collected 7 checks, 8 checks, etc., etc. So the industry has evolved a lot, but yeah, the opportunity was massive, and the impact which was available for founders like us was massive. Just fast forward 8 years, the numbers were mentioned. We've disbursed 7,000-8,000 crores in loans to micro entrepreneurs, and one thing which I'm extremely proud of, we stayed true to our mission. 75% of the loans which Flexi Loans is giving is in tier 2, tier 3 towns. With a single office in Bombay, we've disbursed loans in almost 2,000 plus cities and towns across the country.
Lovely. So branchless is possible and getting only more possible in a country like India now. I'm going to come back to you on another question, Deepak, but let me bring Tanya in quickly. Tanya, we're talking about LSP, we're talking about priority sector. You represent UGrow, which is possibly the only MSME-focused listed player in the market. You all have powered a lot of collaboration. Talk us through how you see the evolution of this priority sector, how large is it, and how are you penetrating it through partnerships, through collaboration. One small disclaimer, we're great partners and collaborators, so they've been great, and I vouch for that, but talk us through how you've seen this model evolve for you as a very focused, only business lending player.
Thank you, Bhavik. I'll take the pleasure of saying that it's been a pleasure working with you. And I'll take our example to explain how, the partnership model has changed way for lending to MSME segment. The value that you add as a partner today to a lender is your ability to understand alternate data, the ability to understand business cycles, which allow us today to take a large unsecured exposure to an MSME, SME segment, which was not possible earlier. Apart from a certain ticket size, any SME would want a higher loan. Everybody used to ask, property hai? Ya gold rakh sakte ho? But gone are those days. And this is how we have evolved, and thanks to you as a partner and the entire world of collaboration, where each one of us today adds value and learns from each other only to cater to the segment.
No, I think we're being able to together create this mindset, and I think one takeaway for everybody in this room, and I would like to reiterate what Deepak and Tanya said both, gone are the days of traditional concepts of collateral and secured, right? Having machinery, having a piece of land was considered to be collateral. I think a lot of us now, as fintech first, as players using real-time data, we really think that it's this real-time data and live monitoring that's the new security. That's how we need to redefine the term secured and collateral. And at the same time, I think we've touched upon cash flow based, right? How do you really understand the health of a small business? Not by a rear view mirror of the last 3 years of their performance, but as Deepak, you said, what is that cash flow of how he's getting his cash flows, how is he getting his monies in his bank account? And this cash flow based financing has to take front and center if we have to be able to close that gap of the need for credit and access to credit. And we've seen some of this evolve in the personal lending space as well. And so, Anil, I'm going to bring you in. Please tell us a little bit about your journey, your business, and how you evolved from looking at personal lending to now business lending and MSME lending.
Thank you, Bhavik. Just a quick background about myself. I spent 15 years in the US subprime lending space before I moved back to India, looking at the opportunity that India presented. And there is a large unserved and underserved segment in India. And I keep saying this to everybody, the subprime segment in the US is a segment of hopelessness. In the sense, everybody who had a lot of credit, made bad decisions, is beaten out of the credit system, is subprime or non-prime in the US. In India, this is a segment of hope. This is a segment of opportunity. The subprime or the non-prime borrower in India is a borrower who never had the opportunity to get formal credit and never had the opportunity to grow their personal life or a business. So that's the shift I made from hopelessness to hope. And that's what drove me to come back to India and start Vivify. Obviously, our first blush with offering credit in India was with personal loans. And there is a huge underserved and unserved segment on that side, even among salaried professionals, which was larger 6 years ago. And is continuously getting bridged. But when we started out our business and we started addressing these consumers, we started to look at our book, and there was a large self-employed book in it. People who were coming to us and applying for loans, and we were primarily, our product initially was called Flex Salary because we wanted to kind of give earned wage access kind of a solution to our consumers. But then we realized 20-30% of our consumers are actually self-employed. They are, I'll throw one more acronym, OPEs. They are one-person enterprises. So they have their own cash flows through which they are financing their businesses, and they didn't have access to credit. Their only access to credit is a local money lender or somebody. And so they started to apply when new age lenders like Deepak was mentioning, we all came into place and we started to look at cash flows. We just found a way to lend to these consumers. But we were still lending to them more like an income for an employee. And we realized if we really have to touch and improve the credit to this segment, we have to start treating them as businesses, as I said, one-person enterprises. And I will add another alphabet to the MSME, which is N, which is the nano entrepreneur. So these are the customers we are focusing on. And you said we have to look at cash flow. The beauty about cash in India today is it's not cash anymore. It's all digital. It's all UPI-driven transactions. And Deepak mentioned 60% of his business is account aggregator driven. Almost 75 to 80% of our business is customers giving us access to their bank statements through which we are able to analyze their digital flow of cash, through which we are able to underwrite and offer them credit. And if you move a slightly up the segment, you can triangulate that with the GST invoices, plus the credit bureau data wherever it is available, has created this powerful flow of data that can now be leveraged to offer credit to a large segment of Indian population which has traditionally been left out. And that's where in the last 12, 18 months we have focused, we have built tools and customer segments and offered them credit. So, I mean, we are, I'm the oldest on the stage, but we are the youngest business lender here. And we are here to challenge the, obviously the traditional banks and all, but also the incumbents. And I see Deepak and Tanya as the incumbents. And we would like to challenge them and offer solutions to segments that are not being serviced by them as well.
No, I love that you're throwing the challenge, but I think the challenge here is really for all of us to be able to collaborate, because I think we all are now starting to talk the same language. And I really urge a lot of bankers, large wholesale lenders, if you're in the audience, please start internalizing what you're hearing us as sourcing partners, as LSPs. And our role really is triangulation of data, as Anil said, right? Can we really take real-time data of GST, bank statements to see cash flows, and one more digital source of revenue, right? And you really get the real health of that business. The power of this triangulation of data, looking at cash flow-based financing as an alternative to more the traditional secured. I think that's what we are challenging, and that's what we are fighting all against. And with that comes this another interesting sub-segment under PSL, right? We talk about nano entrepreneurs. Anil, good you brought that up. You know, I was with, spent a lot of time with the ex-chairman of SIDBI, and it's also good to see someone like SIDBI also really talk about and highlight and focus on saying, we need interoperable networks like Oaken to be able to drive even access to credit to these nano entrepreneurs, these gig workers that we are seeing take up shape in our economy. And amongst that, of course, is our women entrepreneurs. Riddhi, you have to come in, tell us a little bit about the business, how you all have evolved as a platform for women, and where are the differentiated areas that these nano entrepreneurs, these women entrepreneurs, these micro industries really need access to credit and capital.
Thank you, Bhavik. So it's really an interesting conversation. I think we've touched on some amazing points. So I'm going to just take one step back. Firstly, priority sector lending, right? We think it's underpenetrated, obviously, and it can create huge impact. MSMEs, like we discussed, in number are huge, and the employment it gives is huge, right? That's why it's priority sector. But this perception is also there that it's a niche sector. So whenever we talk about women entrepreneurs, or opening up credit to this sector, people are like, oh, it's great you're servicing that niche sector. It's not a niche sector. 50% of this country is women, and the other 50% is given birth to by them.
No, sorry, I have to humor this, because I'm sure Deepak has heard it. I keep hearing a lot. You know, we keep getting investors asking us, "Tumhara TAM kya hai?" And we're like, credit and TAM and MSME and women.
Exactly.
I think.
Exactly, right? So there's obviously huge scale, huge impact. It's just, it's not a low-hanging fruit, because in lending there's mainly two things, right? One is getting a person to come borrow from you, and second is getting them to pay you back, right? And women are not part of traditional platforms or even modern platforms. Of course, they're not going to banks because they're scared to take loans. They don't know how to apply for loans. Even the newer digital platforms, though we are 50% of the population, increasingly working, increasingly homepreneurs, gig workers, we're not going and taking loans, right? And that's because they come with a very different mindset, different socio-economic conditioning that needs a different approach to first get them to apply for loans, right? And that's where a Lakshmi, so we run a financial app called Lakshmi for Women, and we started as an Ask, Learn, Invest platform, a wealth tech platform. But increasingly women came and told us, we love what you're building, we trust you, we want to do everything here. We want to borrow on your platform. We want to do banking, payments, everything. And that's how we've evolved into a banking, like into a rather money app for women, right? And the first is getting them to come and be comfortable taking a loan. There's a lot of fear, right? So generally when women are taking their co-borrowers, when they come as a co-signee because the man is not getting a loan, and we all know they're great borrowers. They pay back. There are no NPAs. They're very disciplined, you know, in every actually aspect of money. They're great savers. So that's where Lakshmi comes in. We're a platform that is attracting women to come in, right? What we also do is then tell them why actually taking a loan is important. Generally, there's like, a credit card is great, it's a sign of prestige, but you've taken a loan, oh gosh, it's negative. Especially women have this fear. So what we say is, no, actually it helps you build a credit score. So it's not necessarily a negative thing. So we try and rework firstly that socio-economic conditioning in a platform where women already are feeling safe, already trust us. Right? So that's one area where I think Lakshmi and platforms that are catering to women and their unique needs help. The second thing is actually understanding, one is that ability to pay, in understanding whether you'll get your money back. One is ability to pay, second is intention to pay. Right? Women, whether they have the ability to pay or not, will pay you back. I mean, it's just they have that fear, they have that innate discipline. So how do we understand that intention to pay and convert it to what a regulated entity needs, right? And that's where platforms like us help, right? So intention to pay, everyone knows women will pay, they're very disciplined, all of that. But they might not show the ability to pay on paper, right? That's when alternative data on platforms like us comes in. What are the blogs they're reading? What are the live sessions they're doing? What is the learning they have? Do they have mutual funds? How disciplined they are in their SIP payments, right? So there's a lot of alternative behavioral data that we can use. Like we said earlier, there was only kitta salary aa raha hai. Now we're looking at account aggregator. Luckily, we've got GST. In the middle, there was social media, which I always question. But something like how good they are at investments, how well are they planning for their children's education. So we have to enable, loans. And a lot of women, when they become homepreneurs, when they start these businesses, it's actually to improve their family situation. It's to earn enough to be able to give their child the best education, right? So if we enable credit for them, we're improving their business, but we're also improving the entire family's standard of living and the economic opportunity they're going to get over the next generation, right? So using alternative forms of data that women have, that would not be a GST, but would actually be how disciplined she is in her savings and investments and FDs, for example, is what platform for us enable credits for the women's sector.
Lovely.
Initially, for us, because we started with the e-commerce, we started embedded financing as we call it today. We used to call it B2B2B back then. And we started like e-commerce, payments, all these guys.
Yeah, I had to add a word for going and raising money after you. Na?
So when we were doing e-commerce, and I vividly remember talking to one online seller, like because initial days, all the founders, we'll talk to customers a lot more than we do today. I remember talking to this customer and telling her that, we will not need your father or your brother as a co-borrower. It's okay, your basis, your cash flows, you're eligible for a loan, and why don't you apply? And it was a game-changing thing for her.
No, I think what Deepak and Riddhi, what you're highlighting is alternative forms of data, right? And not just social footprint, but actual other financial data and financial footprint, as we call it. And I think the emergence of that is what the role the LSPs will start playing, because we clearly know there are a lot of lazy balance sheets out there, right, that need to find deployment. And I think that's the role we play. But here I'm going to change this up, and I'm going to ask all of you all to be honest, including all of you all. We heard about women entrepreneurs intend to pay, or the women's intent to pay. How many of you all, or हम सब ने शायद, because we are all in the same industry, कौन सी ऐसी application या deal आई थी जब ultimately underwriter ने भी बोला कि कुछ नहीं, take the mother as the co-borrower, take the wife as the co-borrower and approve कर देंगे. Raise your hands if that was the last resort where we said add the mother or the wife as the co-borrower and we will disburse this loan. I think we have evolved from there on.
I just want to add something while you were explaining, how disciplined women are and how it adds value. As lenders, we have also seen them as risk mitigants, which you have just very rightly brought out. Ki get a woman on the structure, and yes, the loan will be approved. And that's the power.
No, and what's evolving is the real role of LSPs like us is to build programs with unique data, with unique regional strengths, with unique strengths on sectors. And I can tell you at GetVantage, we run a very women-focused corpus, funding women founders, and the data says it. We co-lend a lot of that with UGRO. We've had negligible, and I really can't even put it in a percentage, negligible default in the women portfolio that we've been funded. So data backs it also. It's just not a human bias, so to speak. I think one of the aspects to bring about is, great, there is opportunity, there is new technology, there is new data. But some things have or haven't changed. For this industry to grow, not only demand and the technology and the underwriting has to improve, but supply has to improve. Deepak, I'm going to ask you to come in and, Tanya, then, please add some color. Challenges of co-lending. Has that been solved? We heard this panel on co-lending, NBFC with bank, abhi bhi khali traditional products mein hi chal raha hai, right? Easy products, same file going through the same DSA to 5 banks, then co-lending. But what has not changed and what has changed, Deepak, in co-lending? And then Tanya, please chime in.
So, couple of things. See, the young tech-led NBFCs will always be slightly more agile than slightly, like for example, Anil, you rightly mentioned, if you're launching something, you will always be more agile than where Flexi is, in its journey. And thus, banks need to have that open mind that, okay, if they are building something, let's look at that for a couple of cycles and then back them. That's still not changed in a significant manner. For us, we first partnered with a bank, back in 2017. I don't know how many people were doing co-lending back then. And 3 months into the partnership, we spent almost 6 months integrating with that bank. 3 months into the partnership, we realized it's not working. We need to change gears. And we went ahead and partnered with 3 NBFCs. And that's when the co-lending scaled for us. So the micro or the nano entrepreneurs, where the real impact is, while the government of India wants banks to go out and do those lending, except now under CLM2, under CLM1, it's very difficult to scale it with banks even today. Because of the kind of processors, the kind of filters they'll use, etc., etc. The second big letdown is, even for PSU banks, that this whole mindset that unless you're rated A, where unless you're as capitalized as UGRO is, you're not rated A, then they will not even partner with you for co-lending. So PSU banks is where a lot, I will not call it lazy money, that's where a lot of money is there. And they need to deploy it because the treasuries are so big today. They're sitting on massive treasuries and money out there to be deployed. So for them, and unfortunately even the people who are running the co-lending, they want to partner with people like us. But there's a diktat from the top that it has to be rated A. And until that happens, they'll not partner. So to me, that one big game changer decision has to come, where if you have a fantastic track record, your track record of credit costs, say over 3 years, 4 years, 5 years, the PSU banks need to start partnering with more younger NBFCs. For flexi loans, it will happen soon, but more younger ones also they need to partner. Otherwise, the real impact which co-lending can make will take a lot more longer to happen.
Tanya, your thoughts?
So, UGRO is a lender which does both downward co-lending as well as onward co-lending, and I had the downward co-lending. In fact, I always tell this to everyone, we taught co-lending to the market. We were, I think, the first ones who started this from our downward co-lending experience. And the biggest USP, and one thing that we have also learned over the years is that if I ever tell a partner to change their sourcing because I understand only ABC, there is no point even signing up the document. We will end up signing contracts and we will keep, filling up our cupboards. We will never start business, we'll never scale up. The entire idea or the entire purpose or essence of co-lending is to understand the business of your sourcing and servicing partner. And then value add by giving capital, guiding them. Please understand, if I look at, we have a lot of regional NBFCs as partners, trust me. And we do a lot of macro nano loans. My ticket size today varies from a 50K to a 5 crore. So we cater to all kinds of SMEs. So, if I tomorrow tell them that no, I can only look at partnering with you, one, when you get a rating, two, when you only get me a banking GST customer, three, when you get me a business which has minimum 3 to 4 years of vintage, why will anyone even look at YouGrow as someone who can value add to their business? No one. So this is the skill we built, and we built over the years. We understood this. We partnered, where we started to drive our, sourcing patterns. It never scaled up with us because he's not come to me to change his style of working. So this is one of the most important, learning, and something that today we implement across the partner is that understand their business, see what value add you can do. Today, public sector banks have, annual targets to fund to startups. And trust me, Bhavik, you are, one of the best engines to feed that. But we are trying to get that understanding. But, that is what is needed.
No, I agree. I think, like Deepak, you said, and Tanya, there's a lot of capital out there. I think we just have to be able to change the lens of how it's seen. In fact, so much so that the technology is available. Today, as NBFCs, as tech-enabled NBFCs, we are able to do live co-lending. And it's not even just fancy tech. I don't want to throw around words like API and STP and AI, ML. It's as simple as saying, when we raise equity, we can have one document with multiple shareholders coming in. Why can that not simply happen even in a digital disbursement for a small ticket size loan? Right? I think it's just these basics that I am sure the industry and the ecosystem is going to work together to have to take it up and solve for it. I think very quickly and in a sense of time, what I want each one of you to be able to quickly highlight and share is give us a wish list or two, right? And we don't have to get on the regulatory and compliance side, because as industry players, we'll always have complaints. But I think what I want to hear is basics more important yet to make the market happen? Or are we using new technologies like AI, alternative data? What different ways are we being able to be more branchless, paperless, digital, and being able to collaborate? What are still that one or two top wish lists that you would want to see change to be able to take this market 5x? And for you to be able to be called an incumbent quickly, then this being the challenger. Riddhi, if you would like to go first?
Okay, so the first thing from a simplification point of view is, I think if we could simplify the whole KYC process, right? There are so many KYCs for wealth tech, then for borrowing, then for FDs. It's the different KYC.
Acha, hands up, any experts? Video KYC, CKYC? What is the latest circular saying? I'm confused.
Exactly. Then can you send the recent thing with PAN? You can't send the data, you only get it. So it's complicated, right? So can we simplify the KYC across financial products and regulators? I think that would really help. Otherwise, the journeys are very digital. It's just they're very repetitive. The second thing is what I think would really help an industry like ours. Now, obviously, I think we've recognized huge opportunity, huge TAM, huge need, huge impact. But still, at least in our lending and for new to credit, right? In us, we have a lot of new to credit. And not because they're not working, spending, it's just they've not built a credit score. I think how do we get banks and not just NBFCs to service our sector? because that will enable loans at better rates. And I think that issue is there. While we are still priority sector and we realize the impact, the rates are very high, right? So how do we kind of bridge the gap between having traditional forms for the new age sector we are looking at? How do we get banks and the bigger guys to give us rates where on alternative data? I think that would really help.
Yeah. And how you can remain a platform play and not have to get regulated but be able to work with the different REs out there.
Yeah.
I have one wish list for you, Riddhi, which is on the way out. I think I take away from our chat today, you spoke about it's sexy to have a credit card, but there is a huge downside to saying I took a loan. I think to all of us and to all of us in the room as an ecosystem, forget the word loans, lending, let's call it financing, let's call it funding, right? Let's make taking capital sexier than the old incumbent perspective. वो बैंक देते थे तो मैं lender हूँ इसलिए I'll call it lending industry, right? I'm the lender and it's a loan. No customer, no individual, no business wakes up saying आज मैं loan लूँगा. They wake up saying मुझे inventory खरीदनी, मुझे capital चाहिए. I wake up saying I need growth capital, I need funding, I need financing, right? And I think onus on us as an industry. Deepak has raised a lot of capital recently, so he has to make this happen. And no, it's, I'm genuinely sharing this as an open suggestion, not only to my panelists, but everyone who's going to take this back to their organizations. You know, mutual fund industry came together and really made mutual fund sahi hai and made it something, an aspiration. That has to be driven by us as an industry.
So we started video ads 6 months back. These are not TV ads because no point. Loan is a easy product to sell, right? You don't need to give TV ads for that. And the tagline is loan nahi tarakki samjho.
Yeah, lovely, of course. You have to change the rhetoric. Yeah. Love. And you know, it's interesting. We have an NBFC called Get Growth Capital, and our partner is You Grow Capital. And I think in itself is growth, right? I think we want to be able to together also. I was actually talking to Shachindra about it, and I said, sir, you need to fund it, I'll come with the creative aspect of it. But no, I think we need to change this and make credit sexy. You know, in the US, right, it's not considered bad to be able to say, I have a payday loan, I have capital.
I actually just want to add one thing. So you're absolutely right. Credit cards, right? The wealthy don't need loans, but a credit card is just that. It's just rebranded to make it cool. I have a cool credit card that's got a higher limit on it. So a higher loan limit. But we have made, the ones who actually need it to grow, made it sound like a negative. So spot on, it needs a rebranding as growth capital.
Priyasmita, one more line item for PSLAI. Let's make business financing sexier.
Yeah, I think a lot of good points have been brought up, and I think what Deepak said is one of the most important things in the rating which PSU banks or banks at large look for, and having a rating structure where only A and above is considered important is obviously a big hindrance to growth, and especially if you're talking PSL where a lot of capital is sitting with the banks and you are wanting to partner for co-lending partnerships and you are trying to serve segments which have not been touched so far by formal credit, that becomes a big hindrance. But also the other thing is there is also only acceptance of traditional product structures where it is the same term loan, the same monthly EMI. If you want to do shorter term loans, or if you want to do weekly or daily payments, a lot of that becomes challenging. It is in favor of the consumer, it is in favor of the business, and businesses find it far more easier, unlike individuals, to pay on a daily or a weekly basis their loan obligations. And we need to evolve our ecosystem so that we are able to accommodate those variations and are able to do, I mean, it's important to do appropriate recognition of NPAs and payments, but the product structure should not scare a potential partner. And everybody needs partnerships, and we all need to have access to good capital to grow the businesses, not ours, but our consumers, so that the traditional mindset in terms of product itself and product structure should be something we should evolve.
Perfect. Tanya, wish list?
So, before I give my wish list, I just want to quote something here. We all have heard about M-Pesa. They are very popular in South African countries. If I put the entire population of those countries where M-Pesa is, the banked population is at 40%. But the credit penetration is at 80%. That's the value of an LSP. So don't, discard without trying us.
Lovely.
So well said.
Superb. Deepak, last words.
So there is an amazing opportunity in partnering for LSPs like us on this side of the table with some of the best PSU banks out there and some of the regional banks. And because I've worked, the last two public sector banks which went public, I did those IPOs, Punjab and Sind Bank and United Bank of India. And I know the kind of presence they had there. I've worked with South Indian Bank for their fundraise. I've worked with Manappuram. So I've worked with some of the southern banks, Catholic Syrian Bank, etc., etc. So the point is that the kind of depositors base they have, the kind of customers base they have is so good and so deep, but they're not lending to each one of them. If they can partner with players like us, the kind of impact we can create on the Indian economy is just massive. I can say this, that if the collaboration which we are all talking about on the entire day today, if it goes to the real scale its potential is, with players like us on this side and PSU banks and the regional banks on the other side, no deserving entrepreneur will go underserved. And I think so that's the aim which keeps me awake in the night. That's the mission I am on, and many of us are on. So let's try and do our best for the same.
Yeah, no, that's exactly why I was looking out for the Resurgent team and Ashish ji, saying, jara PSU banks ko bolo ke rating nahi dekhe, thoda different lens laye. But quickly opening it up to the audience, any questions for the panelists? We've tried to keep this very candid. I wanted to get out the real stories, the real pains, the real challenges, the real opportunities. Please, sir.
Up to what amount do you think that the digital lending is good? Matlab, till what amount? Up to 5 crore, up to 3 crore? What is the max? What is the limit after which that you think that the digital lending fat jayega? This is the first question. मतलब
नहीं आपने अच्छा वर्ड यूज किया हाँ बुक फटती ही है हम जो भी बोले AI ML फटती है तो फटती है no and I'll just add one more color to this I think Deepak I want you to answer Anil I want you to definitely Tanya but sir amount के पहले ना एक reality input है that digital lending guidelines are great we have a proactive regulator I had promised Deepak and my panelists I won't bring this up but I can't stop myself by saying कि सर सबसे पहले तो DLG में ना कंज्यूमर और बिजनेस लेंडिंग को डिफरेंशिएट करना है क्वांटम सेकेंडरी है पहले अगर हम पर्सनल लोन और बिजनेस लोन को सेपरेट कर दे बिकॉज द प्रोसेस इज वेरी डिफरेंट एंड द ग्रीवियंस इज वेरी डिफरेंट
एंड द एंड यूज इज वेरी डिफरेंट
द एंड यूज इज ऑल्सो एक्सट्रीमली डिफरेंट सो आई थिंक द फर्स्ट स्टेप that and that's why I mentioned the PSLAI as an association as a body and all of us as a body even AFAI. We have to first be able to say यार use case के हिसाब से lending guidelines change करने क्योंकि business loan बहुत different reasons से फटता है और personal loan बहुत different reasons से बस फटता है is it for consumption versus for growth of business sorry Deepak you want to add
so Jyoti what I would like to point out is there's nothing called digital loan. Digital is just a mean. What we have done is we have changed the mode of acquisition, but your underwriting has to be there, in some shape and form, which gives you enough confidence to give that loan. Whether you're lending 10,000 rupees, you're lending 1 lakh rupees, or you're lending 1 crore rupee. So, and like you, I'm a CA as well, right? So, our money is made as a lender when the last 3 EMIs are paid to us. In the last 3 EMIs, even in a 36-month loan. So then, you need to be sure, absolutely certain while giving the loan that whether this entrepreneur will make more money out of the money we are paying him or giving him as a loan, and thus repay our loan back. And then accordingly you set up the underwriting standards. So if you get enough and more digital data, you can do a verification which is slightly lower, physically. Or, if the data which you're getting is not enough for you to decide, then you increase the layer and go out and meet that customer physically and then decide. So it all depends upon the kind of data your engine is generating and the kind of confidence your scorecards are giving you while lending. Obviously, we'll all have NPAs, the best of the physical branch-led PSU banks or the best of the branch-led private sector banks are also having a lot of NPLs in the retail book, right? So NPAs will happen no matter what, but you have to try and reduce that over decades of your existence, because we are all here to do this a decadal business. Lending is not a business of few years. These startups are forever now. If we are able to create that kind of organization, we'll have to keep learning every quarter, every 6 months, and change our underwriting method, change our models to ensure that we are avoiding the bad loans and we are giving more and more good loans.
Bhavik, can I just add one more? Deepak, excellent answer. Just wanted to add one more flavor to it. Till what point do you think you will, आपका जो calculation है, that digitally or whatever that calculation you are doing, you will not look for the collateral till the point that you have faith on the balance sheet and the cash flow lending. I'm just asking कि cash flow lending आपको लगता है कि किस amount तक do you think that the cash flow lending is good, and beyond that the cash flow lending के बाद we can ask for the collateral.
So again, it depends on two things. One, your size as a company. So for example, like Flexi Loans is say X thousand crores in asset under management, and we were a few hundred crores not many years back. The risk appetite as an entity changes. So that's one answer. You need to keep your maximum loan ticket size collateral free, unsecured, depending on where you are in terms of size of the company. The second is the kind of customers you have. So if the customer is a fantastically large MSME where you locked escrow on the cash flows, you can do a few crore in sale loans as well, the kind of business which Bhavik runs. If you're locking the cash flows where, few crores are coming into your bank account every month in the escrow account, why not? So it all depends on what kind of customer you have on the other side of the table and what kind of collateral, if not absolute physical collateral, some cash flow collaterals do you have in place.
Sir, Tanya already mentioned it also. 5 crores the players like Ugro and us are doing in either co-lending completely. Sorry? What guarantee? No. This is outside the guarantee backing program. This is purely on securing their revenues and cash flows and dropping escrows. Purely unsecured business loan up to 5 crores is happening right now.
See, this is what is, when we talk about MSME, SME lending, somewhere we always miss out on understanding the business. It is not a plain vanilla product out there in the market that today anyone can be eligible for a larger ticket size of an unsecured loan. Having said that, there are people who can be eligible for a larger ticket size on unsecured loan, as long as 1, you understand their business, 2, you have control on the cash flows, 3, we all understand that every business, we understand the concept of business cycles. To mitigate the risk, you ensure that you don't take an exposure where you end up, going through a lot of business cycles together with the customer. And that's what the value adds are today with alternate data, with the digital platforms like GetVantage. These are the value adds they provide. You may not go out in the market and source a customer and give him a straight of 5 crore loan as unsecured. But you may give it to him when it comes with the power of data, understanding of business and other variables. Why not?
Sir,
I'd
even
like
the
to add
corporate
one-
guarantee schemes haven't come down till the NBFCs yet easily. It's a very difficult process with SIDBI to get plugged in. It's not straight through. Wahan bhi rating, vintage of NBFC, the premium that you have to pay to try to collect 75%. Tanya is already smiling. She knows it's rather not going through that process and really having technology tap into. And that's what's... So the form of security we are taking, sir, is security on their future receivables. If you as a lender have first rights on the future receivables of that business, quantum is irrelevant. You can do higher quantums. If the receivable cycle, if the vintage shows that there is a very large receivable cycle and you've tapped into that channel with technology, that's what you can do. But that's the quantum that's working right now. Any other quick last question? I think we have just time for one last question. I see one hand up there.
First of all, I would like to appreciate it's a wonderful session. I would like to ask a few questions to Mr. Deepak Jain, from co-founder, Flexi Loans. Sir, what's the portfolio of your NPA bad loans? And moreover, I would also like to ask that it's quite easy being said that we have been looking at only the cash flows and taking the KYCs and we have been giving the loans. So we would also like to know about your journey of the bad loans. What the lessons you people have learned, the kind of percentages of bad loans that turned at the initial points to the day through the process you have grown. What are the kind of precautions you take these days? And since it's been said few minutes back that you have been managing from one office to collect the recovery from different kind of parts of India, I mean, what and how you people are doing that and with the NPA percentage as of now? Thank you.
Sir, before Deepak answers, please can you introduce yourself, your name and organization?
Yeah, my name is Arpit. I am from Punjab National Bank.
हाँ ठीक है. So अगर आप co-lending करने वाले तो वो आंसर देगा.
नहीं. भाविक, आपने बहुत अच्छा सेशन किया. ये NBFC की साइड से चल रहा है, तो being from the other side of the
it's a fantastic question.
ये हम जानना चाह रहे हैं. Kindly don't take it the other way around.
No. I was just making humor.
बुरा मत बनाना इसका. But we also want to learn and want to see that kind of journey transition so that there are so many things for we also to learn along with.
So
Thank you.
It's a fab question if you ask me, and I'll just add one more line from what Jyoti said earlier, that to what extent you decide digital or what are the loan sizes you do. See, as a lender, and lenders, as I said, it's a multi-decadal journey. Neither Punjab National Bank nor SBI can say that they've learnt it all. And they've been lending forever, right? So who is Flexi Loans to say that we understand the underwriting models to the T? No, we don't. But are we learning? Are we evolving quarter on quarter in a very disciplined manner? And I tell a lot of our senior management folks that we are in the most boring industry. Don't make it adventurous. This has to be the most boring industry, but you have to put your head down and say that, okay, you're getting X number of customers. Are you putting your head down and cutting the bad cohorts quarter on quarter? So, and then decide your focus. So, for example, we used to do loans up to 1 crore. And we used to do loans less than 50,000 also. Today, we don't do less than 1 lakh and we don't do more than 25 lakhs. So you decide on the segment you want to focus upon as a lender, basis your underwriting models getting trained. So that's first, generic answer to where we are saying. Specifically on the credit costs, in better cycles, we are at 3.5% annualized credit cost. In worse cycle, we are at 4.5% credit cost. And that's, our roughly our 8-year journey summarized. Now, there can be some years where the 4.5 may become 5.5. There will be some years where the 3.5 will become 2.5. But to us, our underwriting models and our real numbers are predicting on those sides. We're building it in a very, very frugal manner, where if you look at, while we have invested a lot in technology, we've had a massive engineering team since the beginning. But, you look at our capital raise and our net worth, it's more or less similar. Not many fintechs out there can say that. because we built it very frugally. You know, as I said, from day one we knew that if we can't collect our last few EMIs, we'll not be able to make any money out of this loan. I'm not selling soaps here. I'm giving a loan. I have to collect the last 3 EMIs. So we never started lending in a PIN code if we didn't have an ability to knock on the doors of the customer in less than 48 hours after the customer goes bad. So to answer your last question, that do we have the collection ability? We ensure that before we open a PIN code, we have an ability to knock on the doors of the customer. Now, it can be our employee or it can be an agency's employee to whom we have trained and monitored over the years. So we ensure that to the last mile we have ability to collect. When I was saying completely branchless, I was talking about origination. For origination and underwriting, we don't need branches. For collections and talking to agencies and traveling with the agencies, we have employees all over the country. So that's one area where we have differentiated ourselves starting 2017. We had a hub and spoke model starting 2017.
Yeah, I remember.
That has worked brilliantly for us across cycles. So I hope I've answered, because it was a longish question, so I hope I've answered most of the pointers which you
No, and I was genuinely appreciating a really good question. And I think, Deepak, kudos to you for being able to publicly answer some of these very, very sensitive
Luckily,
data
these
points.
data points are there in the rating reports.
No, it's only inspiring. It's only inspiring me to share that more openly as well. But to also share and add one more color, just like Deepak's business, as an NBFC, even we are completely branchless in origination. I have always believed, even while I built a business called It's Cash, which was a payments business before this, India mein na sir, phygital model chalega. You have to always embrace both. You cannot completely be one. It's just the percentage of how you embrace the other, right? So also to your point, sir, how we look at DLG and for business lending, digital lending, there's a huge difference. It's not about one click. In fact, I think all of us will agree, business loan mein you don't need an instant. No business wants 10 lakh rupees with a press of a button in 30 seconds. That's not their requirement. The process has to be digital. There will be certain physical elements in that process, right? Whether you want to do a personal discussion, whether you want to have an underwriter or a human eye double check what the system has given back as data, right? So there is also a throughput approval, and there is also what is known as a analog approval, which is 80% digital, but there is a 10-20% physical leg to it as well. So even when it comes to collections, sir, what I wanted to highlight is what a lot of us have put in place is जब आप cash flow based disburse करते हो, जब आपकी underwriting change हो जाती है, सबसे पहले तो if your lens changes and you'll start looking at cash flows, the value of data, and I keep telling this to people, it's not कि आपने physical document लेके scan करके उसको digital कर दिया तो digital journey हुई. Our origination journey starts with plugging in and pulling data live from the sources of the business. तो उससे क्या होता है, when your data is coming from the real source, it's not only during the application, underwriting and disbursement, but collections में it helps in the EWS. The early warning signal and that module in reality helps जब I am connected to that business's GST, I am connected to its digital streams of revenues. भाई उसका Amazon में कितना sale हुआ, उसका payment gateway से कितना revenue आ रहा है, you can connect the pipe and see that. So your EWS, your early warning signal, things will go wrong. Like Deepak said, like all of us agree, lending is a difficult business. Things will go wrong. But if you can catch it in real time and be able to take corrective measure faster than waiting for a quarter or a month end when you actually get the MIS or when you get the quarterly statements. If you're able to catch this and take corrective action, you're able to reduce the risk. That's the only thing you can do in the play.
I also brought up this point. The digital lending guidelines is very all-encompassing, right? Like if any portion of the journey is digital, which today I don't know which bank or NBFC doesn't have some portion of the journey which is digital, then digital lending guidelines apply to you and to the bank or the financial institution. So by that definition, almost all lending we do in India is digital lending today.
Which is the best investments in technology out there? SBI. Look at the app.
Yeah.
It's phenomenal.
Perfect. I think on that note, we'll wrap this up. I really appreciate my panelists. Keeping it real, keeping it simple, dhande ki baat, real numbers, real challenges, real issues. I hope you were able to take something back. But on a closing note, I have to say this was a session on technology, on the role of LSPs, and I think Tanya did a wonderful job making LSPs a little more valuable and sexier. We do really do some work. Let's together as an industry really make loan into more of a sexier product like credit financing. We're ultimately boosting the economy of this country. And so to end in the famous words of a very, very dear mentor guide of mine, Sharat Sharma, who runs iSpirit, he really very strongly and passionately says this is priority sector lending. We need to focus in emerging markets like India on priority sector lending because we don't need to fuel consumption. For all of us to buy one more fridge, one more TV, let's not fuel consumption lending, but let's really fuel business lending. वो छोटे वर्कशॉप वाले को 3 महीने का पैसा देगा, वो ज़्यादा चेयर बनाएगा, वो बेचेगा, he'll drive employment, ultimately driving consumption and driving our economy. So on that note, I really thank all my panelists and thank you very much.
It was indeed a very interesting session, sir. Thank you so much for carrying it out. Now I would like to request you to kindly felicitate our panelists. To begin with, Mr. Anil Pinnapala, founder and CEO of Microfin. Please bring your hands together, everyone. Thank you. Next, Ms. Riddhi Dungusre, co-founder Lakshmi. Next, Mr. Deepak Jain, co-founder Flexi Loans. And last but not the least, Ms. Tanya Chadha, Chief Business Officer, Ugro Capital Limited.
Lovely, pleasure.
And not to miss, I would like to request Mr. KK Gupta sir to kindly felicitate our moderator. We are going ahead with the co-lending awards, everyone, right after this session. So we'll request the delegates to be with us in this room. A group photo, sir. Gupta sir, group photo. Perfect moments to remember. Thank you so much, everyone, for this lovely session. And we request you to be with us for the co-lending awards.
The critical role of partnerships between banks and NBFCs in driving financial inclusion. These awards celebrate the institutions and professionals who have demonstrated excellence in implementing co-lending models, advancing regulatory compliance, managing risks effectively, and integrating cutting-edge technology. By highlighting these successes, the AFAI Co-lending Awards inspire innovation, encourage best practices, and promote collaboration across the financial industry, contributing to the growth and sustainability of co-lending initiatives in India.
I would like to call upon the eminent jury panelists on the stage to honor our winners across 9 refined and fine categories. Our first jury member, Mr. UP Singh, IAS retired, Ministry of Textiles, Government of India. Mr. UP Singh is a former Secretary of the Ministry of Textiles and the Ministry of Jal Shakti, Government of India. A 1985 batch IAS officer from the Odisha cadre, he has held significant roles across central and state governments, bringing a wealth of experience and expertise from his varied assignments. Our next jury member is Mr. NVS Mallikarjun Rao. Mr. Rao is an accomplished financial advisor with 15 years of experience across India, holds a master's in commerce from Hyderabad, and brings 8 years of prior banking experience. Specializing in accounts, audit, and financial advisory, he has a well-rounded expertise in guiding clients on financial management and strategy. Our third jury member is Mr. Ashutosh Mishra, CGM NABARD. He has an extensive experience in risk management across India, the Middle East, and the Central Asia. Starting his career with SBI, he has held senior roles including CRO at SBI Life and Chief Risk Manager at NABARD since 2015. A certified member of the Institute of Risk Management, London, Mr. Mishra holds an MBA from IIFL, a law degree, and certifications in risk and credit management. I would like to request Mr. K.K. Gupta sir to join our jury members. Now I would like to request Ashish Agarwal sir to felicitate our jury members. Then Mr. NVS Mallikarjun Rao sir. Now Mr. Ashutosh Mishra. And then Mr. K.K. Gupta sir. The process of evaluation of these awardees have been really comprehensive and very, very much statistical. And to explain more about that, I would like to request UP Singh sir. So as you wish, sir. We have a switcher as well.
Very good afternoon to all of you. My name is UP Singh, even though I am not from Uttar Pradesh. I am unlike most of you, I see a lot of young faces here. I am a much retired person. I superannuated a couple of years back after putting more than 37 years in what is called an Indian Administrative Service. I belong to 1985 batch of IAS in Odisha cadre. I am not a finance man. My only kind of a connect with finance has been long back, 98-2001. I used to be in what was then called a banking division. Now it's called Department of Financial Services. And I thought banking in those days used to be totally different than a banking today. I had never heard of those days naturally a word like co-lending. We hardly knew anything called non-banking finance company. There were, in fact, I remember I used to burn my midnight oil in drafting a legislation for non-banking finance company at that point of time. I am talking of 98-2001. Anyway, having given an introduction of myself, I was just outside discussing with some people, and I am very happy that still there are half the seats are filled up. In fact, मैं लोगों को बता रहा था, I switch over sometimes from English to Hindi. Hindi is the flavor these days. If you come to Delhi, any presentation which is made to the Prime Minister, even of a scientific department by a South Indian gentleman, would be in Hindi. So I keep switching over from English to Hindi. तो मैं बाहर बात कर रहा था कि देखिए जो यहाँ पे आते हैं जो वर्कशॉप सेमिनार्स कम से कम गवर्नमेंट में, उसमें 3 तरह के लोग होते थे। एक होता था बैग टाइप, जो वीआईपी आए उनके साथ आए, इनॉग्रल सेशन हुआ, बैग उठा के चल दिए। अब आई डोंट नो वेदर दीज पीपल हैव गिवन यू बैग्स और नॉट, आई एम नॉट वेरी श्योर, बट इन मोस्ट ऑफ द गवर्नमेंट वर्कशॉप सेमिनार्स यू हैव बैग्स, so they are bags type. Then there are lunch type, in the sense that they stay up to lunch. अभी जब लंच अच्छा खिला देगा तो आदमी यहाँ बैठ के कुछ थोड़े सुनेगा, यहाँ सो भी नहीं सकता है ठीक से, तो दे गो बैक होम एंड स्लीप. सो दे आर बैग टाइप्स. सो जो असली लोग जो होते हैं ना, वो पोस्ट लंच सेशन में जो लोग रहते हैं, दे आर द रियल वंस. सो आई अंडरस्टैंड दैट ऑल दोज हु हैव स्टेड बैक आर द काइंड ऑफ people who are really interested in the conference and proceedings here. Having said that, I am supposed to make a PowerPoint presentation. I am not generally very good at PowerPoint presentation, because many times what happens, there is neither power nor any point in those PowerPoint presentations. So anyway, since they have told me, but before that I will tell you, when they asked me to, Ashish Agrawal, Jyoti is a good friend, so they requested me that you become one of the jury. Now many times what happens that you become a consultant if you do not know how to do things yourself. So similarly I thought, but then one should know the subject. Then I found that I hardly know of this subject. Anyway, I have been, all three of us, not only me, but all three of us have spent some time to understand the categories, to understand the parameters, to understand the kind of all the inputs which you have given in those applications. And based of that, to the best of our knowledge, we have done our job. The only thing I have told Ashish, because if this event is going to be an annual event and these awards are also going to be an annual award, then I have told him that perhaps we need to have a little relook at even the categories, because some of the categories I found a category, but I found that parameters do not, basically the parameters on which we evaluate are not very pertinent to that category. So that is to be looked into. The other is that the weightage has been given to all parameters same. Maybe perhaps we need to change that also, because some parameters maybe should be given more weight, some may be given less weight. So categories and parameters and weight to parameters, perhaps people will sit down and after this workshop and they will work out for the next time. So having said that, let me quickly, it will take not more than 2-3 more minutes to go through this. Yes, please. So basically, as you said, there are award categories. So there are broader 4 categories actually. One is the banks, the other is non-banking finance companies, the fintech, and the loan service providers. So these are the 4 major categories, or under those 4 categories there are subcategories. So banks, as expected, there is one outstanding private bank in co-lending, another is outstanding public sector bank in co-lending, other is outstanding social impact in co-lending, and outstanding co-lending bank of the year, both private sector and public sector put together. So that's one banks category. In non-banking finance category, there are 3 categories: leading co-lending NBFC in MSME sector, leading co-lending NBFC in housing finance. I was told that NBFC primarily cater to these 2 sectors, and then there is a leading co-lending NBFC of the year. Then there are 2 on fintech, most scalable co-lending model and best digital onboarding solution for co-lending. And the last category was that of loan service providers, best personal loan service providers and best priority sector lending loan LSPs. So basically 4 categories and then subcategories, together 11 categories. Next. Now, in fact, except the 2 categories where there were only 1 application, there were more than 1 application in all other categories. And I do hope that next time when we come up with these kind of awards, perhaps there would be more people applying for these awards. So the total nomination received across the category was 35. You can see the leading co-lending NBFC in SME finance 6, leading co-lending NBFC in housing finance 1, leading co-lending NBFC of the year 4. So these were all together 11 applications under NBFC categories. Then the banks categories, there were total 10 outstanding private bank in co-lending 2, outstanding public bank in co-lending 3, outstanding social impact in co-lending 3, and outstanding co-lending bank of the year 2 applications. Under loan service providers category, there were total 6 applications, of which best personal loan loan service provider only 1, whereas best PSL loan there were 5. And then finally there was a fintech where most scalable co-lending model 3 applications, and best digital onboarding solutions for co-lending 5 applications. So altogether these 35. Now this was the evaluation process. The responses were received via email across all 4 categories or 11 subcategories. Each criteria as addressed through the questions was given equal weight, which I told you that maybe in future perhaps we should give a slightly different weight. The other thing is that there was no kind of a ground truthing or anything. Whatever you filled up, be presumed that all the figures which you have given is the correct figure actually. In government system is slightly different. Government doesn't believe people so easily. So in government we always look for evidences. So whether it is National Water Awards or whether it's the Swachhta Awards or whatever, so we do a lot of, we send the people to the field. Even during COVID times when we could not send people to the field, we used to have all kinds of a video recording and everything to find out that what somebody has mentioned in the application is correct. Here we have assumed that whatever you have mentioned in the application is correct, and it has been basically, your evaluation has been made based on that. Then the 3 jury members calculated a cumulative total score for each entity individually. Somewhere there were 12 parameters, somewhere the 10, 8 or whatever, the total was done. And the final winner was determined by factoring in the scores and reaching a consensus among all the jury members. And the jury meetings, the 2 meetings were held, and on 9th and 10th it was done through the video conferencing. So I think that's all as far as the process is concerned. Thank you very much, and let me congratulate the winners in advance. Thank you very much.
Well, I would like to ask the other dignitaries who wants to say a few words about the awards. As the time is ticking off, the grand finale of the summit has arrived. And for that, I would like to request Mr. Jyoti Prakash Gadia and Ashish Agarwal sir to kindly join the jury for the award ceremony. In the banks category, in the first category of the banks of outstanding private bank in co-lending goes to South Indian Bank. Congratulations, South Indian Bank. A moment to capture. Congratulations, South Indian Bank. Our next category in the banks is Outstanding Public Bank in Co-Lending, and the award goes to Central Bank of India. Now our next category of the award is Outstanding Social Impact in Co-Lending. And the award goes to, I guess Kini sir needs to come back, because it's Central Bank of India again. Big round of applause, everyone. See on the stage, sir. The whole team deserves a win.
Decathlon New Arrivals Collection starting from $199.
The next category of awards is the most interesting one, which is the fintechs. And we had two major nominations. The first category of awards is the fintech category, most scalable code model, and the award goes to UB. Keep clapping, everyone. Thank you so much. Talking about the second category, in the fintechs, best onboarding solution for lending. Well, we have a reputation like Central Bank because it's UB again. Please, everyone, bring your hands together. And the moments to capture. Our next major category of awards is NBFCs. And the first subcategory in the NBFC is leading co-lending NBFC in MSME finance. And the award goes to our beautiful finance speaker, Ugro Capital Limited.
So heavy, the world it feels so dark. Let it come, let the sun come in. Soul is filled with sadness, the mind is torn. Let it come.
Congratulations to the capital. The second category of awards in the NBFC major category is leading co-lending NBFC of the year. And after continuous evaluation and many nominations, the award goes to Nath Capital Private Limited. Please bring your hands together for them. Congratulations, Nath. Fourth category of award is loan service providers, and the best PSL loan LSPs goes to Wipro Capital Private Congratulations, Ugro Capital. In the banks, the outstanding co-lending bank of the year the award goes to IndusInd Bank, but unfortunately we don't have their representative right now. So, for the felicitation of the juries, I would like to request Mr. Jyoti Prakash Gadia to felicitate Mr. UP Singh sir. Please bring your hands together, everyone. And now I would like to request KK Gupta sir to felicitate Malika Arjun sir. And now Mr. Ashish Agarwal sir to kindly felicitate Mr. Ashutosh Mishra sir. I would like to request Mr. Ashish Agarwal sir to felicitate Mr. KK Gupta sir. Well, as we come towards the end of this event, we would like to thank our sponsors, but right after the vote of thanks by Mr. Gupta.
Good evening, friends. It is indeed a very pleasure for me to propose a vote of thanks to all the jurist members, our respected dynamic leader, Shri UP Singh ji, Mallikarjun ji, Mishra ji, who have put their extra efforts to decide. This is very tedious work to decide the price. After vetting the rating and all aspect of the award you have to give to these people. At the outset also, I congratulate the awardee. For the first time, they have got the award under the co-lending. Really, how Mr. Ashish Agarwal designed this program and coordinated with the bankers, with the NBFCs, and with other stakeholders is really appreciable. On behalf of the association, for financial services, I propose the vote of thanks to all the speakers, all the participants, all the delegates. During this full day conversations, I think there must be something which you should take to your home. I think I also attended one or two deliberations. It is extreme excellent. What is the outcome will be there? I think association may come out with some paper with your recommendations. And I also request you to give your honest feedback so that such program can be held in future under the banner of the associations. Further, I am thankful to the Resurgent India under the dynamic leadership of Mr. Gadia coming out the knowledge report. If you have time, please go through the knowledge report. What are the challenges? What are the opportunities? And what the business growth path can be available? I think all things are incorporated in the knowledge report. So please give your feedback also to us on your knowledge report also. So participants were excellent. Questions what they asked also very relevant to the subject. So I have nothing to say further. Only propose a vote of thanks to all the delegates, to all the speakers, and especially to our esteemed Managing Director, Mr. Saxena, who has given a path. He is telling me what are the sources, what are the resources. And Mr. Tripathi sir has come out from the before nationalization, 1969 to till date, how the banking sector has progressed. And Mr. Nath come out very, very clearly, his three visions about he telling the technology, he telling of the transparency, and further he talking about the trust. Trust is the most important thing in any banking sector. I'm just telling you, before I think 25 or 26 years back also, when I was in a bank, so I was also telling, we are not giving a loan. If central bank people are here. So I am just telling the borrower, in our conferences, we are giving you capital. You take it a loan as a capital. And from your cash flow, from your cash surplus, you refund to the bank. I think that concept for 25 years, 30 years back came into existence. I think this is the most important challenge regarding the digital lending. Now the banker has to collect the information from the digital platform without asking any information from the party. Let they should process the proposal on the basis of the cash flow. And that lending, balance sheet lending is nowhere. Now question is cash flow lending. Concept is already undergo a change. Now Chore committee, Tandon committee, Naik committee, our committee are no more. Now point is, what is your digital lending? What is your cash flow? That is the most important thing. Thank you very much for all the participants, for all delegates, and all my friends and banker friends also. Thank you very much, sir.
Thank you so much, sir, for a very well-versed vote of thanks. Now we would like to thank our sponsors for this event. And for that, I would like to call Mr. Ashish Agarwal, Summit Chairman, to give mementos to our sponsors. Our first sponsor is Central Bank of India. Our silver sponsor, Central Bank of India, Ugro Capital Private Limited, representatives from Central Bank of India are requested to take them. Next is our silver sponsors, Ugro Capital Private Limited, representatives from there. And for your contribution to the co-lending awards. Next up, associate sponsors, Punjab National Bank, representatives from Punjab National Bank. Our next associate sponsors, SIDBI. Representatives from SIDBI are requested to kindly come up on the stage. In the next are the fintech partners. We would like to call Plutus One. So representatives from Plutus One. We thank Plutus One to being our fintech partner for this summit. Next, for the association partners, we have PSL.
Friends, now we end this conference, and I hope you have enjoyed a lot, and you have listened to all the speakers and all the moderators and all people who have come to give us the lot of insights about the co-lending. I would like to thank you on behalf of AFAI, to all of you for joining with us. And as I told in the welcome speech that we will keep it continued. So the next year conference of this co-lending, that will be bigger than that. And we have decided it's on the 5th November 2025. That's a Wednesday. So I will request all of you to please keep your calendar blocked for this 5th November 2025. We will soon send you the detailed program, and we look forward support from all of you also. And I will once again would like to thank you to everybody for making it successful. And now I would like to invite all the 5D leaders. Thank you so much. Thank you all. Thank you.